Hello, good morning. You're tuned into CNBC TV 18. You're watching Power Breakfast with me, Vinny. Along with me is Rachna as well. Rachna, a very good morning to you and Tuesday, hoping for a better day.
Absolutely, and good morning to you as well. Please take us through the headlines for this morning.
Let's start with the top headlines coming in from the US. Wall Street has kick-started the week with losses hurt by higher oil prices amid the rising Iran tensions and higher yields. Asian markets trade mixed with GIFT Nifty, which is hinting a negative start for the Indian market.
Tensions between the US and Iran remain elevated. Trump rules out extending the expired MOU and called on Tehran to surrender, while claiming talks with Iran's IRGC, an assertion the group has denied. Iran, meanwhile, has signaled a tougher stance following the expiry of the MOU.
Oil gains for the third straight session as prospects for a new agreement between US and Iran weakened. Also threats of bombing Oman if it interferes with shipping through Strait of Hormuz. Meanwhile, gold holds firm as Fed rate hikes, bet eases.
Government clears 31 approvals worth over 7,800 crore rupees under the Electronics Component Manufacturing Scheme. This includes 5 listed companies like Centrum, Syrma, subsidiaries of Wipro and Minda Corp, along with PCBL Chemicals.
Tata Sons annual general meeting scheduled for today may be adjourned due to the lack of quorum as per the sources. Now, Sir Ratan Tata Trust, a key shareholder in the holding company of the Tata Group, was unable to nominate a representative due to a regulatory restriction imposed by Maharashtra's Charity Commissioner.
All right, those were the headlines that we're tracking this morning. But let's look at the Asian markets. And it seems like a morning of mixed trade across the region. Taiwan is marginally lower, so is Hang Seng, as you can see it on the screen. But Korea is where the action is. The Kospi is back from a holiday and flying. A big move higher led by memory. SK Hynix is doing the heavy lifting there. As you can see, 1.5% up now. Japan, however, goes the other way. The Nikkei modestly lower, almost a percent. It can hit, but not yet. So Asia is pretty split this morning. But Wall Street handover was also soft. Crude hit the $90 mark after Trump refused to extend the Iran agreement. For India, let's look at the implied open. Well, it was indicating a bit of a, yes, that's right. It is a negative start for the day is what the Nifty implied open is indicating, about 80 points down, Winnie.
Absolutely, 80-point downtick, more like a gap down now that we're keeping an eye on. But hope for the recovery, given that it's expiry. But to take us through important cues that we're keeping an eye out on in the Indian market, we have a team of research joining us to set us up for trade, tell you which are the important stocks to watch out for, as well as cues in the world of F&O. First up, let's go across to Hormaz, who's joining us to tell us the market cues we should keep an eye out on. Good morning, Hormaz, and today, weekly expiry. Are we going to see a bit of a swing from this 80-point downtick?
Well, swing, we definitely saw one towards the close of trade yesterday. The first time after the implementation of CAS, instead of a recovery from the lows, we saw a downtick from the highs on the Nifty yesterday. And after 5 days of losses, we most probably open lower as well in today's session. That's the kind of trend the implied open is indicating as well. The 80 points lower is where the implied open is. And if that holds, we most probably open around that very, very important 24,200 level, which is going to be the most important support zone to watch out for in today's trading session. And of course, another day of the index making lower highs. And of course, on the upside, 24,350, 24,400 remains the supply zone, because as we keep grinding lower, every support that was earlier now starts to become a resistance level as well going forward. Today being the weekly expiry of the Nifty, on expiry days, participation generally goes up in the cash. So that is something that needs to be watched out for. And of course, today is another day where there are multiple QIPs launched, block deals that are lined up as well. Keep an eye out on that. And the Nifty Bank as well, similar to the Nifty, gave up all the intraday recovery that it saw during CAS, ended at the flat line, still at that 57,500, 58,000 range. That remains to be the important one to watch. On the downside, buying interest emerging every time around that 57,000 level. So lower end and the higher end still that 1,000-point range. And of course, Paytm, NetWeb Technologies and Shriram Pistons, something that you need to watch out for the QIPs and the supply. Of course, we opened lower today, 24,200, the most important support to watch in today's session.
All right, Hormaz. Now let's go across to Ananya for a list of stocks to watch out for in today's trade. Good morning, Ananya.
Good morning. So let me first start with Paytm here. Now what happened is Resilient Asset Management, which is a promoter entity, plans to sell up to 4.98% stake while economic interest stays with Antfin here. So watch out for this. Now GMR Airports had started operations at Bhogapuram Airport with 6 million passenger capacity. Now, Oberoi Realty gets relief as Haryana DTCP upheld approval for its Gurugram project. Now, Indomim, they came out with their Q1 results, so that will be a key trigger here with revenue up 9% and profit up 32%. Now, Netweb Technologies opened up its QIP at 4,885 rupees per share. Now, IIFL Finance and Premier Energies, they received a rating upgrades here, so they'll be buzzing on back of that. Now KPI Green Energy, they commissioned another 130 megawatt of solar capacity. Now Seagull India is in focus, will be in focus after Delhi PWD cancelled a 331 crore tender. And finally, Nelco partnered with a US satellite company to expand satellite connectivity across India and South Asia. So watch out for these stocks in today's trading session.
Okay, Ananya, thank you so much for that. But let's go across to Sudarshan, who's dressed to support the bulls today. Sud, are we seeing anything positive in the FNOQs? What are the levels that we are watching out for?
So yesterday we saw for the first time that market adjusted lower after post-CAS, that is closing auction session. But the biggest negative for us is the sharp spike in the crude price. We have seen Brent is back over the level of 90 after Trump's message to Oman, "Maan na maan, main tera Oman." So now, but for as far as the range for Nifty is concerned, it's from 24,200 to 24,500. We are seeing a good support at 24,200, so it's very unlikely in the near term for Nifty to slip below the level of 24,200. If we breach that, then in all probability we can breach 24,000. Now, what has FIs have done? So FIs in the index futures, they were sellers. In the stock futures, they were minor buyers. They continue to reduce long positions, add short positions. Now in the options data, as I told you, on the put side, 24,200 and 24,300 were the most active ones. And on the call side, 24,300 and 24,350 have seen maximum change in the open interest. So support I have taken for Nifty, first support around 24,200, first resistance 24,500, and all the same stocks are in the band. And two stocks that I'll keep an eye on: Oberoi Realty, there is a positive development, and Muthoot Finance, gold prices are higher, and also the stock is seeing short covering.
All right, thank you so much, Sid, for that comprehensive update from the FNO desk. Manisha Gupta joins us now with all the updates from the commodities space. Good morning, Manisha.
Morning, and thank you for that. Well, I'll start with the crude oil prices, where we are looking at stronger gains coming in the overnight markets. Well, so much so that we have crossed above 90, and we did see a high of $92 a barrel in the overnight markets therein. Well, the Lebanon has seen fighting yet again. US says that they are not looking for any resolution with Iran right now. And even as Iran and Oman have continued to talk about management of Strait of Hormuz, we haven't seen any resolution come from that as well. The support also comes in from the fact that you have the dollar index now trading at a 3-month high, and that clearly has been supportive. In the otherwise, you also are looking at the precious metal prices gaining firm. You have gold and silver prices trading on the higher side. Within metals, it is about copper, which is trading firm. Aluminum prices, though, have seen some profit taking coming into the markets. But all eyes now on the U.S. Fed meeting minutes, which are coming in on Wednesday. And then, of course, you have the Jackson Hole Symposium that's happening in the last week of August. These two factors would tell you on where the markets are moving.
Absolutely, Manisha. Thank you so much for that important cues to watch out for at the end of the month as well. But on that note, we're going to step into a very short break. After the break, we'll come back, give you the latest from what's happening in West Asia. Stay tuned in.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Let's get you updates from West Asia then. US President Donald Trump stated that Iran ought to put up the white flag of surrender after the Memorandum of Understanding deadline passed on Monday. Trump also warned he would target Oman if the country hindered actions to reopen the Strait of Hormuz.
Well, they want to make a deal, but they're not going to make the kind of a deal that I feel is necessary. Look, we're in there for one reason. Iran cannot have a nuclear weapon. You understand that? Iran cannot have a nuclear weapon, and they won't have a nuclear weapon. And right now, them building one after what we did previously with the B-2 bombers, going to be a long time behalf. But Iran cannot have. It's very simple. They can't have a nuclear weapon. No, I don't think they behave very well, but we'd handle them very easily, just like we do other things.
Well, that was US President Donald Trump. Meanwhile, Iran Foreign Ministry spokesman Ismail Baghi said that the 60-day time frame tied to the June 17 memorandum between Tehran and Washington lost all meaning after the US broke the pact shortly after signing it. On the other side, Turkey's president urged US President Donald Trump during a phone call to keep diplomatic discussions with Iran active to make use of the current opportunity, stating that Turkey stood prepared to assist with the process. Elsewhere, the U.S. Central Command announced that the U.S. Navy turned away 64 commercial vessels in the Strait of Hormuz since mid-July.
That's an update from West Asia. But what's happening in the U.S.? Wall Street opened up the week with a lower start with fresh Iran tensions, rattled markets, as well as sent the oil prices higher. Now, in a massive AI deal, NVIDIA will provide up to $105 billion in financing for a new OpenAI data center in Ohio. Let's go across to CNBC's Kate Rooney, who's here to give us a wrap on everything that's happened on Wall Street. Kate.
Markets were fractionally lower to kick off the new week as new Iran tensions weighed on stocks. Oil prices were higher following the developments, and the 30-year Treasury yield hit its highest level since June 2007 as oil prices advanced. The Dow fell 272 points, S&P 500 dropped 40 points, and the tech-heavy Nasdaq shed 84 points. NVIDIA will provide up to $105 billion in financing for a new artificial intelligence data center for OpenAI in Ohio. That's according to a securities filing on Monday. The credit will support an initial 4.25 gigawatts of computing capacity, with the option for an additional 3.75 gigawatts. And Paramount Skydance, in a new filing today, is seeking to force states holding up its merger with Warner Brothers Discovery to pay for the fees and costs associated with that delay. According to the filing, Paramount is requesting a $1.9 billion bond that would be posted by the states behind that lawsuit, led by California Attorney General Rob Bonta. Under the terms of the merger, Paramount will owe Warner Brothers a so-called ticking fee of 25 cents per share per quarter until that deal closes, which translates to about $650 million per quarter.
All right. Thank you so much, Kate, for that update. Those were the global updates. But now let's slip into a break. Up next, we get you updates from the world of technology and artificial intelligence. So stay tuned.
Welcome back to Power Breakfast on CNBC TV 18. Now let's get you the latest from the world of tech and AI in our special segment AI Pulse. Rachna has hopped onto the wall to give us the updates there. Rachna, over to you.
Well, first update that we're getting in from Washington is that Washington is preparing to tell partner countries to pick sides in the AI race against China. A draft letter warns the signatory companies, and India is among them. Now, the letter says joining Beijing's rival framework would mean exclusion from the US coalition. Then a crypto firm backed by Donald Trump is working with a Hong Kong venture selling access to Chinese AI models. A Reuters review found 43 of 90 models on the platform came from Alibaba and Baidu and Z.ai. The White House has denied any conflict of interest, though. Anthropic's revenue run rate has topped $65 billion, up from $47 in just May. And it is now projecting 2028 revenue between $190 to $200 billion, the forecast behind its IPO price. Then voice AI firm Whisper Flow is valued at $2 billion after a $280 million round backed by Peak 15. Whisper Flow was founded by Tanay Kothari and Sahaj Garg in 2021. And lastly, Sarvam's 14,257 crore rupee Odisha data center with HCLTech is moving ahead, with HCL bearing a majority of that chunk. Sarvam co-founder Pratyush Kumar said the company is focused on the software layer but would still be investing some capital in the build-out. However, the Kaze glasses that broke the internet with the Prime Minister donning them in February and were demonstrated at the India AI Summit were slated for a launch this year in May have now been delayed on back of rising memory costs. Listen in.
Combines India's current strength in these IT services with now we are looking at from an innovation point of view. The leadership is very, very supportive, and we in fact started working closely together. But this area will need more and more capital, and I think we'll continue to engage deeply with the company.
Okay, that's the update coming in from the world of AI. But a quick look at in terms of the Asian markets, we've seen a further fall coming in, especially if you look at Kospi, Nikkei. All of them have now moved off the day's highest point. Even the Nikkei is down furthermore, 1.3% in trade. We have seen Kospi, which is now just holding on to gains of 0.6%. So clearly, Asian markets are also cooling off from the day's highest point. Will be key to watch out for over there, where that is going to be headed, as well as let's look at the Nifty implied open one more time. Right at the start of the show, it was down 80 points. Nifty implied open current indication will be key in terms of 98 points downtick. So a gap down start that continues. Furthermore, downtick that we've seen for the Nifty implied open. Today is going to be weekly expiry. Let's keep an eye out on that and in terms of volatility. But as of now, a gap down start for the Indian markets. But with that, we're absolutely out of time in this edition of Power Breakfast. Thank you so much for tuning in. Up next, we have Bazaar Morning Call to take you through all the market action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Tuesday morning, lots to cover. Oil, unfortunately, is headed in the wrong direction. 90 plus this morning as we kick things off. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Morning.
Hi, morning.
Hi, morning. So crude prices are declining. Crude prices are rising, so $91 plus. And Asian markets too are on the back foot. So pull up the Japanese markets, that's down 1.5%. The Taiwanese markets lower by 0.5%, and the Korean markets too a bit subdued.
Well, that's right. Prashant, let's get straight to the action then.
Well, and I think action is, of course, what's happening with oil. And, there you go on your screen. I don't think much needs to be said beyond just sort of, putting that rate up. We know, all the consequent implications of oil headed in the wrong direction. It's we like it, not like it. It's a big macro thing. And it flows through in so many other ways, through the macro channel, through the micro channel, et cetera, et cetera. Of course, one just hopes that it doesn't stay here. It's not as if there's there's a shortage of oil. There's enough oil, more oil. And we saw briefly what happens when the Strait of Hormuz opens. Prices collapse to $70. But the fact is, ships aren't passing through the Strait of Hormuz. There's no end in sight as far as the blockade is concerned. And that's an important shipping route. And that's the problem. Iran, in terms of just sort of news flow overnight, Iran seized a UAE-owned oil tanker in the Strait of Hormuz. And they said this yesterday in the last 24 hours or so, that Iran is now shifting its policy from a defensive one to a fully offensive one. So essentially, it's not going to be reaction-led. It's not going to be based on, in terms of reacting to stuff which comes their way, but they're going to be taking action first. So, and of course, there was President Trump who told Fox News that he's in no hurry to end the war with Iran. But of course, that one, you got to take it with a pinch of salt. But, there are lots of comments pretty much every day, and we don't know which way things will go in that sense. Trump, of course, also saying that Iran should, and I quote, put up the white flag of surrender. And of course, Iran's got is in no mood. He said, Trump essentially went on to say they're in talks with the IRGC, which is Islamic Revolutionary Guard. IRGC denied that they're in direct talks with the US. So it's more of the same. It's a muddle, and we don't know what's the way out going to be. Foreign policy experts, even out of the US, who cover the Middle East, etc. If you read a fair bit around this, the general consensus is it's not an easy solution. There is no solution which is like a clean win, clean victory for the US, and they kind of sort of walk away. The midterms, remember, are also approaching, and all of this is not helping. Gas prices and sentiment, etc. US equities were also lower. S&P 500 down about 0.5% or so. Of course, the other one was the 30-year yield in the US, which went up 5 basis points, about 5.3. It's the highest in almost 20 years, the highest since June of 2007. There were two other factors, which led to this bid as far as treasuries go, yields go. So stronger US data, the Empire manufacturing numbers came through, and there was, of course, heavy corporate issuance, which we've been highlighting earlier as well. So keeping yields bid a fair bit. I'll just leave you with levels, so it's not very much different from where we left off yesterday. Although we are closer to the support levels, we're actually pretty much at 24,300. And actually, the first one is 24,300, which is where, slightly above that level is where the Nifty left off yesterday. Below that is about 24,200, 24,220 or so, but 24,200 roughly is that level. On the upside, the first one is 24,400, and then, there's that trend line, which, because the market did not do very much, is still at about 24,450, 460. So those are levels, not very much changed from what we put out yesterday. GIFT Nifty comes up on your screen, gives you a quick sense of how we're likely to start, and then we move on from there. So yeah, I think that 24,300 and even 24,200 kind of levels, do they come into play and will they hold is the question. Nigel has walked across to the wall. with the F&O and the positioning. Najib.
Well, after the kind of earnings season that we saw, you'd expect the markets actually to gradually move up. The problem is the fresh supply of paper. That's what's drying up liquidity, and that's what's weighing on the market. And this morning, we have the other negative, which is Brent crude prices have perked up from around that $85, $88 per barrel mark. It's gone to around $91 per barrel mark. As we always wish, we hope that Brent crude prices go down from a bullish perspective. Well, yesterday, the cash session, for the first time ever, that's, the 3:15 to 3:30 session. After a while, or the first time ever, actually, it went to the bears because the markets ended lower by close to around 52 points or thereabouts. So part of this bad news could have been factored in because of the cash session itself. So we'll have to see how that goes, given that the gift Nifty is indicating some weakness to kickstart trade. Flows were mixed in yesterday's trading session, though the DI buy continues. But the problem, as I said earlier, is in fact this kind of liquidity that's getting sucked out by the QIPs, by the IPOs as well, and basically large trades. Well, moving to the FI data on index futures, well, the short positioning, that's moved up by around 4,700 contracts. And in the last few days, it's gradually been moving up by 20, 30,000 contracts from the lows that we saw earlier. So the short positioning is moving closer to around the 2 lakh contracts or thereabouts. In percentage terms, from around that 86% odd mark that we saw just a few sessions ago, that's moved back to around 89%. So the short positioning has moved up and shorts are back in the system. Well, in terms of the index options, that's going to be important because today's a Tuesday, which means that the Nifty plays out the weekly expiry as well. And yesterday, there were more puts than calls that were written, close to around in the ratio of around 2 puts for every 1 call. Moving to the options data then, if you look at the strikes that were active, the 24,350 call added close to 30 lakh shares. The premium out there around 70 rupees, while on the downside, the 24,250 put, well, that premium is holding at around 20 rupees. But given that yesterday we saw the cash session, put us under some pressure and ended sub the 24,300 odd mark, and the gift Nifty suggesting some weakness because Brent crude prices have moved up. I think the first reference point on the downside, by the end of today, you don't want this level of around 24,200 to break. That's going to be important to track. The 20 DMA, that becomes the first level of resistance on the way up. And otherwise, looking at the options data, given that the 24,350 call as well was fairly active, this becomes the resistance mark. So in terms of the band for the day, it's a 220-point band between the 24,200 mark and 24,420 odd mark. Brent crude prices, that's the niggling worry, as well as fresh supply of paper.
Thank you very much for that. And now let's get to the latest on West Asia, and the rhetoric seems to be escalating. US President Donald Trump stated that Iran ought to put up the white flag of surrender after the 60-day memorandum of understanding deadline passed with no breakthrough on Monday. Trump also warned that he would target Oman if the country hindered actions to reopen the Strait of Hormuz. Listen in.
Well, they want to make a deal, but they're not going to make the kind of a deal that I feel is necessary. Look, we're in there for one reason. Iran cannot have a nuclear weapon. You understand that? Iran cannot have a nuclear weapon, and they won't have a nuclear weapon. And right now, them building one after what we did previously with the B-2 bombers, going to be a long time behalf. But Iran cannot have. It's very simple. They can't have a nuclear weapon. No, I don't think they behave very well, but we'd handle them very easily, just like we do other things.
Ed Yardeni, President Yardeni Research is now joining in. Ed, in just 10 days, it will be 6 months since the fighting in Middle East began. Protracted, this low, medium intensity warfare continues with no clear end date or an off-ramp. Is this the new economic reality? Do we sort of need to adjust to this semi-permanent state of hostilities in Middle East? What's your assessment now?
I think that's a good question. And I think the answer is right now, it definitely seems so. When the war first broke out and I heard that the U.S. had managed to take out the main leaders of Iran, my initial reaction was that it would be a short war. And then the very next day, I thought about it some more and came to the conclusion that this may not be a short war, that at the end of the day, we're really going to be dealing with the IRGC. And the IRGC is, for all practical purposes, they are a professional terrorist group that's taken over a country. And they are not particularly concerned about the pain they are causing their fellow citizens. As we know, they're willing to kill their fellow citizens if they object to what their policies are. This could be protracted. This may mean that the U.S. continues to blockade Iranian ports and tries to come up with other means to choke off the economy of Iran. And meanwhile, the IRGC do whatever they can to keep the Strait of Hormuz closed. But it is fascinating that the price of oil hasn't gone up a lot more, which does suggest that, well, oil is liquid, and one way or the other, it's pouring out of the Middle East.
It's not just getting through. Ed, morning. Good to have you with us here. On bond yields, especially on the long end of the U.S., how do you read it, the 30-year?
Well, I am concerned, but not too concerned. I've been thinking that the 10-year government bond yield would, in fact, be ranging between 4% and 5% over the rest of this year and into the next couple of years. And the idea is, people keep saying that interest rates are going to stay higher longer. Actually, interest rates are where they should be. Higher longer implies they should be coming down, but the 10-year bond yield was 4 to 5%, and when it was normal, it was normal before the great financial crisis. It was also between 4 and 5%, and before the great inflation of the 1970s, it was 4 to 5%. 4 to 5% is a sign that the economy is healthy, that the capital markets are working as they should be working. So I'm not particularly concerned at this point, but doesn't mean that others aren't. Clearly, there's a lot of nervousness about the fact that the 30-year bond yield is the highest it's been since 2007. But again, that's when the bond yields were normal.
The only thing is interest rates are where they should be. Are stock prices where they should be? Question mark, Ed, in relation to where bond yields are at.
Well, it's funny. I'm actually just writing for my quick takes for tonight after this interview. I'm writing a piece on the possibility that the old relationship between stocks and bonds may be coming back. I called it the Fed stock valuation model. And it does suggest that the bond market may very well be back as an important variable in determining the forward PE, the valuation multiple of the market. And at even if we got to 5%, 1 divided by 5, the reciprocal would be basically the valuation multiple of the bond market, and that would be 20, which is where the valuation multiple of the stock market is right now. So the stock market right now is actually fairly valued relative to the bond market at around 7,800.
All right, Ed, giving all the cues that we have, if you were to be allocating fresh money to the U.S. markets, between U.S. markets and gold, I recall, you were quite bullish on the S&P 500 as well. And a lot of the levels that you've given us have got taken out. If you're putting fresh money, given the correction that we've seen in gold, as well as the kind of momentum we've seen in the U.S. stock markets, what would the allocation be?
Well, in the stock market, I am still bullish on the S&P 500 for the end of the year. I actually raised it to 8,400 because of earnings. I've been told that I'm the most bullish on the street, and my response is actually I'm not. It's the analysts that are the most bullish on the streets. They keep raising their earnings numbers, and so I'm kind of following them. Within the S&P 500 or the stock market broadly, I've got AI fatigue. I think everybody's a little tired of it. It's hard to kind of figure out who's going to win and who's going to lose. I think technology, broadly speaking, will win, and the NASDAQ 100 makes a lot of sense as a way to play that. Other than that, I'd like to play the areas of the market, companies that will benefit from using AI, and that's financials, life insurance companies, property insurance companies are already using it to reduce their costs. Industrials will continue to build the AI infrastructure, and the hospital, the healthcare system, I think, clearly could use a lot of productivity booms related to using AI. And with regards to gold, I thought before the war started that gold would get to 5,500 by year end. Then the war hit, and much to my surprise, the price of gold actually went down on that because some central banks had to sell gold in order to prop up their currencies, and that kind of got a lot of weak hands out of the gold market. I think it made an important support level at 4,000, and I'm not looking for 5,000 by year end, and I'm still using 10,000 by the end of the decade.
All right, Ed, we'll leave it there. Thank you very much for joining us. Good speaking with you. And we look
Always a
forward to that
pleasure.
note. Send us those quick takes. We'd love to read them. But interesting point there. But it's also interesting what you're saying, that, I mean, relative to bond stocks are fine, at least where they are at this point. We'll take a quick break. We're just running you through interactions which are lined up on the program. 9 o'clock, we'll be joined by Gaurav Malhotra of Access Capital. We focus on the telecom space. 9:20, Nilesh of Envision Capital as a market master of the day. 9:30, management of Patanjali Foods will join in to break down their June quarter earnings. The management of Park Hotels speaking with us at 9:40 on their first quarter earnings. 9:50, excerpts from our conversation with the management of Dixon Tech on the sidelines of the Motilal conference. Lata speaks with Harendra Kumar of Velara on first quarter earnings and the takeaway for the full year earnings growth outlook.
Well, time to slip in a quick break. We've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. We're looking at Indomim, Obra Realty, Manipal Health, Sigma Advanced Systems, as well as GMR Airports. All of them will be reacting to positive news flow, while you have Paytm, NetWeb, SPR Auto Technologies, Sigil India will be reacting to negative news flow, and a mixed reaction on Colgate. Take that break. We get into further detail on all of these next.
Welcome back. The GIFT Nifty is lower by nearly 100 points, reacting to the increase in crude prices. Brent today is at $91 per barrel plus versus yesterday's level of $89 per barrel. It's just that once we open lower, keep your eye on yesterday's intraday low of 24,227. From there, there was that effective bounce which took place before the market sold off in the last 10 minutes on account of gas. So let's see whether we can protect that level of 24,227, the intraday low yesterday, the lowest since 30th of July. But let's talk about stocks then. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, everyone. Vivek, why don't you go first? Paytm, NetWeb and Shriram Pistons in focus.
Well, that's right. Good morning. Just as we've concluded, the earnings season, a whole host of equity supplies on the cards. First on the list is Paytm. A large block deal of close to 4,900 crores is expected to transpire in today's trading session. The seller over here is Resilient Asset Management. The offer floor price is set at a little less than 3% discount, indicating that there is a chance that this particular block deal may happen in the block window itself. The base offer size is 3% of the equity, and the upsize option is a further 1.98% of total equity. There is a lockup of 90 days on further sale of shares. There was a clarification from the company to the exchanges last evening that the final economic interest of this particular block deal proceeds will actually be going to Antfin, that holds OCDs in Resilient. The other stock on the radar is SPR Auto Technologies, earlier known as Shriram Pistons. A QIP has been launched for a fundraise of up to 1,000 crore rupees. The indicative price range at the lower end of the band is 4,216 rupees a share, indicating close to 5% discount to yesterday's close. The equity dilution at the lower end is at close to 5.4% of the total equity. And lastly, Network Technologies, again, a QIP has been launched for a fundraise, total QIP size of up to 1,200 crore rupees. Closed a little over 25 lakh shares is expected to be issued. Indicative issue price at the lower end of the price band is at close to 4,710 rupees a share, implying a little less than 10% discount to yesterday's close. Expect a mild red in all of these names at the open, but especially Paytm could expect a rebound, especially if it happens in the block window.
Got it. Thanks a lot for that, Vivek. Well, let's hop across to Sudarshan. He's here to tell us about a newly listed company that reported their numbers, Indomim. Hey, sir, morning.
Morning, Nigel. So first quarter earnings by Indomim after the strong listing that company had said. It's operationally very strong quarter. It's looking like company has seen margin improvement both on a sequential basis as well as YY. And sequentially, just if you take a look at revenue, it has grown in double digits, up almost 16%. But YY revenue was up 9%. EBITDA has jumped by 25%. And margin, unlike other companies, this company has seen margin improvement both sequentially and YY. And margin has come at 33.4% versus 29.4% in the same quarter last year. But keep in mind, stock has seen a huge run. Issue price was 485, had listed at a premium of 44%. Now from issue price, the stock is up almost 80%. But on the basis of earnings, I'm going with green.
It's been a stellar run, but earnings are solid. So we'll see how this one responds. So thank you very much for that. Oberoi Realty next in focus. Sonal is here with details. Sonal, morning.
Good morning, Prashant. There is some relief coming in from Oberoi Realty. Remember, they launched their first ever NCR project back in June, and they had made good sales there. But there was a Haryana order from second week of July, which did not allow Oberoi Realty to go ahead with phase 2. Now, the DTCP, which is Department of Town and Country Planning, Haryana, has upheld Oberoi Realty's developer rights, and it has rejected the complaint which was seeking removal of Oberoi Realty as one of the developer, and change of developer is ruled in favor of Oberoi Realty. High Court also removed all the restriction on further allotments of the remaining phase and the remaining units as well. And a company says existing sales and operations will remain unaffected, the 8,600 crore sales that they'd made earlier, and also it will have no adverse impact on their financials. Now, do remember back in June, they had made sales of around 8,100 crore rupees. The total project value was 16,000 crore rupees. So that 8,000 crore rupees was at risk, but now that risk is removed, and that's why some relief is expected on Oberoi Realty. The stock was higher in trade yesterday, could continue today as well.
Got it. All right. Thanks a lot for that, Sonal. Well, hopping across to Ria. She's here to tell us about some stocks that are on the news. Hey, Ria.
Hi, good morning. Let's focus on Manipal Health first. The company will be buying Kinder Women's Hospital and Fertility Center for 130 crore rupees. And through this, they will be acquiring the entire business operations and assets of Kinder Hospital. Now, in FY26, the hospital had a revenue of nearly 21 crore rupees. And the current capacity is 100 beds. And this acquisition will be completed in 90 days. So, Manipal Health expected to be in focus on the back of that. There's also Sigma Advanced Systems that will be in focus, as the consortium with Indrajal has has won an order worth 145 crore rupees and a separate order for 10 crore rupees as well, through which they will be establishing anti-drone patrolling of border and urban areas. And lastly, IIFL Finance also in focus today on the back of a rating upgrade. Fitch has upgraded the company to its long-term rating to a BB minus from their earlier B plus rating, and the outlook for this remains stable. So all of these stocks expected to open in the green today.
Thank you very much for that. Now let's go across to Vivek for more stocks in the news.
Well, a couple of more stocks in the news. GMR Airports is one. Remember the company that had earlier won the contract to go ahead and operate the Bhogapuram Airport in Visakhapatnam in Andhra Pradesh. Yesterday has commenced operations. This particular airport has a capacity initially of 6 million passengers that they can handle annually. Remember, this adds to the company's current passenger handling capacity of a little over 150 million passengers. The other stock on the radar is Seagull, a setback coming in for this particular name. Public Works Department Delhi has gone ahead and cancelled the L1 bidder status or the lowest bidder status of the company in select projects. The company was the lowest bidder with a bid of over 330 crore in select road projects in South Zone in the Public Works Department. So this particular order cancellation comes in as a setback.
Thank you very much for that. And Vinny now joins in to tell us about Colgate's conference call takeaways. Vinny, what stood out?
Hi, so yes, there was an investor day that was held yesterday by Colgate. Now, mainly the highlights that are coming in here, they're focusing more on growth versus profitability. So you will see some trade-off coming in for the margins because they want to focus on premiumization as well as increasing the consumption trends. So that's the key highlight that's coming here. Now, in terms of details, the ad spends in Q1 FY27 was around 16% of their sales. They want to furthermore keep on increasing that and putting more money into the premiumization categories. 3 categories that they will be focusing on in terms of premiumization on the brands will be Colgate Total, Colgate Visible White Purple, as well as Colgate Perio Grade, which they'll be focusing on. Apart from that, the company's also spoken about premiumization becoming their core engine from here on as well. So yes, margins will be a bit of a trade-off in the near term, but growth is what they're going to be focusing on. Premiumization is what they're going to be focusing on. And the strategy continues to be increasing and more focus on the tier 2, tier 3 cities as well, and increasing their base in that city as well. So apart from that, they've also announced Palmolive's underperformance that has been there. Now, because of that, they've announced a strategic partnership with the Bombay Shaving Company, mainly for e-commerce as well as D2C side only, and globally also the global portfolio which is there for Colgate in the B2C category, BPC categories, I beg your pardon. That is also something that they will be focusing on. This is confirmed from the Colgate parent company as well as the India team. So maybe we could be seeing some brands coming in there as well.
Okay, all right. And they're also talking about lifting, the total number of population that are brushing twice a day from around 24% higher. While in rural India, the current toothbrush penetration has moved to around 55% from around 45%. Thanks, Vinny, for giving us all those takeaways from that meet. Well, let's run you through do a quick recap of all the stocks we just focused on, the ones with positive news flow: Indomim, Oberoi Realty, Manipal Health, Sigma Advanced Systems, and GMR Airports. While stocks with negative news flow: Paytm, NetWeb, SPR Auto Technologies, as well as Seagull. The one that could react mixed is Colgate. That's about all the equity market action. For the time being, though, let's turn our attention to the commodity markets. And Manisha Gupta joins us to help us out with exactly that. Hey, Manisha, good morning.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we're looking at prices now trading above $91 a barrel. There has been a strong gain in the overnight market. Well, this is after U.S. says that they are not interested in extending interim truce with Iran that was agreed upon in the month of June. You also are witnessing renewed fighting in Lebanon. The vessel attacks on Strait of Hormuz are disrupting shipping therein. And the U.S. heating oil prices also are now trading at an April high. So almost everywhere that you see under the energy category is trading in the positive. But the base metals and the precious metal prices also have been on the higher side. This is after the dollar index is trading at a 3-month lows. The soft U.S. economic data has cut the Fed tightening expectations. And then it also is about renewed Middle East tensions that have led to some safe haven, tangible commodity buying. So gold and silver trading in the positive. Copper prices gained quite strongly on tightening global supplies. We also are looking at markets looking forward to Fed meeting minutes that comes in on Wednesday, and the Jackson Hole Symposium and the Fed chair testimony therein comes in the last week of August. So these are the two things that the street will now take cues from.
Thank you very much for that. That's the commodity and the economic triggers to watch, which will move equities and commodities. Get into a break. On the other side, we'll connect with Mayuresh Joshi of MarketSmith India for some fundamental stock talk.
Okay, welcome back. The GIFT Nifty should come up on your screen. Take a quick look at what's happening. And, I think still about 95 odd points lower at this point, 90 points lower. So 24,300 around on the GIFT Nifty. Now, the government has cleared 31 approvals worth over 7,800 crores under the Electronics Component Manufacturing Scheme. My colleague Ashmit filed this report on the contours of how this will work. So let's just go across to him. Ashmit, take it away.
Well, the government granting the latest tranche of approvals as far as the ECMS or the Electronic Component Manufacturing Scheme is concerned. In the latest tranche of approvals, as many as 31 projects have been approved with a cumulative investment of over 7,800 crore rupees. And among the projects that have been approved, well, there are listed entities as well. There's a subsidiary of the Wipro group that has received an approval for investments of over 1,400 crore rupees. There's a subsidiary of the Minda Corp that has secured an approval. There's Sirma SGS, there's Centum Electronics, as well as PCBL Chemicals getting approval for one of their projects. Now, what's important is that the message from the government is that we far exceeded expectations. Ashwini Vaishnav was here speaking at the ECMS event, where he clearly pointed out that the initial target was having cumulative investments of about 60,000 crore rupees with total production of about 4.5 lakh crore rupees. Today, he said that they've exceeded those targets. The cumulative investment now stands at about 70,000 crore rupees with total production of nearly 5.5 lakh crore rupees. These are numbers that Ashwini Vaishnav said will not do justice to the ECMS story. He went on to press the private sector that there are 3 to 4 key areas that the private sector needs to work on. Appeal being made for ensuring that local designing is happening here within the country, local supply chains, ensuring a focus on quality as well as talent development. 4 key thrust areas being identified by the government for the private sector.
Thanks a lot for that, Ashmit. But let's hop across to Hormuz. He's here with the big movers yesterday. Hey, Hormuz, good morning.
Morning, Nigel. And yet another day yesterday where the participation in the cash was not as significant as it was last Thursday. But today things might change because it is the weekly expiry. Yet another day where the turnover was less than 1,000 crore as well. Take a look at the top 5 names as well. The highest turnover too for HDFC Bank was less than 50 crore in yesterday's trading session. Bharti Airtel ended below its reference price, a turnover of 40 crore. ICICI Bank around about its reference price as well, same turnover of around 40 crore. Big divergence was seen in Mahindra and Mahindra, though the reference price was above 3,400. The closing price was 3,390 in yesterday's trade. But again, participation being scarce for around about 22 crore itself. You go beyond cash, of course, there were plenty of other stock-specific movers. Hindustan Copper was one such name. The stock was up 8% in yesterday's session. Well over close to 3 crore shares were traded yesterday on Hindustan Copper. The 20-day average was around about 85 lakh shares, and a third of those were marked for delivery. So around about 92 lakh shares on the delivery front, the 20-day average of around 26 lakh shares as well. Ipca Labs was a strong management commentary reaction during the earnings call. They ended 9% higher. 70 lakh shares were traded on Ipca Labs. The 20-day average is only 2.8 lakh shares, and 20% of those were marked for delivery. So 13.5 lakh shares on the delivery front. The 20-day average here is only 1.2 lakh shares. And lastly, on the downside, Zaggle ended in a 20% circuit, a lower circuit at that in yesterday's session. 1.2 crore shares were traded, and the 20-day average is only 5.5 lakh shares. And even then, 40% of those shares for delivery, 50 lakh shares on the delivery front, the 20-day average less than 3 lakh.
Thank you very much for that. In fact, let me ask Mayuresh Joshi, who's now joining in on Zaggle. Very, very disappointing, Mayuresh and Zaggle. I don't know if you've had a look at the stock and the numbers. Stock closed at 160, below the IPO price. All-time high level was 591, which means a 70% drop from its record levels. And the complaint that we got from market experts we spoke to yesterday is that the company, in a way, should have guided or communicated that this is going to be a weak quarter. Acquisition costs will weigh on the company's profitability. It came as a bit of a surprise. What is your view of Zaggle and what's transpired, and where does it go from this level of 160?
Morning, Rima. No, two things. One, I think in terms of what the market expectations were and what the delivery was as far as earnings was concerned, it was not at all anticipated. And the markets, as we all know, do not like surprises, and therefore the reaction that you've probably seen on the stock. Obviously, I think the expectations in terms of how these synergies will play out over a longer period of time, and the core business expected to continue on a steady state basis will happen. But I think it's now going to take some time, as the management has probably put forth. And therefore, the markets will now reset the expectations that they probably got. The expectations largely were runaway growth that is expected to happen over the next few quarters, which clearly gets muted down to a large extent exit 27. And therefore, I think how the company performs, specifically in the second half, when it probably comes to all these facts and figures put together, is going to be extremely critical. However, I think in terms of the reaction, our own sense is that it might go through a very, very long phase of consolidation.
Right. Hi, Mayuresh. Good to see you, Ben. Mayuresh, what do you make of Manipal? The issue price was a little south of 600 rupees. There were question marks with regard to the kind of money that they were looking to raise, the demand out there as well. And the grey market premium wasn't too much. But post-listing, in fact, the stock has done quite well. And now there is some inorganic growth. They are buying Kinder Women's, a hospital and fertility center for around 130 crores. What's your view on the stock? There was an argument that it wasn't cheap, but a stock that wasn't cheap actually has rallied post its IPO.
Morning, Nigel. Yes, and I think it's remaining expensive in that sense. Having said that, I think the kind of numbers that Manipal has probably posted so far, I think has been very, very encouraging. But I think if you probably look at a large part of the peer group itself, I think the numbers have been very, very steady state. Apollo Hospitals reported a very decent set of numbers, in my opinion. Max had a very steady show. Again, I think one of the outliers within the space has been Yatharth Hospitals, which has probably delivered very strong returns so far. And therefore, for Manipal in particular, that you ask, I think the expectations in terms of the matured hospitals actually doing well, and the growth that they're probably embedding into in terms of core parameters over the next few quarters. I think it's a very calibrated growth that they're probably penciling in. And therefore, I think numbers should hold up. However, I think the strong underpinning that remains as a key risk factor for the sector is going to be the new norms that the government has probably put through in terms of caps. How does that play out in terms of the entire revenue growth? I think there have been a lot of pro and con arguments against how that white paper has probably circulated and how does it hit hospital profitability going forward if it is implemented in the way that it is envisaged right now. I think that might have a say in terms of forward-looking numbers as well. So I think decent set so far, the entire hospital pack has delivered, but the underpinning and the biggest risk factor is going to be if the white paper is implemented, there is a risk in terms of the upsides, in terms of profitability.
You know, in a bit from now, Mayuresh, we had a hospitals town hall yesterday, and we had all the top hospital companies with us. Sorry, do we have it? Okay, I think we have it. So right on cue, Mayuresh, right? I mean, at the hospital's sort of town hall yesterday, we had the 4 top hospital companies. We had Max, we had Fortis, we had Narayana Health, we also had Jupiter, which is more Mumbai-centric. And we want to play out some sound bites out of this, and you may want to listen in to this. So the first talking point, of course, I mean, front and center was the parliamentary panel recommendations prescribing lower cost via capping of room tariffs and a lot more. Here is a view from these CEOs and founders of these hospital companies and chains.
This report is worrisome, and it is worrisome because of the kind of thought which has gone in it. I think it is probably based more on anecdotal instances on which the report has been made. So there are a lot of dichotomies in the report. One side, we are saying that India is a destination for medical tourism and we should promote it. Why? Because we are very economically, we are providing the best quality services. On the other side, we are saying that the healthcare is very expensive. I think we are confusing the two issues of affordability and the the actual real cost of delivering healthcare. So I think the report needs to be evaluated a little more in detail. And there are certain elements of it which probably are implementable, and there are certain elements which are not. But the parliamentary report is only a suggestive report, and the policy decision, of course, has to be taken by the government. I believe that they will be a little more rational, and they would do wider consultation with the industry before they decide on what to do.
I think the profitability of, if you look at every listed player, my argument would be that the largest players and those profitable ones are the listed ones, and their financials are a lot more transparent. So the median sort of profit after tax is about 8%. And I think it varies anything from 4 to 13%. And whilst I agree with Ekta about the EBITDA numbers and the revenue numbers increasing, keep in mind that this is not a services sector alone. This is a bricks and mortar business. So profit after tax, because we have real depreciation, the buildings depreciate, the equipment is there for about 10 years, that depreciates. So profit after tax is the right sort of indicator. And 8% median profit after tax, or an outlier being at 13%, is not really egregious. And it is not really out of the park from that standpoint. And if you do less than that, I think it is going to stifle investment into the sector. And, you're going to have issues as far as capital investment is concerned. Now, if you look at the costs, I think costs are a function of inflation, both on the variable side as well as the fixed side. And we have to solve for the person who's going to put up that hospital next, okay, because that is so required. As the baby boomer population in India, which is average age is 29, it shifts to 43, which is the European age over the next 15 years. I think, we need to have about 10 times the number of beds.
And if we are not going to be providing a basic risk-free return, okay, to any investor today.
Abhay, on that point, and I think what you said, some of the other metrics is net profit, you say, is the correct one. But look at return on capital employed, for example. I mean, 22, 23, 24% on mature assets. I mean, that's a pretty healthy return, right?
So you're absolutely right. But, please look at it in context.
I'm not leaning this way or that way. I'm just pushing back against that net.
I completely agree with you and understand. But keep in mind, if you're going to look at the return on capital employed of a hospital which was put up 30 years ago or 20 years ago is going to be very different from what is being set up today. A hospital which is being set up today takes into account the current prices of land, the current cost of construction, and so on. It takes you about 4 years to construct. And yes, 20 years later, that particular hospital may give you a 20% ROCE. But the fact is, at present, and if you actually see, everybody's return on capital have come down by 40 to 50%. Because people are expanding, because people are sort of moving up, on the capex cycle. So you have to solve for whatever is being set up today, not what has been set up. And look, price is always formed by the marginal player, is by the people who are setting up hospitals today.
Cap the room rates. It does not address the core problem that the government wants, which is healthcare is unaffordable for a vast majority of people. That is because people are paying out of pocket, which is not sustainable for a country of our size. We have to start looking at different methods of payment, such as insurance or employers paying for healthcare. The report specifically points out that the bottom of the pyramid is covered by government schemes, and they are not really concerned about that anymore. The top of the pyramid is taken care of by the insurance schemes because they can afford to buy them. Some of the government employees are taken care by CGHS, but it's the missing middle who pay out of pocket, as Viren just pointed out, who need support. And the report specifically outlines how health insurance must step up and become more affordable and widen the base for these missing middle population. So I think this is a definite positive from the report, which helps.
That is the portion as far as the parliamentary panel recommendations are concerned. And I mean, of course, hospital companies and hospital CEOs pushing back and kind of sort of explaining this with what they think should be done. Some, of course, part in some way of the recommendations, others, of course, not there. Viren Shetty of Narayana Health addressed the expansion in hospital bed capacity needed and why capping room tariffs was going to hurt that capacity addition ambition. Remember, over the next 5 years, just from the private listed players, that is, some 30,000 plus rooms are coming up. 30,000 plus beds are coming up. That's the capacity addition cycle we're looking at. Listen in.
If hospitals didn't make any money, we won't be able to build more hospitals or hire doctors or keep in business. Now, given a choice, every single hospital would expand 10 times its size. But it is constrained by geography, constrained by its borrowing ability. And so the entire sector goes through these ebbs and flows. There was a time you mentioned where there was a crunch in capacity, and so everyone added and took investment and expanded. And then people start asking, where's the return on this money? And then everyone stopped and waited for it. We're in this phase where, as India, which is the fastest growing country in the world, and as Abhay and everyone else has noticed that there is a tremendous need for healthcare, there's requirement in all the cities. The tier 2, tier 3 towns have a tremendous requirement. Now, whether or not it is profitable to do so is tomorrow's question. The ones who are making the investment do it based on the opportunity that they see.
Okay, well, sticking with the capacity addition point, from a shareholder point of view, many believe that the industry, that is the hospital sector, the listed hospital universe, it may be underbuilding for the long term because, I mean, we need many more beds, but is it overbuilding in the short run? And is that going to affect shareholder returns, return ratios, etc.? This is Abhay Soi of Max and Ashutosh Raghuvanshi of Fortis, addressing this. Listen in.
The larger micro markets of metros, as Ankit pointed out, are very complex and different in nature, and there are opportunities within these markets. So it is natural for most of the groups who have adjacencies, who have a presence and brand value established in these markets, they will focus on those markets first. But lot of groups are extending themselves into other markets as well. And there are many cities which earlier were considered tier 2, tier 3, where you would see that a lot of infrastructure started coming up. I mean, if I can say, Abhay himself is going in Lucknow, Bhubaneswar, and many other markets, and so are we. So I think a lot of that capacity will come in tier 2, tier 3 cities, but 30,000 beds is not going to be enough.
Okay. What about
if I can just add, today's oversupply is tomorrow's very well thought out decision because they plan for the future.
No, I want to be absolutely clear. I'd be accused of, wanting lesser hospital. I mean, of course, I'm more than welcome. But that question was simply from a perspective of, shareholders are not.
So I just want to add to what the debate. If you look at the Delhi NCR market, and interestingly, that's supposed to be a market where you had the maximum amount of supply of quality beds in India, right? But if you actually see the number of tertiary care beds in the private sector in Delhi NCR is about 11 to 12,000 total beds, right? Again, I'm going to compare it to the UK. The population of National Capital Region, NCR, is 85% of UK's population. And like I said, it's 200,000 beds, the 12,000 beds. Okay, I don't see the 12,000, even if you add your entire 30,000, which you're adding across India, to Delhi NCR in the next 5 years. Okay, and by that virtue, you get to 100,000 in the next 15 years. You're still half of UK's supply at that point in time, even if you take a lower amount of affordability.
Okay, well, that is just a slice of the conversation with the top hospital CEOs we had at the town hall yesterday at the market forum, focused on the hospital sector. Lots of news flow, lots of action, and I think it's an area of high investor interest. I mean, it's a structural growth story, but we are getting into a high capex phase. We'll take a quick commercial break here. We come back, continue our conversation with Mayuresh Joshi. We'll also have our technicals in place, Sudarshan Sukhani and Midesh Thakkar, for that in just a bit. Okay, well, Mayuresh Joshi is still with us, and we are in conversation with him as far as markets are concerned. Mayuresh, we got the hospital's view from you. If you want to add anything post that conversation, some of the sound bites from the hospital CEOs, do add if you want to. Otherwise, talk to us a little bit about the other stories, right? I don't know if you've looked at the Paytm transaction, which is afoot. The Chinese entity is going to be completely out of Paytm post the block. I mean, if you want to talk about that or anything else on your mind.
So, Prashant, I think, again, I think the entire FDR story that is expected to play out is obviously creating a huge impact in terms of all these fintech aggregators. And Paytm has done well. So I think anybody holding Paytm should hold the stock. But in our opinion, I think the broader universe, as far as this earnings season was concerned, has delivered some stellar set of numbers. Mid caps in terms of profitable growth, leaving aside oil marketing companies in excess of 25%, small caps in excess of 30%. And therefore, I think a Durandara dialogue that probably comes through as far as the broader market universe is concerned. Hosla rakho, Indan bharo or badla lo. That's what I think the mid and small cap universe has done. Two stocks that probably come out on the radar. One, I think Usha Martin is something that is still an actionable idea as far as markets with India is concerned. Outstanding set of numbers in terms of the wire rope volumes. The steel prices volatility has been well taken care of, and the reported EBITDA per ton that Usha Martin reported was one of the highest in this quarter. And to top that up, I think the cash balance has actually gone up around 475 crores, from 330 crores a quarter back. So I think they are probably throwing out a lot of cash as we speak. The volumes expected to hold out, with Europe contributing 27%, 15% from the Middle East, expected to probably boost the overall operating leverage. The other area, I think, is obviously the power ancillary space, and Skipper out of that is something which is an actionable at markets with India as far as ratings and rankings are concerned. Very strong order book. They've delivered a very strong top line. EBITDA margins have remained very, very resilient. Power Grid expected to up their capex. The expectations in terms of transmission lines, transformers, expected to go multifold as we speak. And again, they're in the right areas as far as the HVDC segment is concerned, catering to not just the infrastructure segment, but they've also got a very small polymer segment as well, where margins are expected to probably inch a tiny bit higher. So I think the everything's holding up for the broader market. I think these couple of stocks remain actionable at markets.
All right, got that. Thanks a lot, Mayuresh, for giving us those ideas. Usha Martin, Skipper as well. By the way, Paytm's large trade has got done in the block window. That could probably be now the stock of the day, because the anticipation was it wouldn't happen in the block window. But since it's got cleared out, now some of those shots will have to scamper for cover. Yesterday, intraday, you saw a sharp dip with the shots, getting loaded in there. So we'll keep an eye out on that name for today's trading session, though. Slip into a short break, come back. We'll also be joined by Gaurav Malhotra of Axis Capital. We'll be focusing on the telecom space. Welcome back. Well, as promised, we have Sudarshan Sukhani as well as Mitesh Thakur who join us on the show. Hi, gentlemen. Good morning. Good to see you all in. Well, yesterday, that 3:15 to 3:30 session, which is the cash session, that went in favor of the bears for the first time ever. Normally, we were getting used to, at 3:30, you're seeing the Nifty move actually higher in comparison to 3:15. But that didn't take place yesterday. And this morning, we have to contend with Brent crude prices as well spiking up. Given both these two cues, how would you approach the Nifty today? Sudarshan, you go first.
Well, cash is not working, at least not yet. What we have to do is to keep in mind the fact that the Nifty was above 24,200 yesterday. That was a dip, that was a buying opportunity, at least intraday. That level is sacrosanct. If the Nifty drifts below it, close all long positions and do nothing.
Got it. All right. Do nothing is the call on the Nifty. What about you, Mitesh? Would you like to do something?
Nigel, Nifty was slowly sliding down and time and again was bouncing back from this 24,200, 250 zone, and I think it will open below that. The only thing which, will probably warrant an action is that in case the Nifty, after the gap down opening, tries to bounce back again and recaptures 24,200, 250 zone, and then, we might be looking at possibly a false breakdown on the downside and then some kind of an upside move. It's also slightly oversold on the hourly to hourly charts, given the fact that we've been continuously declining for about 9 to 10 sessions. So that's the only, contingency plan which I have in mind. But for the timing, if it closes below 24,200, then I think maybe I'll avoid the Nifty for some time.
What about stocks, Mitesh? And good morning, both Sudarshan and Mitesh. Let's talk about individual names.
Yeah. You want me to go first?
Yes, go ahead, Mitesh.
Sure. So I think the idea is that on the stock side, I have a mix of buys and sells. On the buying side is L&T with a stop at about 4045. I would want to see some strength. So if it starts getting past yesterday's high, say let's keep a trigger of 4100. Buy above that with a stop at 4045 for a target of 4220. And also a buy on Jindal Steel on a mild decline, say around 1110, 1105. Buy with a stop at 1088 for targets of 1145.50. A sell on Sun Pharma for targets of around 1830 and a stop at 1905. And a sell on Gas Authority with a stop at 174.5 for a target of 166.
Sudarshan, hi. Good morning. What stocks are you recommending?
Good morning. It's been a very difficult period the last 6 months, hasn't it? Now, I'll tell you the stocks. Prestige is a buy with a top under 1560. Petronet is a buy with a stop under 275. Infosys is a sell with a stop above 1160. And RBL Bank is a sell with a stop above 390. So it's a mix.
Okay, all right. Any view on Polycap? The stock has been moving up gradually, but there's always that supply overhang, since the street was expecting that. Stock has been a big outperformer, but at around 9,300, what's the view, Sudarshan?
My view is you step aside. If you have it, take profits, wait for a significant correction, which should occur. Then it becomes a buying opportunity. That would be somewhere around 75.
Okay. Ooh, that bigger correction is what you're expecting. Got it.
Okay, gentlemen, we'll come back to you for more 9-10 calls. In the meanwhile, let me just quickly get you up to speed with the latest on the telecom. Now, Reliance Jio has relaunched Jio Prime, which basically marks 10 years of Jio. Now, what they offer is you pay us a one-time fee of 300 rupees. In return, there are two benefits. One is 600 rupees of cashback voucher spread over two. So you can use it for Jio products, Jio Home, Jio PC, Jio SIM. But the second one, and this is a bigger one, tariff hike protection. Basically, a one-year price lock-in guarantee. It's valid from 5th September 2027. So basically, it's going to shield you, any subscriber, from a tariff hike which takes place in that window. So this is the big announcement, a tariff hike protection for a period of 1 year. So the big takeaway is that, is this signaling a tariff hike is coming for the industry? Because logically, if you have to justify the 300 rupee upfront fee, the only way it can pay off for a subscriber is if the company is planning to do a tariff hike, and it has to happen within the protection period. So by paying, by telling subscribers that you pay me 300 rupees, I will give you a 12-month price lock-in, is the company signaling in a way that a tariff or price hike is coming. But remember, generally, if you see the subscriber psyche, you are wary of upfront payments without knowing what the actual savings is going to be. And that savings will depend on, one, when the tariff hike takes place and how big it is, the timing and quantum. Generally, people are saying that, the tariff hike will happen after the IPO. Suppose the IPO happens around Diwali, maybe a little before that. So it's going to happen. So it won't happen in the next 1 or 2 months. But very simply, the base case, maybe a more negative, pessimistic scenario is that a hike takes place in December and it's only a 10% hike. Then actually it would be a loss for the subscriber on that cheap 299 rupee plans, because you are going to get only 9 months of savings of 10%. That's the tariff hike on 300 rupees. But of course, if you are a higher priced plan, it will be a saving. The question is how many Jio subscribers will avail of this. But now here's how Jio now compares with Bharti Airtel. Now last week, Bharti discontinued the 299 plan. So subscribers only have an option of 349 rupees. Indirectly, Bharti took a 16% tariff hike for the popular prepaid tariff hike. But Jio still has the 299 plan. Now for a Jio Prime subscriber, the effective price, because you've paid 300 rupees, goes up to 324, an increase of 25 rupees, and that is locked in for 12 months. So net, Jio is still cheaper than Bharti. Bharti's cheapest will be 349, but there is a potential for a further tariff increase. For Jio, you have to pay 324 rupees for that similar plan, and there is no tariff hike coming through. So that's how the two compare with each other. Gaurav Malhotra, Executive Director at Axis Capital, is now joining in. Gaurav, thank you very much for joining in. How should we read this announcement by Jio Prime? Does it make sense, and what are the implications?
Yeah, hi, good morning, everyone. See, the way to think about it is that, look, we have been waiting for some sort of a tariff hike now for more than around 6-7 months. Our base case expectation is that a tariff hike of 10 to 12% is likely to happen anytime in the next 3-6 months now. One way of thinking about it is that this obviously gives you some indication of there is a potential for hike, which is obviously built into numbers of all the operators. But should we call this a hike? Maybe not, because a hike is that, everyone moves up, right? In terms of whatever they were paying yesterday, they are paying more today. This is an optionality given to the subscriber, which the subscriber may or may not choose to avail of. Net, we like I said, we are even whatever between what Bharti has done, what Jio has done, we do expect that there will be still a base hike, a more broad base hike of 10-12% in the next, say, maybe 6 months period from here on.
But then, Gaurav, as I was pointing out with the maths, if you just do a 10-12% tariff hike and it happens in the next 6 months, even if it happens in the next 3-4 months around December, it doesn't make sense for a 299 rupee subscriber, because he will be effectively saving. He's paying 300 rupees, so that is gone. But he's going to get savings only for 9 months, and that also by an offset of 10% on his plan of 299. That's 30 rupees into 9 months. That's 270. So does that mean, perhaps we are in for a much larger tariff hike, maybe 15, maybe 20%, 10, 12 may not be what the street should expect?
See, okay, you can do lots of permutation combinations on this. Our base case, the reason why we say 10-12% hike is that, obviously the operators have taken 2-3 hikes, reasonable hikes in the last, since 2019. And progressively, the transmission of those tariffs into the ARPU and revenue of operators has substantially moved up. So, for example, for Bharti, the transmission was almost 100%. That means the tariffs went up by 15-16%, and the ARPU also sort of went up by 15-16% with no major subscriber loss also. So, end of the day, operators care about how much ARPU is increasing. So in the first hike, the hike was 30%. Bharti's ARPU went up by 15%. In the last hike, the hike itself was 15%, and the ARPU went up by 15%. So I don't think so. One has to look at a very substantial hike to see a meaningful improvement in the ARPU of operators. And hence, we are still sticking to a 10-12% overall tariff increase generally across the operators.
And the timing, when should we expect it?
Like I said, in the next 6 months, we should expect it. It's kind of, we were actually expecting it in the first half of this calendar. That obviously has been pushed out. There have been some tariff interventions taken by Bharti just last week. So now maybe the expectation is that it'll take at least another, say, 3-6 months before we see a more broad-based hike. Because whatever, for example, Bharti has done last week, itself will take a couple of, at least more than a quarter for it to fully flow through. So that's the way to think about it from a 6 months perspective.
Okay. And for Jio, is there going to be a change in your ARPU or subscriber addition, estimates based on this development?
So we are restricted, so we can't talk. But all I can say is that for all operators, the estimates do assume a certain amount of tariff hike, on a compounded basis over the next 3-4 years.
Are things turning around for Vodafone Idea? They reported their first positively quarterly subscriber addition. The promoters infused some money, that is confidence capital. Incrementally, are things turning around? And what is Vodafone Idea going to do in response to Bharti Airtel discontinuing, in a way, that entry-level plan?
So see, the wheels are slightly turning for Vodafone Idea, right? From at least from an operational perspective, we are seeing subscriber increase for the first time since the merger. We are seeing data consumption per user also moving up as the company has started to invest into the 4G network. So on the whole, it's on the right path, but obviously it's a long road, given the gap which it has versus the other operators. So we'll see. I think so. They do require that debt raise to meaningfully improve their network. I think so. Between all the things which we have seen, whether it is AGR, whether it's promoter infusion, whether it is this indicative hike, or elimination of the lower tariff offering which Bharti has done, all gives more confidence. So the likelihood of a debt increase is higher than what it was earlier. Now, whether Voda will follow Bharti, see, typically Vodafone has followed Bharti. This time, the situation is a little bit trickier because, the company obviously does not want to rock the boat, at least when it comes to subscriber additions. I think so eventually they will take up a hike. That's obviously, the hike obviously will have a much more substantial benefit on the revenue than subscriber addition. But I think so they could be a little bit more calibrated in terms of how much they take, when they take, kind of things.
Okay, Gaurav, we'll leave the conversation here. Going into pre-open, let's quickly get in some 9-10 calls. Sudarshan?
Petronet, buy Petronet with a stop under 275.
Petronet. Mitesh?
I'll go with the sell on Sun Pharma.
Sell on Sun Pharma. Sudarshan is now joining in for the brokerage call of the day. Sudarshan?
So we'll start with Colgate. Yesterday, company held the investor day in which the main focus area was premiumization, and also management's focus remains on growth over margin. Today, brokerages have returned. The HSBC continues to maintain hold call with a target price of 2,140 rupees per share. CLSA 2 has a hold call with a target price of 2,024 rupees per share. It says high gross margins are here to stay, and it has raised growth and gross margin estimates, but has lowered FY 27-28 EPS estimates on higher advertising spend. Now, Jefferies, it has a buy call with a target price of 2,650 rupees per share. HSBC has written note on AC companies and upgraded Blue Star to buy, and target price here is 1,780 rupees per share. It says room AC industry grew 25% Q1 FY 27 with estimated volume growth in the range of 20 to 22%. And once you look at the sales from Jan to June, Blue Star had stable margin despite slow growth on a high base. Upgrade Blue Star on the reasons: first, strong order book, it's a data center play, and third, there is scope for margin expansion, and the company continues to have a focus on core business. And as far as the valuation is concerned, it finds favorable. Last one is Milky Mist Dairy is going to be listed today, and DAM Capital has initiated coverage with a buy call, and target price here is 175 rupees per share. It says it's running an essentially 100% VADP portfolio across 20 plus categories, and FY 24-26 revenue CAGR was 31%, which is the best amongst all the peers.
So Milky Mist has no milk, right? It's all value, you said value added, paneer and other products, etc. But no liquid milk in that sense.
No.
Thank you very much. So that is Milky Mist, the new listing. Lots of interest around there. Valuations, though, of course. What a change we've seen. 10, 15 years back, if you look at some of these milk companies, which were still listed even then, but of course, it's completely different now, completely changed, and has happened over the last decade or so. That a business like that, is essentially getting top-tier consumer kind of valuations. We'll just look at where markets are opening, 24,230. It's about 0.25% lower. We've got the Nifty Bank, which is absolutely flat. The Sensex is down about 1/3%. And you've got the small cap index, which is absolutely flat, 19,800 on the small cap index at this point. So this is the picture. 900 up, 800 lower. I think it's still early with the market breadth, so maybe just a couple of minutes more. Nifty 50 heat map should give you a quick sense of how we are starting across the board. We've got Nestle, which is starting the strongest, Sun, Bajaj Auto, ONGC. So only about 15, 16 names in the green. The rest are, some are opening up and the others are lower. Anything which depends on oil. Indigo is down quite a bit. Asian Paints is down. But you also have Infosys and TCS and HCLTech, which are starting slightly negative. So about 50 points down on the Nifty with about a minute in as far as market open is concerned. Indo-Mim continues to absolutely rip higher. Up 80% before today and add another 6% to it after numbers. Rima.
Well, Bharti Airtel has also opened up with a cut of nearly 1%, perhaps linked to the Reliance Jio Prime announcement. In a way, trying to convince subscribers to pay that 300 rupee upfront and lock in the tariffs for the next 1 year. Reliance Industries will come up for you on your screen. Reliance Industries, through the whole of yesterday's trading session, was holding out with a gain of 1.5%, but sold off in the last 15 minutes on account of cash and ultimately ended with a gain of 0.5%. Today, it's opened up on the softer side. Max Healthcare is a bit subdued, so that's down for the second day in a row. IT names are a bit weak. Infosys, HCLTech have lost more than 1%, TCS down half. L&T is lower by 0.5%, and BSC got that Jefferies downgrade yesterday. Stock was weak, 3.5%, and it's followed it up with some more cuts. On the way up, ONGC deserves mention, Bajaj Auto, M&M, Maruti, and a few banking names. Banks were outperforming even yesterday. And today as well, the banking stocks have opened up in the green. Just some more mid-caps. Zaggle Prepaid is weak yet again. After a 20% lower circuit, it's opened with a cut of 3%. Physicswala, Grow, Swiggy, new age tech companies are weak in trade. But on the way up, it's Indo-Mim all the way.
Well, that's right. Grow, that's the stock actually that should come up for you on the screen. There was a block trade that was in the works, and I understand if I look at the screen, Billion Brains Grow, that is, you have close to around, if I'm not mistaken, it looks like around 6.5 crore shares that are changed at around 192 rupees. So that large trade gets out of the way. Finally, that's, that one has got absorbed, it appears so. So we'll wait for our ticker team actually to alert us on that. But that's one of the big volume buzzers today. Uflex, that one as well is bursting away. It's up close to 7% as we speak. So big up move is what you're seeing on that name. Cupid, the stock yesterday and today had fallen close to around 10% in trade. Well, this morning it's made up most of those losses, up close to around 5%, but it's been a very, very volatile counter. So keep an eye out on that name as well. And Ethos, take a look at that stock, up 8% now. I think post its numbers, the stock has rallied close to around 15%. So solid move is what you're seeing on Ethos as well, guys.
Absolutely. 3,000 bucks on Ethos, and that's a luxury watch play, and it's done very well. 50 points lower. The market's been sideways for the last 10, 11 trading sessions, tight range, lower highs, lower lows, but you had earnings to contend with, and last week was an absolute flood. Even yesterday, we were still reacting to numbers which we got post Friday. Maybe things start to quieten down a little bit after what has been an absolutely frenetic pace with regards to the earnings season and what the market's been doing. Nilesh Shah is with us, founder at Envision Capital. Nilesh, good morning. Great to have you on the program on CNBC this morning. You've been absolutely hooked on to your portfolio companies, tracking them, listening to calls, and of course, the entire 9 yards. What's really stood out to you? If you want to describe, you've been a big believer in the new age, the platform companies. You own many of them. What's really stood out for you from Q1?
Just a few things, Prashant, that basically the platform that they have created, honestly, is sustaining itself. And you can clearly see that relevance and that dominance playing out. So if I were to kind of really look at the whole basket of these digital platform companies, all of them pretty much have grown in very strong double digits. Probably some of them have grown in their 20s, 30s, 40s in terms of the growth rate on a year-on-year basis. And second is that as this growth is happening, as the scale up is happening, you're clearly seeing operating leverage play out. You're seeing margins expand. And finally, it's basically winner takes it all. It is basically that number one, number two player who clearly are asserting themselves or are showing up in terms of their performance. And the laggards remain laggards. So I think these are some of the kind of trends or the underlying threads that one is basically seen into the most recent quarterly performance for the digital platform companies.
With the disclosure, Nilesh, which new age stocks do you own, you're bullish on?
So, well, we like a bunch of them. We've been owning Eternal, we've been owning Nykaa, we've been owning Grow, Angel One, Lenskart has been a recent addition, Card Trade. These have really been the bunch, Paytm. These have really been the bunch of companies that we have been owning. And our thing is that basically just spot the leader, look at the opportunity. The opportunity is still kind of underpenetrated, spot the leader, and then ride the leader. That's essentially been our philosophy.
And you're comfortable with the fact that, say, a Lenskart, which you added recently, is very expensive. And there are ups and downs in companies like an Eternal or even a Lenskart, or some of them are loss-making. So you're comfortable and you're willing to buy in at the current price?
Well, most of the companies are no longer now loss-making. Yes, they may not be generating free. Some of them may not be generating free cash because they're reinvesting back into the business. But I think most of these companies have turned profitable over the last few quarters as they have executed well and as they have scaled up. And then when you look at them more from a 3 to 5 year perspective, clearly I think the valuations then don't look as expensive because clearly the future growth is not yet fully priced in as yet. And as these companies continue to grow in high double digits, you're going to see more value getting created by these companies. It's not just the digital platform companies. There are companies which are D2C companies in the electric vehicle space. There are D2C companies in the beauty and personal care segment. So those are companies also which are essentially beyond just the plain digital platform. These are also some of the companies which have done exceptionally well. They continue to do very well and they continue to, I think, still be very confident about their prospects.
Okay. All right. Hi, Nilesh. Good to see you. And as always, Nilesh, from the earnings season, which was that stock, a couple of stocks, if you could tell us, where really turned the corner, things are looking up and valuations are pretty okay. One of the standout performers in this earnings season, because the talk is that this earnings season is very, very good. So it'll be interesting to know what's that, those couple of stocks that you're actually betting on.
So, well, it still continues to be a range of stocks. But I clearly think one thing, I think Eternal clearly demonstrated that the Blinkit business, that the break even that they had achieved in the last financial year in one of the quarters, probably it was Q3 or Q4 of last financial year, was not a one-off. And despite all the competitive pressures that they faced from all the other players in the e-commerce space, in the e-commerce segment, they continue to essentially kind of improve and do better, especially on the margin front. So to that extent, I think that was something which was expected that they would face a lot of margin pressures, especially with oil prices going up, restaurants being shut. So the Zomato business would also be under pressure. But I think both on Zomato and Blinkit, they have demonstrated that they continue to execute very well. So to me, that was, and especially on that size and that scale, to kind of continue to demonstrate and execute well, I think is something worth writing home about.
Okay, got it. Nilesh, what are you making of this supply of paper as well? Every time the markets get into a good rhythm, whether it's QIPs, IPOs come back on the table, and we're only getting started, right? In the last few days, we've seen a lot of supply, and probably that's likely to continue, say, till the next earnings season. How big a headwind is this? Because liquidity is getting, sucked out big time. Out of nowhere, you had LIC coming and taking 30,000 crores. That's a large number.
Yes, Nigel, I think this continues to be a key worry. Clearly, the supply of paper, it's not just basically the IPO stable, but it's also companies which have IPO'd themselves in the last 1 year, 3 years, 5 years. There also we're continuing to see their investors, especially investors who were there in the pre-IPO stage, come in and basically wanting to offload. Thankfully, I think as long as the SIP flow continues, there's going to be liquidity to be able to absorb it. And yes, we've seen these rounds over the last few years where there are a few quarters where nothing happens with the market, IPOs or issue of fresh paper takes a backseat, then basically secondary markets perform. And that's really when the primary market basically issuances start to happen. So I think this is unfortunately a cycle that we have to continue to ride with. My own sense is that this is something which will probably take a few more months, maybe take another year or so. Hopefully, at some point of time, the FPIs will also step in and be able to absorb a lot of the fresh paper issuance which is coming about. But I think that's something which we will have to take it in our stride. And net, despite all of that, the markets have been performing reasonably fine.
By the way, out of the new listings, I know, Nilesh, if I'm not wrong, you tend to wait a little bit, right? I mean, not buy at the listing, but so many. Look at this Indomim. I remember having this detailed conversation with them. They were in the studios. Different manufacturing. I think there's a bit of a scarcity premium as well for names. For many of these names, right, is one of a kind, at least in terms of they do something called metal injection molding. So that's the manufacturing that they do. And they supply end-user industries are all booming, aerospace, defense, I mean, you name it. So yeah, I mean, anything you liked from, paper which has come to the market recently? New paper?
Well, I think most of the companies which are kind of, hitting the street with IPOs essentially are high quality companies. I mean, these are companies which have demonstrated really well. And so to that extent, it's hard to take out just one or two names, whether it's the diagnostic space, whether it's the name you just mentioned on the auto component side or the aerospace component side. I think each one of them are basically standout companies. Just that some of these companies have demonstrated strong performance in the recent quarters, just probably prior to their run up to the IPO. So you have to really kind of take a bit of a cautious view on them, and they're not cheap. I think the best strategy is that maybe 8 out of 10 or 9 out of 10 companies surely have some kind of a tepid or a weak quarter later on, or if the markets turn volatile. We've also seen sharp corrections in them. And I probably think the best thing to do is to kind of watch them closely, keep doing your homework, keep building your conviction. And then when the market gives you that opportunity a few quarters down the line, that's really the time to step in.
Fair enough. I was talking to a banker, Nilesh, who was saying that about, this is of course an approximation, about 40% of the companies now which are coming to the market are backed by private equity. So it's that large a number now. As an investor, when you look at, so new issue or you meet a management, I mean, does that make a difference? Who's selling?
Honestly, no. Prashant, because in the market, there's somebody who's at any point of time going to buy and somebody who's going to sell. These are folks who've essentially entered in these businesses maybe 5 years ago, 7 years ago. And to be fair to them, they are entitled to basically sell as well. They also need to essentially take those gains back home. But it also creates an opportunity for new set of investors to basically come in. I think ultimately what really matters, and we are long-term investors. So I think from that point of view, I think what really matters essentially is the performance of the underlying business, the balance sheet remaining strong, governance remaining strong. I think these are some of the things which matter and which finally lead to value creation. So honestly, yes, they become talking points for a day or two or a week or two. But I think beyond that, it's back to performance.
Oh, yeah, absolutely right. My only point was that when, you were a sophisticated investor, but, on the other side, the seller is also a fairly sophisticated investor. So, I mean, does that kind of... so does that make a difference at all? That was the question.
No, honestly, Prashant, no, it just doesn't make any kind of difference. I mean, we've seen many of these companies which essentially were hammered down. I mean, you look at all the digital platform companies, the D2C companies, or some of these engineering component companies. In most of these cases, we've seen selling in the past, but all of that selling gets absorbed. So from that point of view, it honestly doesn't matter beyond a point. I'd say I'd differentiate between a promoter selling and a private equity fund selling. I think private equity fund is a financial investor, so that's less of a concern. Promoters selling, they are pretty much like strategic investors, they're permanent owners. And when they sell, I think that's something which probably becomes a bigger cause of concern versus a private equity fund selling.
I see. I see. Fair enough. Got that. Just a quick word on this, the entire the payment side of it, right? I think you own Paytm still, Nilesh, right?
Yes.
This Pine, which has done well recently. The MDR thing is now becoming maybe high-value transactions. So it perhaps will become a reality. And I think we've now heard it from official sources as well. For something like Paytm has done very well. Pine maybe not so much. Actually, it's not done well since listing. Have you looked at that business carefully? I mean, what can happen? Because it's not just about the boxes, right? I mean, they do a lot of other things. So any thoughts?
So specifically with Paytm, I think we've been owning it now for maybe the last 2.5 years, and I think they have been executing really well. Honestly, incentives, MDRs, etc., they honestly don't move the needle too much. A lot is being made out of it, but ultimately it's going to be competitive forces which are going to kind of be underway, and not too sure how much real money they'll be able to make on the MDR side. I still believe that the core of that business is around the merchants and the merchants payments ecosystem that they have built over all these years. And their ability to offer different financial products to that cohort of merchants that they have, I clearly believe is really the center of the opportunity which a business like Paytm is addressing. So that remains the core. I think everything around it, I think, is probably yet peripheral, and I'm not too sure whether things like MDR or something like that are going to materially move the needle. Yes, there have been some marquee sell-side firms and analysts who have essentially kind of really pointing to what kind of a difference it will make. But honestly, I'm not too sure whether it's going to kind of mean a lot over the next few years. It's still going to be essentially distribution of different financial products and credit products to that cohort of merchants. That, I think, is essentially really the core of their business.
Paytm for today is down nearly 1%. I think they had an option to sell up to 5% via a stake sale, including the green shoe. But in the block window, only 3% seems to have been sold. So the green shoe option not exercised. Is that on account of weaker demand? But we'll wait to see. For now, Paytm is down nearly 1%. There is that supply angle. Nilesh, great chatting with you. Thank you very much for joining in.
Thank you. Thank you so much.
Let's invite the first management on the show now. It's Patanjali Foods. Sanjeev Asthana, CEO of the company, is now joining in. Sanjeev, it's been a good quarter, revenue growth of 29%. I think this is the fourth consecutive quarter when you've reported highest ever quarterly revenues. Margins have expanded on a year-on-year basis to 4.8% versus 3.7%. And that's largely been aided by an increase in the edible oil margin because the FMCG margins came under pressure. So let's begin with the margins and the way forward. For edible oils, your EBITDA margin in Q1 was 5.22%. But there was a price inflation which boosted margins. What is the sustainable margin range for the edible oil business and even for the FMCG business?
Two parts. One is that on the edible oil side, we are pretty confident that this run rate will continue. We have three businesses within the edible oils which have done exceedingly well. One is our oil palm plantation, which is less spoken about, but we did last year almost 357 crores of EBITDA on the oil palm business itself. And there, the benefit has been that consistently year on year, as we've often said, that contribution is going to continue going up year on year. That was one which is doing exceedingly well. Second one is our crush business, where we do the oil seeds crush. That has been a consistent performer. And last part is that, the broader price spike that we've seen in the edible oil space, we have done better than the rest. And our expectation is that as, all the pointers sort of point to price inflation in the coming quarters, largely on account of whatever we are seeing on El Nino or Middle East crisis, I think edible oil should continue to do very well, on the business front. And pretty much we stand with our projections that this year we should do on the better side of the 4%, perhaps even more than 4% margin. So that is very positive. We had one-off challenge on the FMCG side, where typically there was some sort of write-off had to be taken on the inventory, which was smallish, as at a quarterly level, more an accounting issue. That part has been now sorted out. So I think this quarter onwards, that should be a thing of the past. So that is how it has played out overall. And on the FMCG side as well, we've done quite well across the spectrum, barring only the foods business and within foods only the staples bit, where we had this challenge. Otherwise, the business is going pretty much, all the projections that we've done, all the guidance that we've given, I think is pretty much on course for that.
So on edible oils, 4% EBITDA margin should sustain for the full year. That is the floor. On FMCG, though, you said that there were certain one-offs. So in Q1, EBITDA margins were close to, I think, 6.5%. Q2 onwards, what is the expected recovery? And will there be broadly a price hike that also boosts margin, some range on the FMCG business?
FMCG has two dimensions to it. One is the foods and the second is the HPC business. On foods, we've got four verticals. So, for example, on the biscuits, we do about 15%, which we have maintained pretty much in that. In fact, we've done better than 12% what we had projected. So that was very positive. Nutraceuticals, we have turned the corner. It's a small margin that we do very well in. Our Nutrela business, the consumer business, we've done almost 18%, which is very much par for course. It's a traditional foods business, which combined of staples and the ethnic foods, where we had a one-off challenge in this quarter. So I think overall guidance for the year of 8 to 10% margin that we expect to generate on foods portfolio and 15% plus margin that we expect to generate on the HPC. We are very much on course for that. And I think this particular quarter, because of that one-off write-off that we had to take on the stock quality, I think that should be a thing of the past. And I think this quarter onwards, pretty much for the year, we should be very much on course for that.
Got that. And how has Q2 been in terms of demand? Because you have flagged off deficient monsoon in the early part, El Nino. So for the various businesses, can you give a sense of what the volume growth is going to look like?
There is a challenge. Clearly, we are witnessing that the rural demand is slightly muted. And this is something that we'll probably see more in this particular quarter. So demand has been slightly muted in the second quarter, especially on the rural segment side. Whether this gets exacerbated in the coming quarters, if we see some impact of the monsoons reflecting on the structural basis on the demand in the rural areas, I think we'll have to wait and watch. But right now, I would be cautious on the rural demand side. It does look a little bit stressed, and we'll have to wait a bit, maybe for 1 or 2 months. I think it should become amply clear, because El Nino is also there are two sides to it. One is that, some sort of projections mention that is an extreme event, and the other projections are pointing to, more muted El Nino. So we should wait maybe another month. But right now, it does look a little muted on the demand front.
All right. Hi, Mr. Asthana. Good to have you, sir, on the show. What about on dental care? The growth out there was a little south of the 15% that you had guided for, around 14% or thereabouts. Could you tell us, you're still sticking to that 15% number on an average for the year? And how does that happen? New launches expected in the second half?
No, we should do pretty much on course for that. I think dental marginal drop in demand could happen. There's some seasonality aspect to it also. But broadly, we are pretty much in line across the board on the HPC. Barring on the home care segment, we saw a bit of decline. Decline means that our growth was just about 6% plus. We'd like that to be closer to 15%. That we are correcting. But 15% projection overall on the HPC, we are quite confident that we should be able to do that. And we did about 19% margin on the HPC. We would like to certainly for that to remain in that ballpark number. But 16 to 18% margin on the HPC, we feel pretty confident about.
Mr. Asthana, a few years ago, FMCG was around 7-8% of your mix, which you've guided that it goes, I think, to around 28% of the mix, say, by 2028, right? Given that sort of a change in the revenue mix, directionally, margin should move to what? 6.5%? I'm looking at a Jefferies note, and they are talking about around 6.5%, say, by 2028, 2029. Possible?
We should be very much on course for that, which we have projected. Look, one of the parts which we which define so on a percentage basis, we've said that by 2029, 30, we should be 50-50 on the revenue front. Now, if there's a big commodity inflation on the edible oil side, obviously that skews the percentages bit. So I would rather stay with the course of the growth momentum that we have in both the businesses on the FMCG. And I believe the margin construct of 6.5% on the blended basis should be very much on course for that. And as the oil palm plantation revenues continue to increase and the share continues to increase in our overall share, we should do better than what we are projecting today. So, for example, earlier I was mentioning to Rima that we did about 358 crores last year. This year we should cross certainly more than 400 crores on that business, and it will keep accelerating year after year. So on a blended basis, this margin of 6.5% is highly achievable by 2028, and probably even better than that.
Okay, and at some scale, will you be looking at having a separately listed FMCG business, say in the next 18 to 24 months? Is there a possibility? Because that's where you unlock value, right? The higher margin business gets listed separately. Shareholders who want that, they go for that. And who want the older business, they go for that. So a demerger on the cards?
No, this we have discussed many times. Right now, certainly not on the cards.
Right now, it's not on the cards. But at some scales, Mr. Asthana, you could be interested, right?
No, so I would not commit to that. I think we'll wait for that time to come. But right now, I think we're quite happy in the way it's moving. And right now, the focus is purely on good execution, get it right. I think all the basics are in place, and we just want to be a high-performing business, which continues to drive that momentum.
Okay. One, broader question, sir. The broader Patanjali group, Patanjali Ayurved, also recently secured the regulatory approval to acquire a 73% stake in Magma General Insurance. I get that this is for a different entity, the parent entity, Patanjali Ayurved. But just wanted some clarity if maybe capital or the cash reserves or the balance sheet of the listed entity will be used for the insurance business.
So right now, it is not on the cards at all. I don't think any listed entity, either the cash reserves or the promoter holdings are getting discussed at all. So they have a robust business, though smaller now. There are a lot of funding sources available for them to tap into. So in terms of getting it funded and working through that, they should find it reasonable means of achieving that. So right now, that's not on the cards at all.
But in the past, we have seen your HPC or your biscuits. They were all transferred on a slump sale basis from Patanjali Ayurved into Patanjali Foods. It happened over a period of time. So do you think over a period of time, there is a possibility that even this insurance business gets folded into Patanjali Foods? Is that the thinking?
It's got no link at all with our business. So, for example, we didn't even take the Ayurvedic medicines business into the fold. And anything that sticks to the core of the company, which is around the foods and the HPC business, that's very much within the framework of what we operate in, and rest of the businesses would pretty much stay out of the listed entity.
All right, Mr. Asthana, final question before we let you go. I recall you joining in and clarifying that there's nothing wrong with the business, but it was market participants at play that could have pulled down the stock. Given the kind of erosion that we've seen, I think 25% say in the last 2 months in terms of stock price downtick, is there any plan from the promoter entity to do a buyback or some creeping from the promoter, just to send out a message out there that you all believe that this recent fall was not called for and maybe you'd like to give some support?
So right now it's not on the cards. I mean, obviously these options are always open to support the stock and give the confidence to the investors. But right now we don't believe that we need to shore up the stock price or even otherwise, because the company is strong. We have got very large cash balances on the balance sheet. The businesses, the free cash flows are very good. There are no major capital spend requirements that we have. So in terms of funding the growth of the business, continuing to grow at the pace at which we have done, I think we are very much on course for that. So we would not be getting into buyback, etc. And we feel pretty confident. And I think stock market will do what they do best. And we will do what we know how to do best.
We appreciate you joining in, sir, fielding all our questions and sounding quite optimistic about business as well. We'll hold you to this guidance and we'll take your word for it that there's no demerger on the cards, at least in the near term, and no plans of buyback. Wishing you a good day ahead. All the best to you and the team.
Thank you.
Well, time to slip into a short break. On the other side, we have another management that's waiting for us, that of Park Hotels. Stay tuned. Welcome back. Well, the markets are down close to around 65 points. A couple of stocks actually are calling for your attention. I think, Milky Mist, by the way, dairy food has listed at around 165 rupees. That compares with the issue price of around 140 rupees. So that's been a good listing. And a company like Indomim, as Prashant mentioned, they joined us on the show itself. And post its listing, I think the stock is up close to 80-85% or thereabouts. So Indomim posts its numbers. The street likes it, and in fact, that stock, is holding with some good gains today. But I think we could go across, yes. I think we've got the management of, Park Hotels who joins us on the show. We have Mr. Vijay Diwan, the MD of the company. Hi, Mr. Diwan. Good morning, and good to see you, and thanks a lot for joining in. Well, tell us in terms of growth. Earlier you were guiding for double-digit growth in FY27. For the first quarter, it's been a little short of expectations. For the year, what kind of a number are you looking at in terms of growth and also margins, right? You were guiding for a 200-300 basis point improvement. Do you stick to that?
So very happy, firstly, to be back on CNBC. So I'm delighted
to have you, sir.
Yeah, okay. So thank you so much. We have started actually FY27 on a very, very positive momentum, demonstrating the resilience and the strength of our business model. So despite the headwinds which have been there on account of the West Asia crisis, on account of air traffic and passenger air traffic being absolutely flat, supply side disruptions, we have been able to record a 10% growth on a consolidated level. And as well as the EBITDA has grown by 8% at a consolidated level. The most important thing is that despite all these headwinds, we have been able to achieve occupancy rate of 92%, and we have been able to maintain our leadership position in the upper upscale segment, in the on RevPAR in the upper upscale segment. So it has been a very positive momentum. We feel that as we go into quarter two, the business environment is definitely changing. What is changing is that India is hosting the BRICS summit, and there are going to be large number of wedding dates which are going to be there from November right up to March. There are going to be about 40 wedding dates. In addition to this, there are going to be large conferences like the Aero Show in Bangalore, plus the Bharat Mobility Expo, which is going to take place on a really large scale in Delhi. All this is going to be very positive for the hospitality. ICRA forecasts a 7 to 9% growth in hospitality during the course of the year, and we are confident that we will go ahead of the forecast.
So 10 to 12% growth is what we could factor in for the year. Would that be fair?
We can look at in terms of roughly about high single digit or just crossing the double digit is what we can definitely expect. The momentum is strong. As I mentioned, the environment is changing and the momentum is strong. And we are very positively poised because we have excellent growth plans. Currently, during the course of this year, we are going to add 12 hotels, totaling to about 472 keys. 142 keys are just going to open in the month of September itself. In Q3, my plan is to open about 186 keys, followed by 137, 38 keys in quarter four. So all in all, it looks very good for us. And we are very positive. And one very important thing I must mention, which is very, very important to us, and that is in our mixed-use development at the EM Bypass in Calcutta, which is residences as well as hotel development, the response has been absolutely phenomenal. We have been able to sell 33 of the 69 apartments which are up for sale. And this is going to result in a positive cash flow for our company by over 80 crores during the course of this year itself, followed by
120 crores in the following year, and in the third year by another 100 crores. So on the cash flow front also, the company is extremely well poised, and this will give us a tremendous opportunity in terms of inorganic growth as we go forward.
Got it. All right. Also, sir, as you said, you're adding a lot of keys from September onwards. For the year, what is the cumulative addition in terms of number of keys? And since, for majority of the year, you won't have these keys because it will come from the second half of the year itself. What kind of ARR, average revenue, are you working with in terms of an increase from year on?
So firstly, currently we have 42 hotels totaling to 2,677 keys. We plan to add 12 hotels and add 472 keys, taking our overall key target or overall key count to 3,150 keys, to be precise, 3,149 keys. As I mentioned, the market is looking good, and we are expecting high single-digit ARR growth as we go forward. So it is looking very positive for the industry because things are changing. Things are changing in West Asia also, and the airline growth is also expected. So it looks very positive at the moment.
High single-digit ARR growth for the full year. But in Q1, sir, your ARR growth was only 2%. Why is that?
No, because I mentioned there are 3 or 4 reasons. One is that the air passenger traffic growth in India really slowed down in quarter one because of high energy cost or high fuel prices. The airline growth or the passenger growth has been absolutely flat. In fact, in the month of June, the passenger traffic declined by 1%. So that has had an impact. Along with this, there has been obviously disruptions. Foreign traffic has also reduced because of the West Asia crisis, and this is impacting ARR growth. But the most important thing is that despite these headwinds, the APJ Surendra Park hotels, we were able to record 92% occupancy, and we were able to maintain our position in the upper upscale segment, and we were able to lead in terms of the RevPAR in the upper upscale segment. So that is where we are at the moment, and we are very bullish and positive as we go forward.
Final question, sir. Finance costs went up by 60%. Could you explain that line item for us? Was there an increase in debt?
That actually is very positive because it shows that we are on the path of expansion. During the course of last year, we acquired a property in Mumbai, which is the Zillion Hotels and Resorts, at a cost of 228 odd crores, out of which about 190 crores has been paid. Plus, we acquired a property in the south at the Vemanad Lake, Purity, and all this has increased the term loan, which has now gone up to 276 crores. So that is the reason why the interest cost has gone up. So it is gone up for propelling expansion, and still the debt to equity ratio for the company is extremely healthy. It is only at 0.12 to 1. And it gives us a lot of freedom for both inorganic and organic growth.
Okay, we'll leave it there. Thank you very much. Wonderful conversation, and we wish you all the best as you execute. So thank you.
Thank you. Thank you so much.
Okay, well, from hospitality to EMS, and this is the conversation from the sidelines of the Motilal Oswal Annual Global Investor Conference. We had Atul Lal joining us from Dixon Technologies. Mr. Lal, great to have you with us here on the conference, from the sidelines of the Moti conference. In your presentation, Mr. Lal, you said that there will be 5 PLI schemes, and all through which Dixon could benefit from all of this. How is it going to benefit Dixon in terms of exports and in terms of volumes? The PLI schemes, that is, which you yourself described in the presentation.
The government policy framework has been extremely supportive of electronics manufacturing sector. And in Dixon, we have been beneficiaries of 5 PLI scheme, which has really supported us in growth. And also, it has supported the Indian industry. The next policy announcement on the PLI 2 or MPMS, as we call it, for mobiles, And Dixon, we are going to be leveraging it. One, we feel that is going to help us in accessing the global markets. And the second is going to help us in deepening the manufacturing by localization, in which Dixon has recently forayed by our entry into camera modules and also display, and at some point of time even mechanicals. And also, we are going to be leveraging the second PLI for design, in which we are going to support the domestic Indian brands. For us, these are all important building blocks for taking our mobile business to the next level, and we are sure that it's going to help the Indian industry in reaching the global scale.
So just to carry on that point, could you give us a sense, Mr. Lal, of what kind of investments is Dixon envisaging across these new PLI schemes, the newest one as well? And what should shareholders expect in terms of returns from the investments that you will be making for this?
So we already made significant investments in creating capacities. We feel the capacities as of now are adequate, but whatever investments are required for expanding the mobile capacities, we are committed to it. We have recently built one of our very large factories of 1 million square feet for mobile in Sector 151 Noida, which is going to be operative in the next 2 to 3 months. We have made significant investments in our display plant and also in the camera module plant. So our run rate for capex in this particular sector is going to be somewhere between 800 to 1,000 crores a year.
Okay. You spoke about the benefits, sir, that the company has gained through these PLIs. But what the market is worried about is on margins. Now, you spoke in your presentation about that. How are you planning to improve margins from here going forward, and which would be the key segments which could be margin accretive?
You see, the margin profile of the Indian EMS industry in the space of mobiles is comparable to our global peers. For margin expansion, there are significant initiatives being taken. One is in the component business, which is a significantly higher mobile business. And also, apart from the mobile business, our expansion into our appliances business, lighting business, since that's completely ODM business, the margin profile is much, much higher. So we feel that in a couple of years, on the blended basis, there will be a significant expansion of margins.
Mr. Lal, what about the recent Vivo JV announcement? When do you think, I mean, this is essentially going to start production, and the numbers that you expect coming out of this? Just give us a sense and scale.
Well, the integration is happening. We feel that in a quarter or so, the trial productions are going to start, and then step by step is going to start building up.
Well, Mr. Lal, the memory prices have gone up, as you mentioned in your presentation, not only in the last quarter, but also in the last 1 year or so. You think there are any signs of the trend actually reversing, which will help Dixon going forward?
As of now, we feel these higher prices are going to be there, and we'll have to live with them for another 4 to 6 quarters. So it's a difficult prediction to make, but I feel that at some point of time, there'll be some sustainability or some softening taking place. However, as of now, it's on the higher trajectory curve.
And sir, on the ESM approvals, can you give us a roadmap on when things will start in terms of numbers as well?
So we have received practically all the approvals that we had filed at the Government of India. Our various projects are under execution phase. Our camera module project is a running factory. Our display factory is going to start the trials in the next quarter, and the commercial production should start partially in Q4, and it's going to pick up in Q1, and we'll keep on ramping up. Our JV with Longchair is going to get operationalized in next 3 to 4 months. Our JV for optical transducers also is going to get operationalized by Q4 of this fiscal. So that's the steps being taken.
Mr. Lal, just to sort of wrap this up, Dixon has done some 11 joint ventures in the last 12 to 18 months. Do you have all the technology partners and customers, etc., with who you want to tie up, or are we going to see a lot more tie-ups in the near and further out? How are those shaping up, if you can give us a sense?
So Dixon's growth is going to be through the partnership route. As I shared in my presentation, in the last 18 odd months, we have done 11 JVs. So we are going to keep hunting for partners and create a win-win situation, offer to them the Indian markets, partner them for adopting the technology, deepen the manufacturing, bring in more science and technology and R&D into India, and try to make India and Dixon as a hub and a footprint for servicing global markets across various product devices.
So we leave the conversation here. Thank you very much for joining in. There's a word coming in from Dixon. Milky Mist has listed at 165. This compares with an issue price of 140, straight away a bump up of nearly 22%. Overall, the subscription was strong. It was about 56 times, with QIBs subscribing the company by nearly 155 times. We'll quickly just tell you about the company before we get to the valuations. Now, this is a company which does not sell milk, not your plain milk. They could sell UHTs, that's ultra-high treated milk, etc., but largely value add. In terms of categories, 29% of the revenue comes in from paneer, but they have cheese, ghee, yogurt, chocolates, and the rest. FY26 revenues for the company were about 3,138 crore. This is a company which has been growing at 30% for the last 2 years, and EBITDA margins also expanded from 12.2% in FY24 to 13.9%. Now, the company had raised about 1,500 crore via the QIP. Of that, there was a fresh issue of 1,428 crore, and part of those proceeds would go to pare down the debt on the books, the debt which stood at close to 1,700 crore rupees. Now, we had a chat with the management of Milky Mist earlier, and this is what they had to share about the growth going forward. So Milky Mist has been growing at 30% for the last 2-3 years, and the management believes this growth rate is sustainable, even if there is a lot of competition coming through. All the names like your Amul, Hatsun, Dodla, they're all entering into this value-added space. But what the management said is that 90% of India's paneer market is still unorganized, which means it leaves plenty of headroom for the organized players to grow without a lot of pricing pressure. Secondly, on margins, the company has one very fancy, factory in Tamil Nadu, but that factory is operating at a capacity utilization of 35 to 50% across various products, which means the future growth, at least for now, can come from the same plants, same infrastructure, same overheads. So according to the company, revenue growth is sustainable and there is still operating leverage. So people like the story. I think the only concern was on valuations. Now, FY26 EPS, what was shared in the RHP, if you account for the dilution, because the company did raise fresh issue, was about 1 rupee 65 paise. At the IPO price of 140, it was already 85 times. So it was deemed expensive. But I had a look at the DAM Capital note which came out today, and this is their EPS projections. Now, they said FY26, this is pre-dilution. Post-dilution was 1.65 for FY26. Pre was 2 rupees, but this goes up to 4.3 rupees in FY28 and 5.6 rupees in FY29. So the bottom line is expected to more than double. So DAM Capital is pricing the company at about 35 times forward multiple. The EPS they've assumed is between FY28 to FY29. Yes, it is premium valuations versus the rest of the peers, but they say this is a category leader in paneer and their gross margins are also higher than peers. But for now, that's about the company and how the valuations stack up, and it's been a good debut for Milky Mist. Still holding up. Oh, it's extended now. 165 points at open, 180 rupees for Milky Mist as we speak. Let's go across to Chandan Taparia now. Chandan, sixth consecutive day of losses for the markets, and now we're closer to 24,200, breached yesterday's intraday low. What's the positioning?
Yeah, good morning, Rima. Thanks for having me. So Nifty has been making lower top, lower bottom from, in fact, last 10 days. We have seen a corrective move from 24,774 to almost 24,200 levels. Now we are nearest 50, the exponential moving average. But the important part is market needs to negate the lower top, lower bottom or lower highs. Then only the positive stance could be there. So it seems that now some resilience is clearly visible at lower levels, but it needs to surpass an immediate barrier above 24,350. Then only the stability will be back. So as of now, we have to be with broader trading range, 24,000 to 24,350, 24,500. This is the trading range. But we need to initiate only long position if market negates the 11 days of lower highs formation in next 1 day or 2 days. Talking about Bank Nifty, that got stuck in a range from last 10, 12 days. Multiple supports and put rating is visible at 57,000. But at the same time, hurdles are clearly seen at 57,750 to 58,000. So Bank Nifty got stuck in a range, and Nifty is in a range but making lower highs and needs to negate the lower highs to get some buying interest. And meanwhile, I believe selective stock-specific bottom-out approach could play well in this kind of market scenario.
Stocks, Chandan?
Yeah, so first there is buy on Sonacom. The stock has been making higher top, higher bottom formation on daily chart. In fact, selective Nifty Auto and Auto ends are doing well. Sonacom looks quite interesting. We have seen build up of long position. So momentum could extend. One can buy with support of 800 for an upside target towards 860. Second trading idea, there is buy on HAL. We are positive on the Nifty India Defense Index. Most of the defense counter looks good, whether we talk about the FNO name of HCL or BL or Mazgaon or non-FNO counter like Paras Defense and all. But here we would like to go for HCL. Counter is given a consolidation breakout. Major trend is positive. Some put writing is also visible in the counter. So one can buy with support of 5,000 and a small follow can lead the stock towards 5,400 level. Last trading area, there is buy on Dixon, one of the strongest counter, all set to start the next leg of rally. Given a consolidation breakout of last 20 days. So with support of higher base of 13,900, one can look for an upside target towards 14,750 to 14,850 marks.
Thank you very much for that. Get into break. Manisha will join in on the other side to talk commodities. Stay tuned. Welcome back. Let's talk commodities, crude in particular, which continues to rise. Manisha is now joining in with the latest numbers and the news.
Thank you so much for that. Well, we have seen 2 weeks of gains come in for the crude oil prices. This is the third straight week, and there is extended buying that we are looking at in case of crude prices. It's trading at a one-month highs. It's also trading above $91 a barrel. And the 60-day US-Iran ceasefire has just about expired, with statements coming in from both sides that they're not looking at any truce right now. US especially has ruled out any extension, and Iran has signaled a more aggressive stance going forward. And that's exactly the premium that the markets seem to be working with right now. Take a look at the Strait of Hormuz numbers, and that will tell you that there are concerns about oil supplies from the Middle East as well. It was 5 vessels that went via Strait of Hormuz on Saturday. Sunday was 0, unless, of course, some of these ships really switched off their signals therein. And this is vis-a-vis 31 vessels that crossed in the last weekend. So from 31 to 5 is what we've seen on a weekend-to-weekend basis from Strait of Hormuz, and that's yet another factor to watch out for. And then you're looking at expanded regional escalation therein. The Yemen Houthis have forced a launch missile on Saudi military vessel in Red Sea. There have been concerns at ADNOC as well. Markets also looking at attacks on Saudi military vessels and 4 escort ships that have happened in case of Red Sea as well. So various escalations that we're looking at in Bab al-Mandeb as well, in Red Sea, and then in Strait of Hormuz is what is keeping the crude oil prices higher. The markets also are looking at renewed fighting that we're looking at in Lebanon, Iran and Oman, while they continue to negotiate an arrangement of Strait of Hormuz, but they haven't reached a resolution onto that one as well. The world oil demand expectation, when you look at that for 2026, OPEC expects a growth of 0.6 million barrels per day, while a contraction is what IEA is working with at 1.6 million. So there is a demand destruction as well that both major agencies are working with. Now, when you look at the supply part of it, for 2026, the expectation is that you're looking at an average 4.3 million barrels per day in 2026 there. When it comes to crude supply going forward, so while 2026 could be looking at a deficit of 1.2 to 1.8 million barrels per day, but we are working with the situation of surplus in the next year, and that is perhaps what is keeping the prices in check as well. The reason that you're not trading above $100 a barrel is that you're anticipating surplus of a situation going forward as we step into 2027. The dollar index is trading at a 3-month low. That has been another reason that you've seen dollar-denominated commodities do quite well. It is about the soft U.S. economic data, whether it has been about jobs, consumer confidence, retail sales, and the export numbers. All of that coming in slightly on the weaker side. Add inflation to that list as well. But what the street will watch out for right now is the U.S. Fed meeting minutes. Well, that is going to be released on Wednesday. And then next week, it is going to be about the Jackson Hole Symposium. And what kind of statements do the U.S. Fed really does talk there in testimony is something that the markets will take further cues from.
Manisha, thank you very much for that interesting data points there. We'll take a break. We are back. Lata is speaking with the Elara Securities' Harindra Kumar on the best picks post the earnings season, which has been pretty strong. Stay tuned. Coming up.
Welcome to Market Masters. The Q1 earnings season is done, and the key takeaway is that companies have beaten estimates across most sectors, and that includes financials, metals, automobiles, chemicals, textiles, even real estate. Of course, OMCs, oil marketing companies, expectedly dragged the overall aggregates. But the big rupee depreciation also is behind us. Only geopolitical worries seem to be on here, off here. So where do we go from here? To analyze the macros and give us an idea of what sectors and stocks to pick, I have with me Harendra Kumar, the Managing Director and CEO at Elara Securities. Thank you very much, Harendra, for dropping into our studios. Okay, let me start with a very interesting report your team sent me on rupee depreciation. You're saying that an orderly rupee depreciation is very good for stock markets. Tell us about it.
Yeah, so I think we've looked historically over the last 2 or 3 cycles where, we had sharp rupee depreciation. And typically that spooks the foreign investors. And such kind of depreciation comes with some geopolitical or an energy shock. So you see outflows from emerging market. And once the rupee stabilizes, I think there is a reflation trade that comes into the market. And typically it means that the index should return 20% from there on.
Oh, okay.
So I think, so after the sharp depreciation that we've seen now and the stabilization and the RBI measures, so we are looking at 97 as a stabilizing level. And I think this is what FIs will take note of. And this with the catalyzing earnings that we are entered into, I think we are looking at a very strong recovery on the Nifty. And I think 17 to 20% is a good number to look at in the next 12 to 15 months.
Okay. I was just going to ask you for the time. If you say 20%, by when? Okay, 15 to 20 months, would you say, is the usual time taken?
So I think 18 months is,
18 months,
is a good. So, but the key point here is that you are at a good turning point. Okay. And your risk reward is favorable. So the point here to make is we had 2 energy shocks, and we've demonstrated that India is quite capable of managing crude up to $120, right? And I think this people should take note of this. So the risk reward now turns extremely favorable with, we are seeing earnings upcycle, our ability to deal with crude shocks, and a rupee which is stable.
Okay. So what would be the immediate beneficiaries of a stable rupee?
Yes.
A depreciating but very slowly depreciating rupee.
Yeah. So I think first and foremost is what FIs love, right? So typically what went out will...
large caps then?
Some of the large caps. But we've also seen that a reflation trade is more like a beta trade. So it moves largely for SMIDs more than large caps.
Really? Okay.
Yes.
Okay.
So I think what we're seeing already, the movement in small and mid caps is typically the money flow back into this because they're the ones that had corrected the most. And typically when the earnings cycle also turns in their favor, the money flow first go to SMIDs and their outperformance to large caps is far more superior. So yes, large caps, like we said, will deliver 17 to 20%. But your ability to generate alpha will come from mid caps. I think that is something to note here.
Now, can you break it down? I think one of your themes was consumer discretionaries. Among the small and mid caps, what would be some important themes to play?
Perfect. So, so the point here we want to make is the GST 2.0 has been a phenomenal success. I think we are giving less credit to the macro reform that the government did. The earnings resilience of this is also coming from FMCG names. I think the double-digit top-line growth that the companies are demonstrating has been very difficult to come by.
Oh yes, after so many quarters.
Yes, I think the market should take note of. And from here, you will have a cyclical upturn. So consumer discretionary remains an enduring theme over the next 6 to 8 quarters. And right up there is actually automobiles. So you see a revival in demand for companies like iSure, which has not done a lot more. And then you will have earnings tailwinds plus demand for Bajaj Auto, which is a clear Forex earner.
Oh, yes.
Right? And there's still a lot of upsides with respect to the valuation re-rating. Maruti is posing phenomenal numbers. So Maruti, it had great top line, but bad PAT numbers because of margin.
And that was not only Maruti. We did see margins under pressure, although revenues did well.
Yes. So the normalization of margins will come in the subsequent quarters. Right, so which means that the flow through to the earnings will happen. So auto as a discretionary play remains very, very strong. And coming back from the the consumption plays that we mentioned, I think a lot of the the e-commerce plays, like a Nykaa.
Behave like an FMCG.
Yes, and they will have a lot of volume growth because there will be tailwinds of consumption that will come up. So many of the IPO names which are digitally backed, right, will start to compound at a much stronger rate than historically what we've seen.
Okay. What about the themes that we celebrated so much? Power and defense. Does power still have juice or have they become overvalued?
No, I think power will be the bedrock for India's next century. I think in the Sapta Sparda, whatever the 5 paths to growth which Mr. Modi has given out, we're going to have 100 gigawatts of nuclear energy, out of which 30% will be done by NTPC. Right. So it's going to have...
It will be first off the block.
Yeah. So it will have a phenomenal compounding of regulated equity. So they are no longer equities, they're growth stocks. And if they multiply it 1.5, 2 times price to book, I think there is decent compounding with respect to power stocks. And there are a lot of plays out there. And this will also lead or spur. So like autos, the power sector has a long tail with respect to the ancillary space. So the cap goods revival will be stronger, and which you are beginning to see in a Siemens or an ABB as well. So consumer discretionary and capex look to be moving in tandem after a long time. To the markets,
you don't think the consumer story can get kind of a reversal because of possible El Nino, possible rural consumption not being as good as last year? No such fears?
No, I think as of now, what our macro team tells me, things are pretty much all right now.
It's better than we feared, the El Nino.
So I think, but beyond that, the government has done a lot more with respect to managing inflation, production. Even a PM Surya plan. The challenge check that we do with people is that the adoption of solar panels in the household is very, very good, and this is leading to a large demand resurgence in brown goods, EVs, two-wheelers, power consumption, right?
Air conditioners. We were speaking to the Blue Star guy, although his numbers this quarter were not good. He's saying it's like an 18% CAGR looks like a given. So your story about solar encouraging.
So I think rural has been more resilient. I think the schemes with respect to fisheries, with respect to other farming measures are actually trickling down. So they're far more resilient than possibly we are giving them credit for.
Okay. Among the e-commerce, I didn't develop that theme. You said that e-commerce is almost behaving like FMCG. What would be your favored themes there?
And better actually, because they have become platforms. So for example, if you start from, of course, Eternal is much spoken about. It's a consensus buy. But, you go a little down, you have a Nykaa, which is among our top picks. It's
FSN, right?
Yes, FSN. It's compounding at a serious rate. It's demonstrated it can move horizontally, and the profit will flow down to the bottom line as well. It's becoming a default. It's a category creator, right? So I think...
would PB FinTech fall in that category
100%. So that's also part of our top picks. So while you see that the private insurers are struggling for growth, it has become a platform, and it's demonstrated a clear horizontal move into lending, into wealth management. And as more and more partners climb onto the platform, they become very large players in the space. So my guess is if anybody's at 80,000 crores, they have the ability to multiply market caps. And eventually, I would not be surprised to say the Nifty will become more like a NASDAQ with at least a strong quantum of platform companies become Nifty companies.
Okay, fair enough. Which brings us to financials, the sector which now occupies a large space in the Nifty, or even for that matter,
I'm not so bullish on private banks in the financial space. Is prima facie is that the regulatory construct and the market it's become very commoditized product. So the ability to generate superior ROEs is coming down over the years. So somebody who started at 25 ROE, right? HDFC Bank is now at 15% ROE. So you will trade 1.5, 2 times price to book, slightly higher.
But not the 4 that you were.
Not the 4 that you saw, right? But we are living in history's paradigm and we keep on owning them. But the value capture profit pool has shifted to NBFCs, fintechs. SBI chairman has said we lost the game to fintechs, right? So essentially this means that the economy's construct and profit pools is changing. If you realign our lens towards more of these names, exchanges, wealth managers, I think we'll be better served.
Okay. Just a final question on what are your favorites in the NBFCs?
So of course, I think NBFCs is going to be one category. They're going to be a AI beneficiary rather than a,
Yeah, but Bajaj is also an expensive stock.
No, it's not expensive if you look at the theoretical ROE that it generates to the price to book multiple. So we would like to say that it's going to compound at least if it compounds the earnings, which is delivering 25%, it'll double in possibly 3 years, which is a fantastic for a large cap. So I think NBFCs, you will have the fintechs who are funneling in the credit growth to the NBFCs per se. And of course, since we spoke on autos, I think this auto finances and CV finances will have better tailwind than a gold financier or somebody else.
Okay. Thank you very much, Harindra. Not out of questions, but that's plenty of ideas to work with and a very bullish story that probably within 18 months, that is by end of 2027, we should be seeing a 15 to 20% rise in earnings in stock market returns. That's an extremely pleasant takeaway. That's it on this edition of Market Masters. After the break, we will have Chartbusters.
Colgate-Palmolive is under pressure as the management in its conference call emphasizes on its focus on growth over near-term profitability and signals higher advertising spend. Brokerages such as HSBC and Citi issue hold ratings.
Sigma Advanced Systems Consortium's wins an anti-drone order worth around 145 crore rupees. The stock is up close to around 5%.
Indo-MIM posts an operationally strong first quarter with margin expansion and double-digit revenue growth. The stock is locked in a 10% upper circuit.
Non-milk dairy products player Milky Mist makes a strong debut on the street, listing with gains of around 30% to its issue price. Brokerage DAM Capital also initiated coverage of the stock with a buy rating, target price of around 175 rupees a share, which has been hit.
And the centre approves 31 applications under the Electronics Component Manufacturing Scheme with an expected investment of 7,877 crores. The shortlisted companies include Jyoti CNC, Acutas Chemicals, Sirma SGS Tech and PCBL Chemicals.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV Team Motilal Oswal studio. I'm Nigel, with me is Ekta. And Ekta, as we speak, the market's a little bit softer. I think yesterday we ended lower. And this morning, the worry is that Brent crude prices have spiked up. So that's why I think we're seeing a bit of a downtick. But I think the 24,200 could probably hold out, given that we have weekly expiry as well.
Well, yes, absolutely, Nigel. I think the worry is that, Brent crude crossed that $90 per barrel mark. So currently at around $91. So definitely that continues to be a concern. So let's see whether there's any kind of breakthrough when it comes to the geopolitical scenario between the US and Iran. But nonetheless, for the mid-cap index, it is underperforming. So down around 0.4% at this point in time. The Nifty at around 24,226. Good time then to talk about the technicals. We have Ajit Mishra joining in to discuss that. Ajit, hi, welcome to the show. Well, it's another down day for the markets. Obviously, Brent crude is weighing on sentiment at this point. What is your call?
Good morning, Ekta. So yes, Ekta, this $90 mark again means we are sustaining around this area, $88, $90 mark from last several days. And that's why we are seeing that it's the sixth consecutive day that index is trading under pressure. Today we are at 100 EMA mark, which is 24,200. We have weekly expiry also. So as of now, this is a make or break area. In case if we fail to hold this area, probably we are set for the next leg of decline towards 24,000, 23,800. So positionally, in case if somebody holding longs, 24,200 should definitely be the key support area to watch out for. In case of rebound, 24,400 is something that we are eyeing as a strong hurdle, which was earlier acting as a support, the long-term moving average. And once we cross that, then probably we may see a decisive recovery also in the index. So as of now, 24,200, 400 could be the broader range that index might continue to hover in.
Got it. All right, Ajit, what about some individual stocks?
So Nigel, considering the market tone, we still have like certain pockets like auto wherein we are seeing strength. So M&M within the auto basket after this marginal retracement looks set for consolidation followed by a rebound. So it's a good area to look for fresh accumulation in M&M with stop at 33.50 and target of 35.60. And on the short side, ITC is currently reeling under pressure. In fact, it's a fresh breakdown after almost 2 months of consolidation. So we are eyeing 260 as a target area, position target area for ITC. So with stop at 278, one can go short in ITC.
Okay, all right. Just a quick word on a couple of these IT stocks, because now Infosys is showing a cut of around 4% on a week-to-date basis. What's your sense in terms of how you'd approach a couple of these frontline ones?
So Ekta, after this failed attempt to cross the major hurdle around the 31,800 mark in the Nifty IT index, we are seeing that majority of the IT majors are witnessing decline. So for Infosys also, we are seeing a similar trend unfold, means the stock has slipped below its short-term averages. So probably around this area, 1,100, 1,080 could be the zone where it might take a breather, which was the previous consolidation range also. But overall, indications are much in the favor of consolidation with the negative bias. So avoid any fresh buying. In case if you have any position, 1,100 should be your stop.
Got it. All right. Thanks a lot, Ajit, for that. Well, let's turn our attention then to our special segment where we get you a few ideas for profit from Money Control Pro. Lekha Badlani joins us to help us out with a stock that she's tracking very closely. Lekha, take it away.
Yes, thanks. My stock pick is KIMS Hospitals, where the investment debate is increasingly shifting from expansion-led growth to occupancy-led operating leverage. Now, KIMS delivered a strong Q1 FY27 results with revenue growing around 35% YOY. More importantly, the underlying operating matrix remained robust. The inpatient volumes grew around 27%, the outpatient volumes grew 31%, while ARPOB increased by around 10% to 47,200 rupees. Now, the reported 49% occupancy looks subdued, mainly because of the large capacity additions. Excluding the newly added and renovated beds, occupancy was closer to 61%. The near-term concern is profitability. EBITDA margins declined to 19% as newly commissioned hospitals are still absorbing the ramp-up cost, while higher depreciation and finance cost weighed heavily on PAT. But this is where we see the opportunity. Now, KIMS has already incurred a large part of its expansion capex, and the next phase is about filling these beds rather than adding capacity. As occupancy improves, the significant gap between current and mature hospitals' margin should translate into strong operating leverage. Management is targeting 65 to 70% occupancy by FY30, with the Bangalore and Maharashtra clusters expected to reach 20 to 22% EBITDA margins, and the mature Telangana cluster delivering 30 to 35% margin. Now, there is also substantial embedded growth capacity with around 1,300 beds in the pipeline. Another positive is the balance sheet. Now, KIMS raised around 1,500 crore through QIP and has reduced its debt by a large extent. At around 23x FY28 estimated EV EBITDA, we believe the stock offers an attractive risk reward.
Thanks a lot for that, Lekha. Well, for the time being, we'll slip into a short break. On the other side, we'll continue our focus on markets and stocks that are moving around. Stay tuned.
Welcome back. Well, it's definitely a down day for the markets, but if you look at a couple of stocks, they're managing to hold up quite well. So one would be Physicswala, which has done well today as well. And in fact, on a week-to-date basis, it's already gained around 6%. So it's up around 3.6% in today's trading session. And MRPL is doing well as well. So that stock is up around 5.5% with a gain of close to 10% on a week-to-date basis. But let's get talking about the entire hospital space. Private equity money has come in big into the healthcare and hospital space. The parliamentary panel report also talks about this. So we put these questions down to Dr. B.S. Ajay Kumar of HCG. He's someone who has seen multiple PE players in HCG since its inception. So let's listen in to an excerpt of that conversation.
Some of the non-profit hospitals charge the patient as much as we do. There is no difference when you look at it, their bills. So what is it we achieve? We put the money back into the system to bring better technology, hire better doctors, do better training. Today, because of that, at least in oncology, I can say, I'm sure in other specialties also, the outcome of our patients are equal or best. I studied in MD Anderson, which is one of the big centers in the world. Our outcome is equal to that. It should have a wow effect. But here is a parliamentary committee sitting and talking about, I'm going to put a cap on this, beds and all that. For me, it doesn't matter. You want to put a cap, put a back. Because patients will come. The right patients will come, we will grow. But my issue is, they should understand where we are. India is like a multiple country within a countries. We have, as I always say, 300 million population growing up the ladder, demanding high care. They want that kind of care. And as we heard before, what we charge is far less compared to advanced countries, so-called. We are an advanced country charging much less.
Dr. Ajay Kumar, let me come in there. I mean, just again, to push back on, just because I want to present the other case as well, do outcomes change? Because you've had private equity partners with you, I mean, as you said, since inception. Because these are largely, I mean, they are financial investors in that sense, right? Yes. So they're out there. Your focus is patient outcome. But of course, I mean, a financial investor's focus is return, maximization of return. Ekta was earlier telling me that there is...
I want to talk about maximization.
Yeah.
When a private equity comes to us, first thing, rule of thumb is there's no guaranteed return. Second is, when we as doctors talk about it, no private equity has ever interfered to say you should not do the right thing. Or you should do more procedures, more things. Nobody has in. All 7 or 8 private equities. And their return expectation... Also, we should talk about it. I remember once talking to a private equity in New York. They said, we require a minimum 25%. I was at a breakfast. I said, thanks for the breakfast and walked out. So we have to be very clear. As a promoter, founder, we have to be very clear how do we navigate this with the private equity. My view is 15%, 20% if they get. Even if they don't get, it is not my botheration. I do right thing. What returns comes is for them. It is like a stock market where, it is a stock which appreciates. When you don't give dividend, somebody comes and buys a stock at 100 rupees, somebody has 200 rupees. Why should I worry about it? I do what is the right thing as an oncologist. Go into research. India lacks research. How do we go into
private equity in the driver's seat, controlling stake, I mean, essentially running things.
It has not happened to me so far. And I think it is who is the doctor, how the system is run. That is what makes it. I think there's a false assumption private equity is in the driver's seat. In my view, it is not true. It is because you see the stock market going up, the stocks going up. You see, wow, look at them. They made a 5x, 6x. But I don't think in reality private equity. But they do bring more efficiency in the system, which is what we want. Efficiency, good margin, buying power. How do you acquire the same term? How do you make sure the margins are good? At the same time, you provide the right care. I think it is the best of both worlds. It's a Goldilocks type of a thing, but people refuse to accept it because people think, how can India be so advanced? That is the problem.
Well, interesting one. As always, Ekta and the team will keep, playing bites of that particular chart all through the day. That was our special market forum. Well, we'll slip into a short break. On the other side, we have the management of Electronics Mart that are waiting for us. Remember, they did a very, very good job in the first quarter. What's the way ahead is what we want to find out. Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, let's focus on electronics. Smart India. They reported its highest ever quarterly revenue and a five-fold jump in its profitability, which was driven by strong same-sales growth as well as margin expansion. We're now joined by Mr. Premchand Devarakonda, the CFO of Electronics Smart India. Hi, sir. Good morning and congratulations on a good showing in the first quarter. Well, my key question to you would be on the margins. They came in excess of around 9%. I went through many quarters. I didn't see this sort of a number. So one, I've observed that your gross margin is well expanded and also maybe better product mix helped you all. What's the sustainability of this margin number, if you could help us out? And what kind of growth are you guiding for the year after this good start?
Yeah, good morning and thank you very much for having me on your show. This Q1 was it's like a power play in the cricket match, and it went in our favor. And it was mainly the top line. I mean, top line was driven by the market demand and also price escalation. And about the gross margin percentage, it was mainly contributed by the product mix. Mainly that summer season. This summer season was heavy on the cooling products, and the cooling products will always have the higher gross margins. So all these blended favorable conditions actually helped us to achieve this remarkable target. And second thing is the similar rate of margins cannot be sustained and throughout the year, because that once the product mix changes, so obviously there will be a little bit of a drop in the gross margins. But for this year, since the Q1 was extremely favorable to us, and we are quite optimistic of achieving a top line growth about 20%, and bottom line will be around up about 3%. So, and EBITDA will be around 7% up.
Okay, all right. So you're expecting a 20% revenue growth this time. Well, if you could just break it down region-wise, what can investors expect in terms of which are the regions which will be leading in terms of same-store sales growth? And why is that? What are the reasons behind that?
Okay. See, when you compare Q1 of last year to the current year, so Q1 last year was little unfavorable to us because the summer season was washed out. And this time again, the situation is normalized. In fact, the southern margins, southern states like AP, Telangana and Hyderabad clusters did exceedingly well. And NCR was around 18% SSG, whereas these southern markets had a decent 30% SSG. So that was remarkable.
All right. So just one quick word on margins. You're expecting it to hold around 7%. Is that what you said?
7% EBITDA margin for the current year.
Got it. All right. So we'll just correct that flash then. Got it. Tell us a little about, the NCR region. The north out there. I think you turned positive as you had guided the last time around. Sustainability of this number and traction you're seeing on ground out there?
Yes, sir. In Q1, NCR was a little slow because again there were unseasonal rains. But last year we achieved about 30% top line growth in NCR, and this year we are going to sustain the similar growth rate in NCR.
Okay. How many stores are you adding in FY27?
In FY27, we'll be adding around 20 plus stores, out of which about 10 stores will be in the existing clusters like NCR, AP and Telangana, and about 10 stores will be added in the new region, that is Kolkata. So we have started expanding our operations to Eastern market with Kolkata as the base. And before Diwali, we are planning to launch about 5 stores. And by end of this financial year, we'll be adding 5 more stores. So that will take the total store count in Kolkata to 10.
Okay, so how many new stores would you have by the end of this fiscal, and how long does it take to break even on these stores?
See, currently in the existing markets, like in the first year itself, we are able to breaking in. So that is because already we have the brand recognition in these markets. So as a result, it does not take much time. Like we'll have the operational break even in the first 3 months, and I think we can have the store profitability by end of the first year. So, whereas in the Kolkata region, we are expecting it to be around, to have the operational break even, we need about 12 months.
All right, Mr. Devarakonda, actually the other positive was your working capital days. That slipped considerably. What is the broad range we should be working with on a steady state basis?
The steady state, it will be 60 days. So this time it drastically came down because of the pent-up demand for the cooling products and and also the highest churn for the mobiles.
Okay. All right. So we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Electronics Mart, quite bullish in terms of FY27. They're expecting revenue growth of around 20% and EBITDA margins, I think, of around 7% is what they are guiding at this point in time. So down around 0.7% currently for that particular counter. For the market, still subdued, as you'd have to say. So the mid-cap index is not really extended in terms of losses. It's still cutting. It's still sitting with a cut of around 0.4%. The Nifty down around close to 100 odd points. 24,200 has now broken, so it's below that level for the Nifty. Advanced decline ratio on the declining side.
Well, that's right. Ekta, a few stocks actually from the broader markets are catching your attention. The newly listed company, that's Milky Mist. Just take a look at that. That's now moved to the high point of the day. It's up close to around 30%. Physics wala, the stock was up, I think, just 1% if I saw it at the start of this hour. Now, that spiked to the high point of the day. So good move is what we're seeing out there. The newly listed company as well, Turtle Mint. I'm calling for intraday charts, so we should get that up for you on the screen. You have Turtle Mint as well as Physics Wala. Both of them actually have seen a bit of a spike, in this hour itself. So good move out there. And Restaurant Brands Asia, that's probably been the stock of the last 1 month. It's seen a big surge. The stock, if I'm not mistaken, is up close to around 50% in a matter of a month. Yes, the 1 month chart actually will confirm that. And Subex, that stock is just a 16 rupee stock now. But we're seeing a big move out there. The stock is up close to around 18% or thereabouts right now. Volume's very large, so that's why that's coming up on my radar. And Jindal Drilling could be another name that's now up close to 9%. So plenty of action taking place in the broader markets. But for the time being, the Nifty has moved to the low point of the day. We're down 100 points odd. But that's it from Ekta, myself, and the entire team that put this show together. Chartbusters wraps up, but we have Trading Hour that comes up next. Stay tuned.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me, as always, Ritu Singh. The index is now at a very, very important level. As of now, it's 24,200. But the bigger takeaway is the fact that today is the weekly options expiry, and that is what also puts the cash into greater significance. As we saw in yesterday's session as well, instead of a recovery from the lows, the index fell off the highs at the conclusion of cash. So today's session will also be very closely monitored, particularly so because of the expiry day. The only negative trigger as of now is the rise in oil prices. Otherwise, the market continues to remain devoid of any directional cue, especially considering the fact that earnings season has come to an end. Hi, Ritu.
Hi, Hormaz. Yes, that heavy earnings season finally coming to an end. We still have a few managements to get through too. But, the negative trigger, like you said, that is the higher oil prices. That's definitely adding to the negative sentiment. You have oil prices that have now risen above $90, $91 a barrel. In fact, $91.50 as we speak. And that follows the expiration of that ceasefire agreement between the US and Iran. So what happens there is going to influence which direction these prices go. And on the back of that, you're seeing rupee also under pressure, weakening to about 95.66 against the greenback. This is marginally lower compared to yesterday's close, but it continues to remain under pressure, and so do the GSEC yields. They've now actually risen to a near two-week high, around that 6.8, 6.81% handle. But for the markets, look at the market breadth. You have about 1,700 stocks that are declining for about 14, 15 stocks that are on the advance. So market breadth shows you there is weakness. The IT pack continues to remain a big drag, down by 1.3% as we speak, and the bank Nifty also above, just above that 57,260 odd mark, trading with cuts of more than 230 points as we speak. The broader markets also under pressure, small cap just about there. But let's go across to Hormaz to put the spotlight on specific names that are moving the market.
At a very important level, as we just highlighted for the index right now, that slow grind down continues even in today's session. 24,200 is that level on the index that it needs to sustain above to have any form of support before collapsing towards that 24,000 mark on the downside. That's what the analysts have been telling us through the day. 24,230. So the gap between the spot and the futures is now down only to 30 points as of now. So it's that gap has been narrowing, as was the case over the last couple of days, where the gap was fairly wide since the implementation of the cash. But 24,200 is that level that the index participants need to watch out for. Back to the lows of the day is the Nifty. You look at the Nifty Bank as well. The Nifty Bank opened in positive territory, in fact, and that also shows the reason why the Nifty was higher for a brief period. But then that positive momentum fizzled out very, very quickly. The Nifty Bank is also now down 250 points, but the fact that every time the Nifty Bank has moved towards that 57,000 mark, it has seen some buying that has come in. So it remains to be seen whether that happens in today's session as well or not. Even here, the spot futures divergence is anywhere between 125, 130 points as we speak. But the Nifty is going to be the bigger index to watch out for, considering the weekly expiry in today's session. Real estate as a sector has been sulking, seeing some profit booking. All of these names, Godrej Properties, Lodha, DLF, they are slightly off the lows of the day, but still down anywhere between 3/4 to just over 2%. IT as a sector as well has been sulking. It didn't do well yesterday, not doing well today as well. Infosys is now down 2%. Infosys and Coforge also trading with losses of around about 1.5%. But the activity in the broader markets continues to remain stock specific. And Paytm saw a block deal earlier in the day. Only the base size, the base portion of the block deal the transaction took place only for that 3% equity. So around about still 1% lower on Paytm. Colgate, the analyst day commentary, the street not very enthused by it, 2.5% lower. Tube Investments, well, Sudarshan spoke about this on closing bell yesterday with the conference call takeaways, and those were on the positive side as well. The stock 8% higher in today's session, and Physicswala continuing to move higher from where it left off in yesterday's trade as well. Capital market stocks are not doing well today. Nippon Life India, Grow, Angel One, all of them under pressure. Motilal Oswal was up around 5 to 6% in yesterday's trade. That too is witnessing some profit booking in today's session, down anywhere between 2 to 3% are all of them. And at record highs today, Netweb Technologies has launched a QIP at a record high. The floor price is also at a 6.5% discount to yesterday's close, so that is still higher. RR Kabel is at record highs, Neogen Chemicals is at record highs, and Nitin Spinners among the textile names is doing well for itself as well, Ritu.
All right, Hormaz, thanks very much for running us through that list. Let's bring in our first management on the show. We have Knowledge Marine and Engineering Works. They will focus on the back of their first quarter numbers. So let's bring in the management to get a sense of the quarter gone by and the way ahead. We have with us the CEO of the company, Sujay Keval Ramani. Sujay, thanks very much for joining us here on CNBC TV 18. And let me just start with how the year is shaping up to be now that you're well into your first quarter and in the middle of your second quarter as we speak. The top line, the bottom line, the margins, order inflow. How is all of that shaping up to be for the full year?
Thank you, Ritu. Good morning, and thank you for CNBC to give us this opportunity. This year, the first quarter has been the record quarter. It's been the best numbers the company has delivered in its lifetime. And with the government support and the kind of order book that we are building and the orders in pipeline, we are projecting higher and higher growth year on year. So this year is going to be very phenomenal for the company.
Got that. Could you give us a sense of in the first quarter itself, which has been good for you, in terms of the top line growth? If you could break up for us, what were the biggest contributors segment wise and going ahead as well? What are the fastest growing engines for you?
So in the first quarter, the numbers really got a push from the dredging business. And as the year progresses, the shipbuilding will be a bigger contributor going forward as well. In the dredging segment, we are concentrating on larger dredgers and larger volumes by entering into the maintenance dredging segment, wherein the volumes previously done by the company in the last 5-7 years, we are trying to grow those volumes. And with the volumes, the revenue will grow and the margins will be maintained. So the real push will come from dredging as well as the shipbuilding business.
Okay, dredging will be the real, big contributor, followed by shipbuilding. Quick word on your EBITDA margins as well. I think you'd earlier in your interview told us that you will be able to sustain it above that 35% odd mark. But the first quarter, you've gotten to 64%. So then here on, some moderation if you're still sticking by your guidance?
So we always have been guiding between 35 to 40%. There was a spillover of some revenue from the last quarter of the last financial year into the first quarter of this financial year. But taking into account the expenses, even after, our margins have expanded from a guidance of 35 to 40%, beyond 50%. So we believe the guidance, we will stick by that. But as the year progresses, there is high chance that the margins will expand with the volumes in the business.
Sujay, what is the kind of order inflow that you have received so far this time around? Your order book at the end of FY26 stood at close to 1,100 crore, 1,400 crore, beg your pardon. What's the kind of inflow that you are targeting this time around in FY27? And how much have you already received in the first quarter and a half of this year already?
So the present order book currently stands at 1,600 crores, and the bid pipeline is 3,000 crores as of now, with dredging standing at 900 crores, the chartering business at 1,000 crores, and the shipbuilding at 1,100 crores. We have had a track record of converting our bid pipeline into orders of approximately 50% and beyond. So we plan to continue doing that. Out of which 3,000 crores bid pipeline, we believe at least 30 to 40% will get converted in the coming year itself.
Fair to assume that it will be 1,500 crores this time around?
Yes.
All right. And since you mentioned shipbuilding as well, what's the current capacity at which you are operating? And is there an expansion plan in store? What's the kind of capex that you have planned for this one?
So shipbuilding did a turnover of 25 crores in the last year. This year, as the plan progresses, we are planning to surpass more than 100 crores of turnover in the shipbuilding segment with the current orders in hand. If the way the order book plans to expand in the second quarter, then it will surpass the projections that we are giving even now. And the capacity that we currently have is to manufacture 14 vessels per annum, and we are trying to expand it to 16 vessels per annum before the close of this financial year.
Got that. Just one last word on your fundraising plans. I think you had indicated about 150 to 175 crores is what you were looking to raise. How quickly would that happen?
So the fundraising has been completed. We raised 150 crores through the pref round, and we had good institutional investors who participated in the round. We have got the funds, and we have started deploying them for our capex plans already.
Okay, wonderful. Thanks very much. We'll leave it at that. And thank you for joining us here on CNBC TV 18. Well, let's slip into a short break. Up next, we're going to focus on the bond markets with Manisha Gupta in just a bit.
Welcome back. As promised, let's shift focus to the bond markets then. Manisha Gupta is here with the latest. Manisha.
Thank you so much for that. Well, the markets have reacted to the RBI's decision to close the special FCNR deposit scheme withdrawn early. But what the street will now watch out for is the foreign inflows and whether or not there is an impact on the systemic liquidity and whether these inflows actually come into the bond markets or not. Having said that, there's a lot of cues also coming in from the global markets. You have the crude oil prices, which are back above at 1-month highs, above $91 a barrel as well. And then it is going to be about the geopolitical tensions as well, where we have seen more statements come in from Iran and US and Oman as well, especially from US, which is threatening to bomb Oman if it gets into negotiations between US and Iran when it comes to Strait of Hormuz. So all of these segments also, or statements rather, which are also keeping all of these markets jittery therein. But as always, there's a list again for today for private bond issuances. And first of all, I want to talk about the board of Poonawalla FinCorp, which now has approved allotment of around NCDs worth, which is 3.15 billion. The debentures carry a fixed coupon of 8.09% and it will mature in 2029. The other company which is also coming out with its bids trying to raise money is John Deere Financial India Limited. They are looking to raise nearly 3 billion and they're doing it via issuances of 3-year bonds which are maturing in 2029. Well, the coupon on the bond is fixed at 8.10% and the bonds are AAA rated by CRISIL Ratings therein. Vivinti Capital should come in on your screen as well. They're looking to raise 3 billion and they're doing it via issuances of bonds which are maturing in 2032. The coupon on the bond is fixed at around 8.30% and AA plus rating from CRISIL Rating is what this company as well enjoys. And finally, Sundaram Finance should come in on your screens because they are looking to raise 7.5 billion. They are doing it via reissuances of 7.74% July 2028 bonds. Well, the coupon on the bond is payable on an annual basis and the company also enjoys a AAA rating from CRISIL Ratings therein.
Manisha, thank you for those updates there. Still fighting to hold that 24,200 mark is the Nifty. Take a short break. On the other side, a quick chart check and some trading ideas with Jai Thakkar from ICICI Securities. Welcome back. Below the 24,200 mark now, still fighting, struggling around those levels is the index. So around about 90 points lower is where we stand currently on the weekly options expiry. It's good time to get in Sudarshan, who's at the FNO desk, who will tell you the latest trends from the futures and options market as well. Sudarshan.
So as you have said, Nifty is trying everything to protect the level of 24,200. It's very important support zone that Nifty has formed over the last two trading sessions. But what is negative is market breadth, and that's because of the mid-cap underperformance. Over the last few days, we had seen that mid-cap index had outperformed benchmarks, but today, because of mid-caps underperforming, market breadth has turned in favor of declines. Another negative part is the Nifty Bank. That's also not supporting market, and that's the reason you are seeing the Nifty just hovering around the level of 24,200. But technical, if you just go by the technical levels, we might see a recovery, mainly because of the Nifty PCR. If you see, you can see that now it's at 0.71 versus previous day's level of 0.98. Normally, when it's in the range of 0.60 to 0.7, we say it's in oversold zone. So don't be surprised if we see recovery in the second half of the trading session. Now coming to the options data. On the put side, if you take a look, 24,200 and 24,100 are seeing maximum change in the open interest. At the same time, premium for both these two put options has seen an increase. Now, call 24,250 and 24,300 are the most active. So it tells you the range from 24,150 to 24,300. So support 24,150, resistance 24,350. As far as Nifty Bank is concerned, today it slips below both 20 DMA as well as 200 DMA. Now support is forming around 57,000. As far as resistance is concerned, it's 200 DMA of 57,472. Some of the stocks that are in focus, Tube Investments. Remember yesterday I was talking about the commentary was positive in the con-call, and that's the reason stock is seeing addition on the long side, up more than 7% currently. Now, hedging plays on between BSE and MCX. So you are seeing addition on the long side in MCX, and you are seeing addition on the short side as far as BSE is concerned, and this counter remains weak over the last few days. And last one, Cochin Shipyard in the last 1 hour has seen a sharp up move, and also it has started seeing addition on the long side.
All right, Sudarshan, thanks very much for getting us that update. Perfect time to bring in Jay Thakkar from ICICI Securities for a quick technical check of the markets. Jay, the Nifty is broken below 24,200 as we speak. The Bank Nifty is not lending much support, nor is the IT pack. What are the near-term levels you'll watch out for? Where do you expect the markets to go from here? And your top stock calls for the day.
Hi, good morning to you, Ritu and Hormaz. Nifty has been falling slowly after having reversed from 24,600 levels, Ritu, and this has happened for almost third to fourth time, wherein we have seen that Nifty was unable to surpass convincingly the levels of 24,600. Is quite close to the 200 DMA as well. But then positively, what we have seen is that the Bank Nifty relatively is outperforming as of now in this fall overall, because there, if you see, the 56,000 to 58,000 levels range is quite maintained. So I think that for this series, the remaining part of the series, which is just 1 week to go from today, I would say, Ritu, that 24,000 levels on Nifty should be held on a closing basis for this August series. Hence, from these levels, the risk reward is on the long side. Although you don't have a major target on the upside until 24,600 levels are taken off. So you can see that 200 points lower from the current level is where the support is, and 400 points on the upside where the resistance is. So that's 600 points range for the remaining part of this August series. So I think the risk reward is favorable on the long side out here. You can buy now, you can add on dips as well if at all it falls further to 24,100 odd levels, placing a stop loss below 24,000, targeting 24,500 to 600. And Ritu, I would say that, see, the overall implied volatility or the India VIX also has been pretty much in the range of say 11 to 13 and a half. And as of now, although it's at the lower levels, the risk is there that it can bounce back anytime. But I don't see it going above the levels of 15 as well, because of which I think that 24,000 levels holding up or going forward will be quite high. Now, stock specifically, if you ask me, then Cummins is one stock which I think that post results, whatever the correction had to happen is happened, and now from these levels we can see a good upside from the current levels. So 56.50 to 57.50 are the levels which I would be looking out as a target on a positional perspective, placing a stop loss below 50 to 80. One can go long on Cummins. The second buy recommendation out there would be on Dixon, Ritu, and Dixon recently had performed quite well. I would say there has been a very strong recovery, and from here on to, I think that until 13,800 levels are held on a closing basis, you can see this move towards 15,000 as well positionally. So I think Dixon and Cummins, these are the two stocks going forward which can give or deliver good returns in the short term.
Jay, thank you for sparing time and joining us today. Views on the index and some trading ideas as well. Take a short break. Continue our conversation on the markets with Varun Sharma from Motilal Oswal Mutual Fund on the other side.
Welcome back. The markets are at their low point of the day now, fallen more as we speak. 24,185 on the Nifty. That's a cut of about 100 points. From in the trading day today, 0.4% lower. The Bank Nifty also trading with cuts of almost 0.4%. The small cap index has also slipped into the red. It was barely holding up in green as we started the show at 11 a.m. Now trading with cuts of about 22 points. So weakness in the broader market. The market breadth also seems to have worsened a tad bit from where we were. So you have about 1773 stocks on the decline to about 1379 stocks that are advancing. Sectorally, look, just look at some of the names that are still holding up. The pharma pack, auto pack, energy and media. These are sectorally some of the indices that are still in the green, but pretty much everywhere else led by, the IT pack, the real estate index, the PSU banking pack, FMCG, all of that is in the red. Let's also quickly pull up the contributors chart, if you will, on your screen. Some of the top drags on the Nifty today. You have heavyweights like HDFC Bank to Infosys, Bharti Airtel, ICICI Bank. All of those have been big drags in the market. Whereas on the other side, the big boy Reliance, that is contributing to the gains about 10 points. Axis Bank, M&M and Bajaj Finance are some of the other gainers. But let's get in our guest on the show. We have Varun Sharma from Motilal Oswal Mutual Fund, who joins in from Motilal Oswal's 22nd Annual Global Investor Conference to talk to us about market fundamentals and his top sectoral picks. Varun, thanks very much for your time here on CNBC TV 18. Got to start by asking you about the earnings season, since it's been pretty spectacular. What stood out for you? And, what would you really stay away from, irrespective of the performance in the first quarter?
See, I think a lot of things, when we look at some of the themes in India which are germinating and emanating and growing pretty fast, you have the entire AI-driven data center wave and the entire value chain where you have a lot of companies growing phenomenally. Then you have parts of manufacturing, be it precision manufacturing or aerospace, and even the electric vehicles-driven value chain. We are seeing phenomenal growth over there, and even earnings responding to the headline growth. And finally, we have the digital ecosystem, where growth rates are anyway, very good, and most of the companies we are seeing today have turned, either break even or are profitable. So all of these areas are quite, I would say, constructive right now, and we are quite optimistic on these spaces.
Varun, thank you for taking our time. There has been this broad consensus that if there is value to be found right now, it is going to be large private financials, at least for most of the market participants who we speak to. But the fact of the matter is that most of these large private financials have done anything but deliver returns over the last 2 to 3 years. The largest private banks have all been underperformers. Do you still continue to bet on a sector like this, hoping that things will turn around sooner or later? Or do you believe that there is still better value to be found in other pockets from within the financial space?
So see, clearly we subscribe to the view that there is better value in other pockets. But I think we have to change our approach now to looking at companies and sectors or even subsectors, deeply, not looking at everything as a pack, because whenever we are looking at something as a pack, especially in the larger spaces, essentially, it turns out to be mean reverting, and then it's very difficult to generate good returns. So what we are doing is that we would recommend that we look at business models and sub-segments and figure out where are the spaces, where we have growth, instead of treating everything as a pack. But as I said, there are other areas of opportunity here, and those are the hunting grounds for us to find growth and value.
Varun, what are these other areas of opportunities then? So I'm taking you don't like large private sector banks. So what within the financial space do you think offers better rewards? What about some of the new age companies as well? I mean, these Pine Labs and Paytms on the back of this potential MDR possibly coming in, is that overdone, or where do you see pockets of value?
See, lots of spaces. Digital is definitely one of the spaces. Technology, in finance is leading to a lot of companies scale up faster, and we are seeing the growth rates differ from the sector itself, and materially better. Then you have the entire microfinance situation, wherein the good players, the disciplined players are actually gaining market share and are showing much better growth than the entire space itself. So those are also areas where we can find opportunities. See, the entire financial space, if you look at the entire technology layer that we have today, and the names that you mentioned, clearly, newer companies are coming up as well, where we are finding these opportunities. Then finally, even the mid-sized banks is, as a layer, is something that we are finding quite attractive, because people or companies and managements have chosen their areas where they want to grow, and some of them are actually demonstrating good growth with good, execution discipline. So there are several areas where we are finding these opportunities, as I mentioned, all of these.
Varun, what about the textile space? There has been a lot of chatter with regards to the FTAs, the implementation, the benefits for the entire space here as well. Or actually, even for that matter, the Alcobev space, which is also a potential beneficiary of these FTAs that are being signed and implemented. Where within textiles, or are you bullish on either of these two spaces, textiles and Alcobevs?
See, it's a similar situation that instead of taking the space as a whole, we are constructive on the space given the FTAs that have been signed. But instead of taking the space as a whole, we have to go company by company and understand their exposures. Where is it that they can benefit? There are certain hope stories as well as to where, a big maybe, an order pipeline can come through and benefit a lot of companies. There is a bit of wait and watch here as well as to, where some of these companies can actually capture or capitalize on the opportunity. So I wouldn't say the entire space, but yes, it's quite a, constructive space for us to look into and find opportunities, and we are finding opportunities here.
The IT sector as well. I mean, it's been down, it's been beaten, it rose up, down again. What's the view there?
I remember we had this conversation last year as well. See, if you look at the overall technology space in any country, IT services is actually a fraction of that. It's just that in India, IT services has become quite big. But when we are looking at technology in India, we are looking at the broader technology ecosystem, whether it's digital, whether it's internet, or software and platform plays, and not IT services. Perhaps the industry, IT services industry has become so big, Indian industry has also become so big that the scale and base of companies is becoming a challenge for them to grow because the global industry grows, in low or mid-single digits. So that is not something that, we would look at, not in the near term, not even in the medium to long term, unless there are certain smaller companies which have a differentiated strategy to grow faster. Otherwise, we will remain, we will stay away from this space from an investment standpoint.
Varun, pleasure having you today. Thank you so much for spending time and joining us on the sidelines of the conference. Wish you good luck for the entire duration of the stint there as well. Take a short break. Back with more on the markets on the other side.
Welcome back. You're watching Trading Hour, and the big talking point in the hospital space of late has been that parliamentary committee recommendation, which has prescribed lower costs through capping room tariffs and a whole lot more. So here's a view from the top voices in this space. Take a look.
This report is worrisome, and it is worrisome because of the kind of thought which has gone in it. I think it is probably based more on anecdotal instances on which the report has been made. So there are a lot of dichotomies in the report. One side, we are saying that India is a destination for medical tourism and we should promote it. Why? Because we are very economically, we are providing the best quality services. On the other side, we are saying that the healthcare is very expensive. I think we are confusing the two issues of affordability and the the actual real cost of delivering healthcare. So I think the report needs to be evaluated a little more in detail. And there are certain elements of it which probably are implementable, and there are certain elements which are not. But parliamentary report is only a suggestive report, and the policy decision, of course, has to be taken by the government. I believe that they will be a little more rational, and they would do wider consultation with the industry before they decide on what to do.
Cap the room rates. It does not address the core problem that the government wants, which is healthcare is unaffordable for a vast majority of people. That is because people are paying out of pocket, which is not sustainable for a country of our size. We have to start looking at different methods of payment, such as insurance or employers paying for healthcare.
There's some flashes at the bottom of your screens. The Defence Ministry has notified the 6th list of indigenization, and that includes 16 items of the Indian Coast Guard and 389 items of defence PSUs. So all of these defence companies back in the spotlight yet again. We'll get more details on this in just a bit. But of course, we take a short break. Back with more on the other side. Stay tuned.
Welcome back. Let's get you some more corporate opinion then. We have Yashish Dahiya, the founder, chairman and group CEO at PB Fintech, joining us now from the sidelines of that 22nd Motilal Oswal Annual Global Investor Conference. Thanks very much, Yashish, for speaking to CNBC TV 18 and joining us here. Your first quarter growth was pretty good at 40%, especially given that the first half is generally softer. So what should we expect for the full year with the stronger second half still ahead?
See, I think we always believe it is very hard to deliver more than 30% growth in the long run. So our future prediction is always around the 30% kind of growth. But historically, specifically in our areas of health and term, we have been able to do more than 45% growth over the last 4 years, every year. And I think currently it's continuing. Now, it's very difficult for us to ever predict longer than one quarter on such high rates. So we always talk about a 30% growth. So I would stay with that.
Yashish, now the GST reduction has resulted in a strong offtake in terms of in term and health insurance. Now, how has both of those segments worked for you post these changes?
See, my view is GST came in September. And I think everybody saw 1 or 2 months of great growth because of GST, after which the customer was not, from December onwards, GST has not been in the consumer's mind. It happened and it went away. After that, it is the industry has been sustaining growth somewhat on its own. And I think the industry still continues to do that. So the industry has delivered good growth. And we, of course, because we have a slightly more marketing, more customer education oriented platform, we are able to grow about 2 times that of the industry. So I think that is coming. But I would say GST was a factor in the quarter from September to December. But I don't know of any customers who from January onwards were even talking about GST. That happened and it went away. So now we are in a post-GST world. And that's fine.
Take that point, Yashish. This recent Supreme Court ruling that talked about adding 1 year each to the mandatory motor third-party coverage. What does that mean for a company like you? Would it mean 1 year less of premium, which will now go to OEMs?
Our main segments are health and term, which is a protection, voluntary protection area. But in motor, there are 2 sides to this coin. One is the extension by 1 year, but the second is the stronger compliance. Supreme Court has also said things like no fuel and, various other things. The last time there was strong compliance, we also saw a major fillip in the sales of, you are absolutely right, that we typically operate 3 to 4 years after the first policy, the new car, and we are operating much more in the older policies. So, let us see which way this goes, but it could go both ways. With stronger compliance, there could be a lot more take-up of insurance at the older end of because the stronger compliance usually matters to the older cars. And at the same time, yes, there could be a pool shrinkage also from, earlier missing out on 3 years to 4 years.
Yashish, now various reports are suggesting that the IRDAI is considering various things around distribution / commission regulations. Now, rationalization of expenses, putting segmental commission limits, effort-based commissioning. What do you think will be easy to take and what would be the most disruptive?
See, I will on this EOM, let me clarify a little bit. The regulator moved from commission caps to EOM about 3 years ago. There must have been a good reason why it was done. Since that has happened, expense of management of the companies has actually been coming down. More companies are complying with the expense of management framework than they were. There were, if I remember, if my data is correct, from the general insurance category, 16 companies were non-compliant in 2024. 10 companies are non-compliant in 26 on the expense of management. So it is all going in the right direction. Expense of management was a very progressive, positive framework which gave the companies the freedom that do they want to invest in their own marketing efforts and their own sales efforts, Or would they like somebody else to do that for them? That is their choice. A company can decide to spend on Google. A company can decide to spend on Policy Bazaar. A company can decide to spend, on their own employees or their own agents, whatever they wish to do. They have the full freedom. I don't believe that was a wrong thought process and that it does need to be reversed. But that's my view. Everybody can have their own view. And I feel increasingly people agreeing with this thought process that I'm sharing. And the actual thing that matters to the customer is the expense. So if we believe the expense should be lower, then that is the thing that needs to be touched rather than any of the other that we only want it to be done to a particular group or a particular. Now, on outcome-based or effort-based, I think it's a great idea, right? That there are some, I do believe remuneration should be linked to persistency, should be linked to outcomes. For sure, why not? But I'm assuming the insurance companies already do that to some extent. And of course, the regulator might ask us to do that more, and we would love to do that.
Well, Yashish, let's talk about something else that affects customers. You recently had the IRDAI chairman talking about, the fact that taking personal details like the customer's phone number, email address, all of that is a dark pattern, and that ends up creating friction. You at Policy Bazaar as well, you see contact numbers and email IDs of the potential customers. So how do you have to respond to the regulator's observation?
First of all, it is not for me to react to somebody that senior. I did go and speak with the Ministry of Consumer Affairs, and in my meeting, I was informed it's not a dark pattern. In fact, we need the consumer's details to be able to understand their risk better, to understand their profile better, to understand their credit score better, to understand their income situation better, because what quote applies to you and what quote applies to me, even if we were the same age and same health situation, could be very different depending on our background underwriting, number of policies we have, the amount of data that IIB has. So it's actually to consumer convenience that we provide them available policies only, rather than show them policies that they may not eventually get access to. What's the point of showing a customer a policy which they may not eventually be able to get? And there's a lot more done through the phone number than just collecting the phone number.
Yashish, what portion of your sales come from call center assistance?
Roughly 80% must come through call center assistance, if you're talking about health and term.
All right, 80% of the business from call center assistance. Yashish, thank you so very much for joining us here on CNBC TV 18. Always a pleasure having you. And, let's quickly pull up where the markets are at. 24,199 on the Nifty, so holding up just about that 24,200 odd mark, a few points here and there. So not much an improvement, but at least it's not slipping much below that as we speak. Pull up a few names that have gained in the last hour or so. Apar Industries is one such stock that's seeing a rise. MCX India as well. That's a 4% odd increase that we've seen. HEG also at a 52-week high as we speak, and DLF making an upward move as well. On the flip side, the stocks that are, trending downwards in the last hour or so, Chennai Petro still in the green, but it's, taken a turn, downward. Torrent Power also trading with cuts of almost 1.8, 1.9% as we speak. And PTC Industries, that's seen a sharp knock, about 4.6% down as we speak. So, the setup for the markets looking pretty much as we started. The volatility index at 11.6. The market breadth also shows you, more stocks still continuing to decline. Those lines are not really crossing. And the Bank Nifty and the IT pack continuing to be a drag on the markets, Hormaz.
Indeed, and well, if you take a look at some of the other broader market movers as well, where PG Electroplast is down around about 3%, is the top loser on the Nifty 500 as of now, and PTC Industries did fairly well in yesterday's trading session, seeing some profit booking in today's trade. The top loser on the Nifty 500 down around 5%. Take a leave on this edition of Trading Hour from Ritu and me. Thank you for watching. Halftime report on the other side.
Stocks drift lower as movement stalls in the Strait of Hormuz, driving up oil prices. Realty as well as IT are the big drags, while utilities and energy eke out some gains.
Paytm promoters sell shares via block deal for the benefit of Antfin, while Netweb Technologies and SPR Auto launch QIPs to raise 1,200 crores and 1,000 crore rupees respectively.
Jio relaunches its Prime plan with a one-year tariff guarantee as part of its 10th anniversary celebrations, providing a shield against tariff changes. Analysts expect telcos to revise tariffs by 10 to 12% in FY27.
Of hospitals, tells CNBC TV 18, the parliamentary panel report is worrisome and they expect wider consultation. They add that profits of players are barely adequate to drive capex and the core issue is insurance penetration.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Bhutra and Vinny Motiwala. Well, it's turning out to be a session which is a bit subdued for the markets again. So 24,200 is currently where the Nifty is at. We've dipped below those levels on an intraday basis, but we've just about managed to hold on to it. For the mid-cap index, it's lower by around 0.3%. We have the Bank Nifty, which is down around 0.3% at this point. So there's a little bit of a recovery from the day's low. At one point, it was down around 0.5%. You'd have to say it's a subdued session and courtesy Brent crude prices, which has spiked back above $90 per barrel. Hi, girls.
Hey girls, good afternoon. Well, continues to be a subdued day, but Bank Nifty is trying to make a recovery yet again, and that is something which is seeing a wee bit of recovery on the Nifty as well. Mid-caps continue to trade under pressure. The advance decline ratio is in the favor of declines, but a lot of stocks which are buzzing. For instance, we just spoke to PB Fintech, so Policy Bazaar is the stock which is at the day's high, but a couple of these stocks in the Nifty pack which are making lows of the day. So it is a very stock-specific day as well. We'll keep talking about these stocks, but we do have some guests lined up on the show and a lot to talk about the Hospitals Forum as well today.
Absolutely, a lot to talk about that as well. A lot of stocks that are moving around in the trading session individually. So we'll take you through all of that and let's talk about what's on the show today for you all, right? We'll bring excerpts from the top voices speaking on private equity as well as hospitals and get you the key takeaways from the hospital-centric CNBC TV 18's Market Forum. Then some stocks that are buzzing around, which are the top movers in the trading session. We will put the spotlight on all of that. New listing, Milky Mist also comes in, so we'll discuss that, as well as Colgate had their investor day yesterday. What were the key takeaways there? We'll discuss all of that in our movers and shakers segment as well. We'll also get you a conversation from the Motilal Oswal Investor Conference with Anupam Guha, Managing Director at Motilal Oswal Private Wealth, so stay tuned in for that. And in our Commodity Corner segment, we'll have Manisha Gupta, who will be speaking to SkyMet's Jatin Singh as SkyMet raises the drought risk. Let's go across now to Vivek for our first segment and he'll take us through the stocks that are buzzing around in the trading session this afternoon. Good afternoon, Vivek. Today, obviously, we do have the weekly expiry, but a lot of individual names that are moving in the trading session.
Well, thank you so much for that. Quite lackluster, especially in terms of movement, especially as far as the broader end of the markets are concerned. But of course, individual names are the ones that are making all the moves. First on the list has to be Tube Investments. Yesterday midday, the management actually held an investor call where they actually guided for a significant recovery as far as margins are concerned. Q2 onwards, the streak has taken note of that, almost 8% higher today. Indo MIM, that particular name, very strong Q1. Stocks done very well today on higher volumes as well, almost 10% higher. Netweb Technologies, they launched a QIP for a fundraise. Sources indicate that demand here is very robust and that stock higher by another 2% today. Milky Mist, again, another very strong debut as far as D Street is concerned, 30% higher for this new listing. And refining stocks, both MRPL as well as CPCL, both standalone refiners doing very well in the session today. On the other hand, quite a few drags as well. Can't look beyond Paytm, post the block deal, the stock sulked a little bit in trade. Expectations were for a 5% equity block deal, just around 3% have exchanged hands. Bharti Airtel under quite a bit of pressure, dealers or brokerages have gone ahead and indicated that there could be some further pressure as far as pricing is concerned post the new launch by Reliance. Colgate Palmolive, the management has indicated growth will come and analysts believe it will be at the expense of margins, so 3% lower for that particular name. And the entire IT pack, most of the names seeing a little bit of profit booking, so names like Infosys, HCL, Wipro, Coforge, all of these stocks anywhere between 1% and 3% lower today.
Okay, all right, Vivek. Thanks very much for that. In fact, you did speak about Colgate, and we're going to be addressing that particular counter. Vinny, you're looking at that because they've indicated clearly that they're looking at growth, and that would be at the expense of margins. So be it. Just tell us, what are the brokerages making of it, because the stock is down and out?
Absolutely. So, what came in from the con call is something that we've always seen coming in from Colgate, right? They want to focus maybe on premiumization, more growth, focus more on the tier 2 cities as well, and penetrate further more in those cities. Brushing 2 times a day is what they're betting on as well, and that continues to be focused. Premiumization probably is a trend that they're focusing on, increasing their ad spends, and that is why margins is something that could be under pressure. Now, what are brokerages saying this today? On the back of this, one, HSBC is maintaining their hold. They're giving a target price of 2,140 rupees. Obviously, premiumization push is encouraging, but growth outlook still is quite similar. So that is a concern, right? Because growth is still similar. They're focusing on it, but it's nothing that they've given a special outlook in terms of growth. Now, CLSA too, maintaining their hold rating. Target price is 2,024 rupees per share. Higher gross margins are something that are here to stay for the company, right? That's an indication that comes in here. More spending in terms of ad is driving the premium side of the sales for the company as well, and increasing the ease in terms of market access. So yes, there is going to be growth. So they've increased their growth guidance, but gross margins, that could be lower. And that's what CLSA is doing, lowering their estimates for FY27 and FY28 in terms of the gross margin estimates that they've kept. Jefferies too continues to maintain their buy rating. Target price is 2,650 rupees per share. So that is what is in terms in the update coming in on the brokerage front as well. For Colgate, recovered from the day's lowest point, but nothing exciting that's come in terms of a commentary, and a bit of a concern on margins, and that's why the stock is down 2.6% in trade.
Betting on brushing 2 times a day, I think. Yeah. That has been in their investor presentation all the time, because Indians don't do that often. But anyway, moving on, this is coming as a dampener for Colgate, this particular outcome, and some of the brokerages not so happy with some of the fundamentals as well. But Milky Mist, the new kid on the block, stock made a strong debut on the street. Rima is joining us now with all the updates. Rima.
Well, a very strong listing for a company which saw very strong subscription. The overall subscription was about 56 times, with QIB subscription being more than 150 times. So first, a little bit about this company. Well, it's called Milky Mist, but the company does not sell milk, not even a liter of milk, ever since the company was formed way back in 1993. They've always focused on the value-added category, which means your paneer, your cheese, your ghee, yogurt, and now increasingly even into chocolates. Paneer is still the hero. As of last year, it contributed about 30% to the overall revenues. Now, a financial snapshot. Last year, the company ended the year with a revenue of about 3,100 crore rupees. It's a company which has been growing at 30% plus for the last 2 years. Margins too have expanded, 12.2% in FY24, 13.2% in FY25 and 13.9% in FY26. So margins have expanded. Now, via this IPO, the company raised about 1,500 crore rupees, largely a fresh issue, 1,428 crore, a small offer for sale of 125 crore. Part of the proceeds from the fresh issue will go to bring down the debt, which stands at nearly 1,700 crore rupees. Now, we had a chat with the management on our show IPO KYC, where he basically said that Milky Mist has been growing at 30%, and they're confident that this growth is sustainable. So then we asked him that what about competition? Because every other dairy company is getting into the value-added space, whether it's Amul, Hatsun, Dodla. He said that the headroom is so much. Look at paneer as a category. 90% of the paneer market, according to him, is still organized, which means there is still plenty of headroom for all the organized players to grow. So he doesn't see intense pricing pressure. Secondly, for the company, they have only one factory. It's absolutely new age, and the capacity utilization is 35 to 50% across various products. So future growth can come from the same plant, same infrastructure, same overheads, which means there is operating leverage. They've in a way also got land for another factory, but that's still, to break ground, and the company has to formulate plans for that. The only concern for Milky Mist was in the valuations. Now, FY26, their post-IPO diluted EPS. So, the EPS that's listed is 2 rupees for last year. But because there was a fresh issue, that EPS number would have been diluted. It stood at 1 rupee 65 paise, which means just at the IPO price, the PE for last year was 85 times. That said, brokerages are expecting EPS to go up significantly. This is the DAM Capital note which came out today, and they see EPS going up from 2 rupees in FY26 to 5.6 rupees in FY29. So, but even then, right, at the current market price, after the bumper listing that we're seeing, the stock is still trading at 35 times forward multiple. The DAM Capital has a buy rating. They've initiated coverage. Their target price is 175. They say that yes, this is premium valuation compared to the rest of the category, but it is a category leader, especially in paneer and cheese. They have premium positioning, they have a brand recall, and even the gross margins are higher than peers by nearly 700 basis points, so in a way justify the premium valuations that they're ascribing to the company.
Okay, Reema, thank you so much for that. But on that note, we're going to slip into a very short break. After the break, we'll come back and we'll get you a conversation from Motilal Oswal's investor conference with Anupam Guha, Managing Director at Motilal Oswal Private Wealth. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. Let's get some more conversations going. Anupam Guha, Managing Director, Motilal Oswal Private Wealth, is joining us from their 22nd Annual Global Investor Conference. Anupam, good afternoon. Thank you so much for joining us. Well, a lot has been happening in markets, but it's personal finance at the end of the day, people's individual portfolios. And I was going through your newsletter as well, how you are stacking up your investors or clients' portfolio. Tell us, what is the portfolio setup looking like right now? There are many categories, but something from the mutual fund space, what do you think are some of the categories which would do well in the short term and the long term period?
Hi. So really from a client perspective, I would say that the last 2 years, given the muted, I would say, earnings and returns from the market, really a lot of discipline has come in terms of clients looking back into the portfolios and trying to correct the asset allocation, which typically is the framework for investing. So over the last few years, whatever have been the excesses, I think those corrections have been made in portfolios, I would say. And typically for a balanced investor, I would say, it's a combination of equity, debt, alternate, and commodities in some bit. So on, say, for example, the equities bit, really the allocation, at least our suggestion has been that, finally market rewards growth, market rewards earning, and which is where, there has been some bit of sector rotation that's happened for sure, which means that clients have looked at some of the sectors where earnings seem to be strong. The first quarter earnings have are coming out, and after almost 2 years, we are finally seeing earnings revival in that sense. In Nifty, it's close to 15% of earnings growth, mid cap 20%, small cap 30%, and we feel that the portfolios need to mirror some of the earnings that are coming in. Also, from a sector allocation, of course, you have financial services, you have pharma, IT, etc. And in each of them, really, so say, for example, in financial, it is about portfolio construction towards, I would say, more non-banks. In consumption, it is more discretionary, industrial, more new age, power generation, etc. So that's how the portfolio construct has been made. And it is through a combination in the listed space through either mutual funds, ETFs, or AIF and PMS, right? One other thing that, has really happened, courtesy, how the asset allocation frameworks have been, and the muted returns in equity, a lot of our investors in the fixed income space, have also looked at, opportunities like, say, for example, higher yield, product. Of course, depending on how nuanced you are as a client, and from a risk-reward framework perspective. So allocation like, say, a private credit or higher yield, where, one could expect slightly more, excess yield and cash flow, so those portfolios have got reject on the alternate side. Of course, gold as a hedge to the portfolio continues to be there as an allocation, and that's how, portfolio construct has been made.
Yeah, absolutely. A lot of changes that have been made in the portfolio construct over the last couple of years as well with the changing market. Anupam, good afternoon. This is Vinny joining in the conversation as well. A couple of things you touched upon. One, I want to know in terms of ETFs as well, right? That is something that has overall picked up pace. So how are you seeing your clients looking at ETFs as well? Is that something more interesting? Also, you have SIFs that have come into the play with HNIs, ultra HNIs, all of that coming into play. SIFs, alternate investment opportunities, how are all of this shaping up?
So the alternate space definitely is no more, I would say, a niche segment. It has become far more strategic in a client's asset allocation model and portfolio construct. And in that context, ETFs, I would keep it slightly differently because it is, liquid, it is easy to invest into, and you could really do you can play in a portfolio which is a combination of a top-down approach and a bottom-up stock picking approach. ETFs play a very key role in terms of core allocation and a top-down if you want to really play through low cost. ETFs really play a key role. But in a market like India, of course, you would also want to do bottom-up, portfolio building. And it is here that I think alternates play a key role, be it private equity or be it pipe funds, or say, for example, some of the other venture capital funds within the space, right? So the unlisted to listed, the entire spectrum. Sure. I think there is a lot of play, and for nuanced investors, and especially with formalization of family offices, right, where people are able to understand the risk associated with such instruments. We are seeing a lot of traction. The other thing is that, especially for business families, in their portfolio, given their own understanding of their own businesses, I think there is a fair bit of resonance in terms of some of the opportunities that we kind of showcase today to our high net worth clients.
Okay, Anupam, that point is taken. Just wanted your thoughts in terms of how you would approach the entire IT space now. It's lost around 20% this year. What is your sense in terms of what the way forward would be, and what are you recommending in terms of a portfolio allocation to your clients as well?
So from again, it will all depend on the asset allocation framework and the capital allocation. But within that, of course, in IT, our preferences have been to new age companies and moving away, I think, or allocating more towards, more mid-cap oriented stories there. But finally, as I always say that, markets are slaves to earnings. And really it is about the earnings revival that we will have to look at. And, and especially with the entire, AI trade coming in, IT, of course, has come under pressure for sure. And we will have to see how they transform themselves, to the application-based model for, performances to come in. So it's more wait and watch, I would say, than anything else on the IT bit.
Take that point, Anupam, and a lot more questions, but we are completely out of time. But we'll have this conversation soon again. So many alternate investments, asset classes coming to the fore. So should they make part of an investor's portfolio or not is the big question. Thank you so much for joining us today. But with that, it's time for a break now. Sachitan Nutekar of Trade Bulls will join in with some trading strategies on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 24,200, just holding on to 24,200 as of now. 0.3% of decline, recovered from the day's lowest point, but we'll keep an eye on where it's going to be ending the day because it's Nifty weekly expiry. With the broader end of the market, that is also not doing anything exciting. So let's keep an eye on all of these. On that note, let's bring on board Sachidanand Dudekar, Vice President Research, Derivatives and Technicals at Trade Bulls to understand more in terms of levels that we should watch out for. Sachidanand, good afternoon. Thank you so much for joining on the show as always. What are the levels you're keeping an eye out on for Nifty as well as a Nifty Bank? Both of them are seeing a bit of a decline, and Nifty has been seeing a consolidation in the last 6 odd trading sessions as well.
Good afternoon, Vinny. I think the Nifty has started rebounding. The data is suggesting that we may see an eventual close above that 24,300 mark. If you look at the overall construct, in the last 7 trading sessions, we have already seen a gradual decline. The Nifty has started, consolidating near its 50-day exponential moving average support, which is around 24,180. I think this particular support would be defended today. Now, on the higher side, we are expecting a move towards 24,300, followed by 24,375. So we are expecting that this is a good zone wherein some long positions can be committed. From a trading perspective, intraday perspective, one can keep a stop loss at 24,180 and build some long positions for an eventual target towards 24,300.
Okay, all right. And in terms of specific stocks, Sachidanand, what are you recommending?
Well, we are liking Reliance. This is something that we have recommended to our clients for the last few trading sessions. We have seen a good consolidation here. We saw a good, rebound from the 1300 support yesterday as well. We saw the closing above that 1320 mark. So we are expecting a good steady move when it comes to Reliance. One can keep a stop loss at 1317 on closing basis. Expect a move towards 1340. Followed by a quick move towards 1366, where its 200-day exponential moving average is also placed. The other stock that we are liking right now is HDFC Bank. The movement has been very gradual. But if you look at the 30 minutes, 60 minutes data, there is a positive divergence on its RSI. So we are expecting some reversal here. One can keep a stop loss at 720 on closing basis and expect a move back towards 745.
Okay, Sachidanand, thank you so much for joining us with that take on some individual names and the overall index levels as well. That's the technical check. Some pressure coming in from the Bank Nifty as of now. Time for a break now. In a Commodity Corner segment, Manisha will speak to SkyMet's Jatin Singh as SkyMet has raised the drought risk. That conversation on the other side.
Welcome back, and joining us on the show now is Jatin Singh. He's founder and chairman at SkyMed. Jatin, hi, thank you so much for joining in. Well, as far as the Indian monsoon goes, every month, especially the month of June, the onset month was pretty bad. August seems to be the same way. And whatever monsoon or rainfall that we saw in the month of July clearly doesn't suffice, does it? Jatin, you're on mute. We can't hear you.
El Nino pattern that we had talked about, if you remember, in December 2025, we had clearly mentioned this was going to be a below normal monsoon. Now, as I've always said for years, that in an El Nino year, there is a 60% chance of below normal and there's an 80% chance of drought. And drought, as in a drought, is a definition where the total rainfall is less than 90% of the long period average. That was the standard that the government of India or the IMD used to have for droughts till 2016. I still think that is a very good standard. Right now, the IMD has shifted to deficient. I'm not really sure what is the thinking behind it, because drought is a great calibrator for all of us and has been for over a century. So the idea was, is this going to be a below normal year, and is this going to be a drought here? And models don't really tell you that, how bad it is going to be, except for the fact it's going to be bad. Also, climatologically, if you look at any of the El Nino years in which you had suppressed rainfall, you have either August or July failing. If both months are good, then you will not have a drought. And so it was very hard to figure out. So that's why we saw about 15 days of August. On the 1st of August, I think it was about minus 11% or so, and now it has gone to 13%. You've had 6 to 7 millimeters of rainfall. It's been slightly below par every day for the last 15 days. But over the next 15 days, we're not seeing a lot of good rainfall, and we'll see that number coming down. And September most likely will also be suppressed because you have a strong El Nino, canonical El Nino, a traditional El Nino coming in the South Pacific. Also, we were taking time because there was a less than 20% chance that the Indian Ocean Dipole would actually help. The Indian Ocean Dipole did turn positive, but it's uncertain positive. Generally, what happens is, I've seen this in 2019, and probably what happened in 1997, was in the Indian Ocean Dipole, the waters around the Indian Ocean becomes very warm very fast. This is something that computers are not able to exhibit very well. Okay. But it has not happened. And right now, where we are putting on the 18th of August, if you want to go to normal, you have to make up for the deficit of June and for the deficit of August that has already happened, and for the deficit that is going to come. So that is highly unlikely. So we think it is going to be a drought, so to speak. There is a 70% chance of drought.
70% chance of drought.
70% chance of drought, yes.
Jatin, there also are concerns that we could be looking at an early withdrawal of monsoon this time around?
That we'll have to see. It's very hard to say. In 2009, the rainfall did not come back after August, so there's a probability of that.
You talked about El Nino, and well, yes, this is an El Nino year where you also have put in a strong to very strong category moving on when we do it in month of September. Going forward from there as well, because Rabi is going to be in focus after that, how are you looking at the months presiding after September?
I think wherever going after September, going into Rabi, wherever you don't have a strong source of irrigation and you're dependent on requisite moisture coming back, retaining from the monsoon, there will be problems. It is not so true for Punjab and UP and Haryana, but for southern states, they're all the Narmada River, the Delta systems are all monsoon-driven systems. So that stress will be there. And central.
You also revised on the downside the overall monsoon for monsoon 2026. Where does that leave us really for the month of August and September then?
I mean, we're looking at about 85% of the monthly average that will be maintained for September as well as August.
This is, of course, 1 year. Are we looking at lower monsoons as we go forward from here? Is El Nino, how long do you see the El Nino to begin with?
For us, we are affected now. The El Nino can go well into January next year. But generally, you do not have back-to-back monsoons. It's a very rare occurrence to have it. It's happened, I think, in 1966, 67, and in 14, 15. when you had El Nino in 14 that broke, and then you had another El Nino that came in 2015. But it's a very, very rare event. Generally, successive droughts and successive El Ninos are statistically rare.
Also, Jatin, what states do you see a more problematic issue coming in from? Because we're in Maharashtra, I understand we are looking at lower rainfall already. Gujarat, Rajasthan, perhaps. What states are you really watching out for when it comes to concerns?
Northeast is already not doing well. I mean, the curious case is Assam floods. Assam is actually the monsoonal precipitation is well below normal. From our breadbasket point of view, I would say Maharashtra, all of it, MP, UP, Bihar, Andhra, Karnataka, Telangana, the whole area. I mean, going by right now, if you go to the IMD map, they're all green. Marathwada is only red part, but by the end of this month, that situation is going to change.
Jatin, that would mean that whether it's about power or whether it's about agriculture, whether it's about rural economy, we are looking at concerns in all of these places.
I mean, if you do a historical study, a simple correlation will tell you that drought knocks out 1% of GDP.
No, that's quite a number there. Jatin, also that's of course is a concerning point here. Jatin, when we look at the forward months now coming in August, as you said, the next few days perhaps wouldn't give us much of a monsoon, and September you've even put lower than that. 70% of a drought, that leaves us with a very less probability of perhaps a below normal to a normal, and absolutely no possibility of an excess rainfall.
No, there is 0% chance of excess. Okay, there's a 20% chance of below normal. There's an 80% chance of below normal. There's 60% chance of drought, which has now become 70% chance of drought. So your best case scenario is a 90 to 95. That is a 2023 monsoon. Your most likely scenario is below 90 right now, which is clearly putting you into drought territory.
That clearly is a dampener right now coming in, Jatin, from SkyMet right now. Thank you so much for joining in. So clearly, with the kind of numbers that we are working with,
1% of the GDP, it doesn't look big, but it is a big amount.
It was only previous quarter that we were talking about on how rural economy seems to be coming back now. But with this, if August is like this and September is going to be even weaker, we clearly are looking at much bleaker numbers there.
It affects every segment of the market.
Jatin, you were saying something.
Jatin, you were saying something?
No, what I'm saying with this is a simple correlation analysis. Generally knocks off 1% of GDP. Then there are these known issues of food inflation, and but so far food prices have actually not gone up. Although we've had higher fossil fuel prices, that's because government controls a lot of food stocks, manages the food supply. But these are known things that this is averages over the last 60, 70 years. At some point, that stress is going to show.
Yeah, it will, and we'll, of course, talk about it in monthly inflation numbers as well. But Jatin, thank you so much for joining us with all those details. Thank you, Manisha, for taking us to this important conversation. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on this markets, talk about some stock-specific action as well. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Nifty is where it is, right? 24,000, just below 24,200 as of now. Let's watch out for where it's going to be headed. But let's talk about the healthcare space, right? Last evening actually, on CNBC TV 18, at CNBC TV 18, we had the healthcare market forum as well. And a lot of key highlights came in on the hospital front. Ekta, take us through those key highlights. What were the ones that were standing out for you the most?
Well, obviously, the big news with regards to what's taking place in the hospital space is the parliamentary recommendations on healthcare, which came out a couple of days ago. Now, we did quiz all of the top CEOs with regards to that, and a couple of important takeaways. So, Fortis said that, we're confusing two issues when it comes to this: affordability and the real cost of delivering healthcare when it comes to these recommendations. Jupiter, which is Ankit Thakkar, pointed out that there are some positives which were out from that report. So, for example, the missing middle, push for easing GST on healthcare and reducing import duties. So, those are some of the recommendations he said, if implemented, would be positives. Now, Max's Abhay Soy did talk about the profit margin. He said that 8% median profit margin which exists, if you squeeze that further, there will be risks of starving the sector of the capital that they need in order to build beds going forward. Narayana said that, obviously patients don't come to enjoy the room when he was asked about the room rates being equal to 3-star hotels. He said that they come for the doctors and the outcomes of coming to a hospital. So most Indians, the problem is, according to him, is that they're still paying out of pocket in terms of hospital care rather than through insurance or through employers. Now, HCG's Dr. Ajay Kumar says that there is a false assumption that private equity is in the driver's seat when it comes to hospitals. Nearly 2 decades, of experience, according to him, and he's seen that there's been no interference in terms of clinical decisions from private equity investors. Asia Healthcare's Vishal Bali, so he's on the other side of the table. He's a private equity investor. PE has been present in India for 40 plus years within the healthcare space. Now, a couple of other important takeaways from this is that bed costs have risen to around 2.5 to 3 crores per bed. That is because construction costs have risen around 60% odd. Doctors at this point in time, fairly paid. The star doctor culture is limited to a few. Viren Shetty said that, just a handful do have that. Now, the average revenue per occupied bed, what can we expect going forward? Expected to possibly settle at around a 6 to 7% growth going forward. Today, total organized private sector beds in India are currently under 100,000. So when there is concern in terms of overcapacity of beds, one needs to think of the fact that there will be a demand which will widen over the next 15 years by 3 to 4 times, and hence the capacity will get utilized at that point in time. In fact, let's listen in to Fortis's Ashutosh Raghuvanshi talk about this rising hospital cost, with the capex per bed now costing 3 crores.
It is going close towards 3 crores and plus, and depending on the value of the land. Yeah. Some of the most expensive areas, it can be even more. And there are multiple reasons for that. The construction costs have gone up so much, and the newer equipment costs have also gone up. So all that is driving the cost up.
So how much do you think it can eventually settle at, on an average?
I think that will depend on the general inflation. I think it is not some number where we can cap it. But yeah, currently it's hovering around 2.5 to 3 crores at least per bed.
Okay. Nothing to do with the healthcare sector. Construction cost pre-pandemic to now is up 60%. The cost of all the raw materials have gone up. The rupee has depreciated since then. We import a huge amount of medical equipment. These have nothing to do with how hospitals function, is how the cost of each bed has gone up.
Okay, so that's the perspective from the CEOs, but let's also get in some perspective from Vishal Bali of Asia Healthcare Holdings, discussing his take on the strong private equity flow which has come into hospitals and whether it eventually impacts hospital operations.
In the US context, this is some data which has been actually floating around a lot from the US context. But I don't think in the Indian context any of this has ever happened. And private equity is not new to the Indian healthcare world. Go back 40 years. Apollo itself was invested by a private equity fund, right? So private equity has had a long gestation in this country. And also, there have been multiple enterprises where private equity has majority ownership. If you look at the clinical outcomes of those enterprises, I don't think that they are any way inferior to any of the others, which are not owned by them. So I think this entire conversation that private equity comes and changes the entire clinical thought process and clinical outlook of a particular enterprise is completely wrong. On the contrary, I believe that the way that the private equity funds actually push operators like us is around how can we get better clinical outcomes of our patients? What is the kind of new technology that you want? What's the kind of new clinical skills you want to incorporate? How can we make our infrastructure better? And that's not a function of capital, but I think it's a function of how you want to do clinical care. So I think returns are an outcome of what you do inside your enterprise. Results are not an outcome of just capital play. And that is truly what healthcare is all about. So this entire misnomer that there is this massive deluge of foreign capital which is coming in and it will change the quality of Indian healthcare forever and create unaffordable healthcare is completely, completely wrong.
All right, those are some important excerpts of the conversation that we had on the Healthcare Town Hall. We'll keep getting you updates on this one. For now, it's time to slip into a short break. When we come back, talk about some stock-specific themes on the other side. Welcome back. You're still tuned into Halftime Report. Well, there's a lot of stocks which will be on our radar because the government has approved 31 fresh proposals under the Electronics Components Manufacturing Scheme, or the ECMS. It is involving a fresh investment of around 7,877 crore rupees. So the total one comes at 82,243 crore rupees. It does include a lot of projects which has capital goods, modules for cameras and displays. There's anode material, rare earth permanent magnets, acetylene black, optical transceivers. But the list is not limited to these 3 or 6 categories. But DAM Capital has put out a note which talks about some of the stocks which will be in focus on the back of this. For Wipro Global, which is a part of the larger Wipro group, the total investment is around 1,401 crore rupees. Remember, they had already made 370 crore of investment for copper-clad laminate facility. Jyoti CNC Automation for capital goods or equipments had made investments of around 1,021 crore rupees. PCBL Chemicals for acetylene black will be investing 329 crore rupees. There's Minda Instruments for display module assembly at 270 crore rupees. Akita's Chemicals, that stock is at the day's high as well, up 3.5%. For electrolyte additives, they are investing big time in battery chemicals, so they'll be investing around 119 crore rupees. There's Sirma SGS as well. So these are a couple of stocks from the listed space which will be in focus on the back of these additional investments that have come by. So these stocks should be on your radar as well, which way things go after these investments have been announced as well. For now, if we take a look at the markets, the Nifty continues to trend lower. There was a wee bit of recovery, consolidating basically at the 24,200 to 24,300 mark. Mid caps under pressure too, and it's the Nifty Bank which is leading to the moves on the Nifty as well. So Nifty Bank should come up for you on the screen as well. Mid cap also attempted a recovery, that was sold into. And similar is the story with Nifty Bank as well. With that, it's a wrap on this edition of Halftime Report, but do stay tuned. Business Lunch will take all the action ahead.
Stocks drift lower as movement stalls in the Strait of Hormuz, driving up oil prices. Realty and IT are the big drags, while utilities and energy eke out gains.
Paytm promoters sell shares via block deals for the benefit of Antfin, while Netweb Technologies and SPR Auto launch QIPs to raise 1,200 crore and 1,000 crore rupees respectively.
Jio relaunches its Prime plan with a one-year tariff guarantee as part of its 10th anniversary celebrations, providing a shield against tariff changes. Analysts expect telcos to revise tariffs by 10 to 12% in FY27.
The Who's Who of Hospitals Inc. tells CNBC TV 18 that the parliamentary panel report is worrisome and they expect wider consultation. They add that profits of players are barely adequate to drive capex and the core issue is insurance penetration. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. With me, as always, Arundhati Ramanan. Arundhati, good afternoon to you.
Hi, Hormuz. Good afternoon to you as well, but it's not a very good afternoon for the markets. Everything in the red, weak global cues and higher oil prices not boding well for the markets today.
Sixth straight day of losses, and the Nifty is fighting tooth and nail to hold on to that 24,200 mark on today's weekly options expiry. We have slipped below that yet again. 24,172, the intraday low as of now. So we are still at the lowest point of the day. Every small recovery that we are seeing in the market is getting sold into. Today, of course, the weekly expiry. So therefore, the cash assumes even greater significance as to what kind of price moves that you see towards the close of the trading session. The Nifty for now below 24,200. The Nifty Bank was also a similar sort of a trend. It saw an intraday recovery yesterday, gave all of that up during the cash session. But today as well, the buying interest emerging around that 57,200 mark at the lower end of the 57,000 to 58,000 range is where the Nifty Bank finds itself in, and that is where buying interest emerges. But every time it manages to try moving towards that 57,500, 600 mark, there is supply that is emerging from higher levels as well. So the markets remain locked in a range. The broader markets too, not any better compared to where the benchmark indices are. Stock-specific activity too is prevalent, yes, but far lesser compared to what it was during the earnings season, Arundhati.
Absolutely, Hormuz. And, let's talk. There's not very much that's doing well today. So let's talk about what's helping that market stay higher. First up, it's those defense names. And if you take a look at the sector is about 1.1% up and in the green. We've got some of those stocks that are doing very well. HCLTech is up nearly 6%. We've got Paras Defense that's up over 7% and Data Patterns nearly 3% in the green. We've got auto and those auto ancillary names that are also doing very well. That index is up nearly 0.5%. We've got Bosch that's up nearly 3%. Tube Investment rallying in trade today over 8% higher. And we've got M&M that's managing to stay in the green about 1% higher. Now, the top losers on the in the market today, it's that IT index, right? That's losing. Again, it was down. Yesterday was the top loser yesterday as well. The index is down 1.7%. Infosys, HCLTech, both of them are down over 2%. TCS is down 1.3%. PSU banks, those names are also under pressure today. Just like yesterday, we've got Union Bank, Canara Bank, both of them down over 1% in trade as we speak. And we've got SBI that's down 0.5% in trade. And that's how the markets are shaping up this afternoon.
Indeed, and that's where the trend lies as well. Beyond all of this, there are plenty of other stocks that are also reacting to their respective news flows. Ananya is here with all of that update. Ananya.
Well, yes, a host of stocks reacting to other news. Let me first start with Indomim. The stock is surging. If you see on the back of strong Q1, the revenue is up around 9% and profit is up around 32% here. Now, let me talk about Paytm also. That stock is down as founder promoter entity Resilient Asset Management plans to sell a stake up to 4.98% through a block deal, while the economic value stays with Antfin. session. Now, let's talk about Colgate-Palmolive. India is under pressure on the back of its con call, where management said it will prioritize growth over near-term profits, increase ad spends, and also acknowledged weakness in the palm olive segment. Now, Nelco is also under pressure after announcing a $20 million or around 190 crore investment in a US satellite company that has not started earning revenue yet. So returns could take time here and will depend on satellite deployment and regulatory approval. So market is taking as a bit negative here in the short run. Now, Seagull India is down after Delhi PWD cancelled a 330 crore tender where it was the lowest bidder. Now, it has also received approval for 4 road transport ministry projects worth 2,000 crore, but these were already known to the market. So the market is now reacting to the cancelled order. Now, Netweb Technologies is rallying after opening its QIP at a floor price of 4,885 per share. Sigma Advanced System is in focus after winning 155 crore of anti-drone orders. Now, and broader defense stocks like Arundhati mentioned are buzzing after the Defense Ministry listed 405 items that will now be bought from the Indian companies instead of imports. So, yeah, these stocks are buzzing in trade today.
All right, Ananya, many thanks for taking us through what's in the news and what's buzzing in trade today. Now, the Department of Defense Production has notified its 6th positive indigenization list, opening up 405 strategically important defense items for domestic manufacturing. Ria joins us now with all of those details. Ria, those stocks buzzing in trade as well.
Well, that's right. All of these defense stocks are buzzing in trade today. And as you mentioned, the Department of Defense Production has notified its 6th PIL, which is the positive indigenization list. And this includes nearly 405 strategically important defense items, which will be put up for indigenous development. Now, in terms of the business potential, that is estimated at nearly 3,070 crores as a result of this. And this includes nearly 389 items for defense PSUs and 16 items for the Indian Coast Guard as a part of this list. Now, in terms of what is included, we have subsystems, sub-assemblies, spares and components, and the platforms that are covered are aircraft, armored vehicles like the T-72 and T-90 tanks, naval warships, even missiles and electronics and ammunition are covered in this list. And once these items are indigenized, these items will all be procured from the Indian industry, which will create a potential revenue opportunity for domestic defense companies. And we will also be seeing significant participation from MSMEs as well as other domestic vendors. And in terms of the timelines for this, the indigenization timeline for these items are range anywhere between December of 2026 to up to the end of 2032. And remember the earlier PILs that had come out, the first 5 PILs, those have covered nearly 5,000 items. And in terms of the key beneficiaries out of this, the listed companies, we have BEL and HCL that account for nearly 77% of the entire list. And we also have companies like Bharat Dynamics, Garden Reach Shipbuilders, BEML as well as Midhani that will see benefit from this.
Ria, thank you for that update there. Defense stocks are the ones that are in the spotlight today yet again. But the big talking point otherwise has been in the hospital space, and that is after the Parliamentary Committee recommendations that prescribed lower costs via capping room tariffs and a lot more. Now, here is the view from the top hospital CEOs and founders who spoke to us exclusively yesterday.
This report is worrisome. And it is worrisome because of the kind of thought which has gone in it. I think it is probably based more on anecdotal instances on which the report has been made. So there are a lot of dichotomies in the report. One side, we are saying that India is a destination for medical tourism and we should promote it. Why? Because we are very economically, we are providing the best quality services. On the other side, we are saying that the healthcare is very expensive. I think we are confusing the two issues of affordability and the actual real cost of delivering healthcare.
Keep in mind, if you're going to look at the return on capital employed of a hospital which was put up 30 years ago or 20 years ago is going to be very different from what is being set up today. A hospital which is being set up today takes into account the current prices of land, the current cost of construction and so on. It takes you about 4 years to construct. And yes, 20 years later, that particular hospital may give you a 20% ROCE. But the fact is, at present, and if you actually see, everybody's return on capital have come down by 40 to 50% because people are expanding, because people are sort of moving up, on the capex cycle.
Is the average actor salary determined by what Salman Khan or Shah Rukh Khan make? This thing describes a very, very small portion of the overall medical fraternity who definitely does get amplified. On average, doctors are paid fairly in India. They get very good salaries. And the students that choose to do medicine do it for reasons that it just puts you up onto an automatic socioeconomic strata that is 1 or 2 levels higher. It's a stable income. It's a very good job. There are instances, yes, where doctors do command outsized salaries, but those are specialists who, you can think of them like the Formula One drivers or the ones that get traded between football teams. There may be about 10 of them in the whole country.
Bottom of the pyramid is covered by government schemes, and they are not really concerned about that anymore. The top of the pyramid is taken care of by the insurance schemes because they can afford to buy them. Some of the government employees are taken care by CGHS, but it's the missing middle who pay out of pocket, as Viren just pointed out, who need support. And the report specifically outlines how health insurance must step up and become more affordable and widen the base for these missing middle populations.
On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. The Tata Sons AGM scheduled for today is likely to be adjourned due to a lack of quorum. Rachna Dhanrajani is here with all of those details. Rachna?
Well, that is correct. I'm outside Bombay House, and in about an hour we will see the AGM start as per the schedule, which is at 2:30 p.m. But what we're understanding from our sources is that due to a lack of quorum, the AGM will start, wait for half an hour because that is what the Articles of Association mandates. And after that, it would be adjourned without any further discussion. Now, what happens after the adjournment is also a question here. But before that, let's understand why no quorum. Well, the Articles of Association of Tata Sons clearly requires one joint representative, which is nominated by the two trusts, that is Sir Ratan Tata Trust and Sir Dorabji Tata Trust, coming together and nominating one person jointly to be the representative at this AGM, and that has not been able to happen as Sir Ratan Tata Trust is barred from conducting any board meetings and take any board decision thereafter, which is why no quorum, because there is no joint representative. But what happens after today? Because over the last few weeks, if you remember, we have been reporting how the Tata Trust has been appealing to the Charity Commissioner and has been looking ways to hold on to that one meeting that can finalize one joint representative. But since that has not happened and the day has come of AGM and it is getting adjourned, what happens here on is important. Now, our sources are indicating that after this meeting is adjourned, for the next meeting, before that, the trust is likely to approach Registrar of Companies and ask for an extension that can run up to 3 months. And in those 3 months, that takes the timeline up to November. In these 3 months, on September 8th, which is another crucial date, that is when the matter of SRTT is likely to list in front of the Charity Commissioner. And so we will see what happens on that front, and that could possibly take this whole case forward. But for now, the AGM is likely to get adjourned.
Rachna, thank you for that update there from Bombay House. We get you more details as they emerge. Let's now get you some market opinion then. Nilesh Shah of Envision Capital says that the dominance of new age companies is now truly playing out, with platforms like Eternal, Nykaa, Grow, Lenskart and Car Trade showing sustained growth. Listen in as he elaborates on it.
Basically, the platform that they have created honestly is sustaining itself. And you can clearly see that relevance and that dominance playing out. So if I were to kind of really look at the whole basket of these digital platform companies, all of them pretty much have grown in very strong double digits. Probably some of them have grown in their 20s, 30s, 40s in terms of the growth rate on a year-on-year basis. So, well, we like a bunch of them. We've been owning Eternal, we've been owning Nykaa, we've been owning Grow, Angel One, Lenskart has been a recent addition, Car Trade. These have really been the bunch, Paytm. These have really been the bunch of companies that we have been owning. And our thing is that basically just spot the leader, look at the opportunity. The opportunity is still kind of underpenetrated, spot the leader, and then ride the leader. That's essentially been our philosophy.
And on that note, it is time for us to take another short break. But more news and updates on the other side. Stay tuned.
On to the latest updates from West Asia, then the 60-day deadline for the US and Iran to reach a deal towards ending the conflict has now passed. US President Donald Trump said that the United States is not seeking an extension of the MOU and also said that Tehran should, quote-unquote, put up the white flag of surrender. CNBC's Dan Murphy is here with the latest updates.
The US-Iran MOU has officially expired, and President Trump says he is not setting a new deadline. In an interview with Fox News, the president said he has no time schedule and is not in a hurry. He also said Iran should put up the white flag of surrender. Speaking to reporters later in the Oval Office, the president drew his red line.
Well, they want to make a deal, but they're not going to make the kind of a deal that I feel is necessary. Look, we're in there for one reason. Iran cannot have a nuclear weapon. You understand that? Iran cannot have a nuclear weapon, and they won't have a nuclear weapon. And right now, them building one after what we did previously with the B-2 bombers, going to be a long time behalf. But Iran cannot have. It's very simple. They can't have a nuclear weapon.
President Trump there. And for this region, all eyes now on the Strait of Hormuz. Iran's foreign ministry says an understanding has been reached with Oman on the map of a transit route through the strait, with the two sides working towards a joint statement. But when asked about Muscat's role, the president issued a threat, saying if Oman gets in the way, the US would, in his words, bomb it. It's not the first time the president has threatened Oman, but it comes at the most sensitive point yet in the Hormuz talks and with the US naval blockade in full effect. Meanwhile, Treasury Secretary Scott Bessent says new economic measures never been seen against Tehran could come as soon as this week, but the details are still thin. Beyond Iran, President Trump also told Fox News that Israel should not be carrying out strikes in Gaza right now, while also claiming Hamas is giving up their guns. That comes as the US Special Envoy Jared Kushner steps up pressure on Hamas, wanting the group to disarm or risk a renewed Israeli military campaign.
So Dan there with the latest from West Asia. Today is August 18th, and the man who made the number 18 famous has completed 18 years in international cricket. Virat Kohli made his India debut on this day in 2008, and what followed has been a remarkable journey of resilience, aggression, and reinvention. From the heartbreak of 2014 to the famous 60 overs of hell and that miraculous 82 not out against Pakistan in the 2022 T20 World Cup, Kohli has delivered some of cricket's most unforgettable moments. And finally, the one trophy that was missing from his cabinet, the IPL title. After 18 years of heartbreak, Kohli lifted it with RCB in 2025 and then added another IPL crown in 2026.
12 runs in his first ODI innings on this day today in Sri Lanka, but it's been a wonderful career nonetheless. Well, with that, we take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Continues to be a quiet day. Another day of lows on the Nifty. We are down 82 points in the Nifty as we speak. Sensex is down even more. The midcaps are falling, largely in line with the benchmarks. And Nifty Bank to down 0.3%. There are a lot of stock-specific elements that we are addressing, and that is something which we'll discuss on the show as well today.
Afternoon, Sonal. Absolutely right. Quite lackluster in terms of the moves that you're seeing, especially as far as the headline indices are concerned, but a lot of action as far as individual stocks are concerned. But we have a lot lined up on the show, so let's start off with the top headlines. Market continues to trade with cuts, with the Nifty trading around the 24,200 level. IT, FMCG and metals drag the most, while auto and pharma buck the trend. Broader market trades in line.
Paytm promoters sell shares via block deal for the benefit of Antfin, while Netweb Technologies and SPR Auto launch QIPs to raise 1,200 crore and 1,000 crore rupees respectively.
Tube Investments gains over 8% in trade today on the back of strong management commentary. The company says they will see double-digit EBIT margin improvement, and their FY27 planned capex excluding CG Power is at 600 to 700 crores. Motilal Oswal and Axis Capital bet on the stock.
Colgate-Palmolive was under pressure as the management in its conference call emphasizes on its focus on growth over near-term profitability and signals high advertising spends. Brokerages HSBC and Citi issue hold ratings.
Indo-MIM posts an operationally strong first quarter with margin expansion and double-digit revenue growth. The stock is up nearly 10%.
All right, those are the top headlines that we are tracking. Nifty very range bound at the 24,200 mark right now, but of course has been quite volatile. The attempts to recovery has been sold into. There was another attempt of recovery at around 115, and it is around those 24,200 levels as we speak. Mid caps, they are falling in line with the benchmarks with 0.3% of fall for the mid cap index. Again, there is a recovery which is underway. But it's time for our segment, Mid Cap Movers. We have Ria to take us through the mid caps that are moving around in trade. Ria.
Well, absolutely. Let's start off with the gainers first. We have Tube Investments up nearly 8% on the back of strong management commentary coming in. Welspun Living also seeing a strong gain of 5.5% today. Even Prime Focus up around 7%, and Action Construction Equipment as well as Schneider Electric both seeing gains of nearly 5 to 6% as well. And moving on to defense stocks that are also in focus today on the back of the Department of Defense releasing the 6th positive indigenization list. We have stocks like Paris Defense, Zen Technologies as well as Idea Forge. All three of these seeing very strong gains today. In fact, Idea Forge hitting an upper circuit of 5%, and HCL as well as BEL also seeing some bit of green today. And on the flip side, looking at the losers in today's trading session, we have Inox Wind taking a cut today. In fact, the stock is down nearly 45% just in the last 1 year. SBI Cards also taking a hit today. The stock is down nearly 30% on a year-to-date basis. Vardhaman Textiles also down just about 1.5% today. The stock has in fact gained around 35% on a year-to-date basis. BHEL also, this stock has been gaining in the last few months, up 70% in the last 5 months, but today taking a cut of nearly 2%. And eClerk Services also taking a cut of nearly 2.5% today.
Well, thank you so much, Ria, for joining us, giving us a list of all the top movers as far as the broader end of the markets are concerned. Clearly, defense standing out along with the list of names that Ria mentioned, even names like Bharat Dynamics, BDL, Mazagon, the shipbuilders, all of these stocks too doing quite well. But it's a good time to get a quick technical check on the market. Shrikant Chauhan of Kotak Securities. Good afternoon, Shrikant. Thank you so much for joining us. Well, the Nifty is largely range-bound in the last few trading sessions. Do you see a breakout from current levels? Is it a consolidation phase? What's your view as far as markets are concerned?
Good afternoon, Vivek. Good afternoon, Sonal and everyone. So when looking at the structure of the market, it is like very clear that currently the market is facing corrective pattern. It is correcting from the highs of 24,700 to almost 24,200. It is very close to the 50% retracement of the entire rally that we witnessed from 23,600 to 24,800 sort of levels. Now we are of the view that around these levels, the market should pause and reverse. But in case today a market closes below the mark of 24,200, then in that case, we can expect some more weakness, maybe up to 24,000. Then by and large, my view is that we are into corrective mode. And after hitting important levels, we can expect very strong rebound. But for the time being, there is no such any indication. And that is why we need to be very, very stock specific.
Okay, so we need to be very stock specific. What are some of your stock specific bets?
So yeah, Sonal, I think then in that we need to focus on those sectors where there is momentum as well as stocks, number of stocks crossing their important resistance level. So in that specifically, we like HAL, Hindustan Aeronautics, which is currently around 5,100. There we have a target of 5,300 in the near term, maybe 5,500, 5,550 in the medium term. But at this level, it's a buy. We can keep a stop loss around 5,000 for creating any long position. Also, if we consider its long-term pattern, then on weekly, monthly basis, the stock has crossed its important resistance level at 5,000. So I think that should act as major support for the stock, and we can expect 5,300 on the higher side. The other stock on which we are bullish is Amber Enterprises. And if we consider the technical pattern of last 6 particular months, then multiple time, whenever the stock has fallen to 7,000, we saw buying interest. And eventually the stock has managed to surpass the level of 7,500. So this time also we are expecting stock to move towards 75 or 78. We can look for adding this stock at current levels and more on dips with a stop loss at 7,100.
Okay, all right. Thank you so much, Srikanth, for joining us today. Important flashes from Bloomberg. Government is looking to lower or scrap the 100% tax on inbound shipments of sugar. So basically, import duty on sugar for now, and it is looking to cut import duty to curb domestic prices. Now, remember, sugar prices have been going higher. There is a deficit that we are talking about in India and globally, and sugar prices, they have been going higher, which, of course, the government is trying to curb for now. Balrampur Chini should come up for you on the screen. The stock has come off sharply from the highs of the day. So that is something that we'll be tracking very closely. What happens to sugar prices if this does take place? For now, it's just a Bloomberg report that the government is looking on lowering or scrapping this inbound duty. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets, talk about some stock-specific moves on the other side. Stay tuned. Welcome back. You're still tuned in to Mid-Cap Radar. Well, while the broader markets are under pressure, there's one space which continues to do well. This is our segment Mid-Cap Spotlight, and we'll discuss MRPL and Chennai Petro. The two stocks are higher today, and that has been the case for the last couple of months and this week as well. So let's take a look at how these stocks have performed. First, let's take a look at how these stocks are doing right now. And they both are higher in trade today. This despite the fact that the Mid-Cap index is not doing so well. Yes, MRPL has come up from the highs, and Chennai Petro is the other one which has also come up from the highs, but they are making decent gains. Month to date, MRPL is up 4% and Chennai Petro is up around 14%. If we talk about the last 3 months, while MRPL is up 20%, Chennai Petro is up 40%, and in the last 6 months, we do have MRPL which has declined 7% and Chennai Petro is up 54%. What are the reasons for some of this outperformance that has come by? Now remember, these are standalone refiners. What they do is take crude, refine crude, and produce diesel and petrol and other products out of it. That is all they do. They do not go ahead and sell it in the market. So European refining margins and US refining margins have spiked to $70 per barrel. European diesel margins have jumped to levels of $65 per barrel, and US gasoline crack spreads remain near historic peaks. This is as per a report by IEA. They also talk about how distillate and gasoline inventories in major hubs like the US are at seasonal levels seen in decades. So we are talking about lower inventories and higher margins. Global throughputs are also now forecasted to decline by 2.5 million barrels per day. On an average in 2026, they'll see a rebound only in 2027. So these are a couple of factors which will keep prices higher, and hence cracks will continue to be higher for some of these refining products as well. Additionally, some reports suggest that Ukrainian strikes in Russia impacted 40% of their refining capacity. That has been shut now, and some refineries are also taking maintenance shutdowns that will only reduce the refinery capacity available globally. That would mean another spike in refining margins as well. But if we talk about these two stocks, they tend to benefit the most because they are literally making that product and giving it to OMCs to be sold in the market going ahead. Now, if we talk about some of the valuations of these two names, Chennai Petro is trading at 4.9 times FY27 EPS, whereas MRPL is trading at 9.4 times. That also explains the kind of moves that we've seen in Chennai Petro. Being cheaper has seen a bigger surge in stock price versus MRPL, which did see some issues in Q1, but looks like the street is avoiding all of that and the outperformance continues.
Absolutely right. Standalone refiners, the spotlight today. But let's now slip into a short break. More news, updates, and stock-specific action on the other side. Welcome back to Mid-Cap Radar. Well, one particular stock that's doing very well in the session is Indo-MIM. It's rallying after an operationally strong Q1. Sudarshan joins in with all the key details.
What a run it's been for Indo-MIM since the time the issue price was around 485 rupees per share, and listing price was almost at 44% premium. And now the stock is almost double if you compare against the issue price. And now it's on the back of today's 10% move is on the back of strong earnings that company has reported for Q1 FY27. It's looking very strong operationally. Margin has improved both sequentially as well as year-on-year. Revenue, if you take a look on sequential basis, it has seen a growth of more than 16%, and YY basis too, it has seen a growth of 9%. Unlike other companies in the auto sector or even in the aerospace, all the other companies had seen margin compression, but contrary to that, this company has seen margin expansion of almost 400 basis points. If you compare YY, it has come in at 33.4%, 33.4% versus 29.4%, and in resultant EBITDA too has seen a surge of almost 25%. So overall, on the back of very strong set of earnings, we are seeing a 10% move in the stock price.
Okay, all right. At that point, thank you so much, Sudarshan, for that. But you have to stay on and talk about Tube Investments. We spoke about it yesterday as well, but tell us more. What's happening with the conference call takeaways?
So yesterday, we did highlight during our closing bell after the con call that company held after Q1 FY26-7 earnings. And those earnings had looked largely in line, but there was a concern related to margin. And on that front, company is saying that the pressure it was seeing because of the sharp increase in steel prices over the last few quarters. Now, as per the agreements they have with clients, they are going to recover all the costs over next few quarters, and that will help in the recovery of margin. Now, on the EBIT margin front, they are expecting a double-digit improvement going forward over the next 1 to 2 quarters. And one segment, they have engineering and metal segment, and that they believe it can revert to old margin levels. TI Medical, they had earlier guided for 20% revenue growth. They have maintained that guidance, and they have 3 e-mobility business. One of those, they believe that it can break even in FY27, basically this financial year, and 2 other businesses, e-mobility business, will break even in FY28. Planned capex, they have 600 to 700 crore if you exclude CG Power, and of that 350 crore is for Tube Investments, and remaining 100 crore is for Shanti Gears. One business, that is cycle business, had seen margin expansion this quarter too, and they believe that by the end of FY27, it can see an improvement of almost 2 percentage points. Talk about the brokerage views. Most of the brokerages remain positive in the stock. Motilal Oswal has a buy call with a target price of almost 3,380 rupees per share, and Axis Cap has upgraded the stock to buy, and target price here is 3,600 rupees per share.
Well, thank you so much, Sudarshan. You know, Tube Investments is a stock that you highlighted yesterday as well, immediately post the conference call, and that particular stock surging away 8% higher. But moving on, the government approved 31 fresh proposals under the Electronic Components Manufacturing Scheme. Minda Corp too received the ECMS approval. The company will manufacture TFT displays in India. Our colleague Ashmit Kumar yesterday caught up with Akash Minda, Executive Director of Minda Corp, and here's what he had to say.
This is a display project where we've applied for the ECMS scheme, and today we got an approval from the government for that. So this is going to be a greenfield facility set up in Pune, Chakan, Maharashtra. So this is for the automotive displays in particular to begin with, and here we are investing at about 270 crores to begin with, and this is where we're going to be localizing the TFT display manufacturing in India. So the complete process of manufacturing TFT displays for all segments of the automotive. As you know, the instrument clusters are becoming more and more premium, going from mechanical clusters to TFT displays in the infotainment or in the cockpits and clusters, which Minda Corporation is already manufacturing. So these displays will be localized and then we'll be supplying to Minda Corporation as well as to our end customers. The objective is to focus on complete, deep localization and backward integration.
Which was in fact my very next question. Help us, for the benefit of our viewers, help us understand the business case for this investment that you're making here under the ECMS scheme.
So typically the TFT is close to about 40 to 45% of our bill of material. And currently almost all displays in the automotive are currently imported from different parts of the world. So in the first phase, this will help us localize the assembly in India. And in the second phase, we'll be localizing the components in India. So that is how we're going to be starting to localize and manufacture for our own requirement, as well as then the OEMs, the complete display module, which is including the TFT, backlight assembly, the cover glass, and other processes that come along with it.
Another question I wanted to ask is that the support that's coming in by way of the ECMS scheme, what does this do? How significant is it in terms of perhaps making up for the competitive disadvantage that India may have against some of the other geographies?
So, see, India is a very important is in a very important phase at the moment, and everybody is continually investing in backward integration. Our customers are also requesting us for the same. So, what we are doing is we're investing in this. We're currently importing. So, this is going to help us become more competitive when we offer products from localized, designed, developed in India and manufactured in India. So this is the basic condition where the government as well as the customers are now asking us. So it helps in winning. So localization becomes the more important point rather than the commercial at this point of time for the customers.
One final question. You mentioned localization. Is it geared more towards the domestic market, or will you also be in the longer term, mid to longer term, perhaps be looking at the export market as well?
Definitely looking at exports as well. So to begin with is build our capabilities, competencies, capacities in India for the market, build number one, and then look at the exports market. But there's a huge opportunity there as well.
Well, a big opportunity is what Minda Corp is highlighting as far as the ECMS scheme is concerned. But moving on, is the private hospital industry underbuilding for the long term, but overbuilding in the short term? Abhay Soy of Max Healthcare and Ashutosh Raghuvanshi of Fortis Healthcare addressed this particular concern. Let's listen in.
The larger micro markets of metros, as Ankit pointed out, are very complex and different in nature, and there are opportunities within these markets. So it is natural for most of the groups who have adjacencies, who have a presence and brand value established in these markets, they will focus on those markets first. But a lot of groups are extending themselves into other markets as well. And there are many cities which earlier were considered tier 2, tier 3, where you would see that a lot of infrastructure started coming up. I mean, if I can say, Abhay himself is going in Lucknow, Bhubaneswar, and many other markets, and so are we. So I think a lot of that capacity will come in tier 2, tier 3 cities, but 30,000 beds is not going to be enough.
Okay. What about
If I can just add, today's oversupply is tomorrow's very well thought out decision because they plan for the future.
No, I want to be absolutely clear. I be accused of, wanting lesser hospital. I mean, of course, I'm more than welcome. But that question was simply from a perspective of, shareholders are not.
So I just want to add to what the debate. If you look at the Delhi NCR market, and interestingly, that's supposed to be a market where you had the maximum amount of supply of quality beds in India, right? But if you actually see the number of tertiary care beds in the private sector in Delhi NCR is about 11 to 12,000 total beds, right? Again, I'm going to compare it to the UK. The population of National Capital Region, NCR, is 85% of UK's population. And like I said, it's 200,000 beds, the 12,000 beds. Okay, I don't see the 12,000, even if you add your entire 30,000, which you're adding across India to Delhi NCR in the next 5 years. Okay, and by that virtue, you get to 100,000 in the next 15 years. You're still half of UK's supply at that point in time, even if you take a lower amount of affordability.
Well, an extremely engaging conversation that we had with the senior folks at the hospital space. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, along with me as always, Vinny Motiwala. Vinny, good afternoon. There have been a lot of market plays that we've been talking about. Today it's going to be contra investing and a lot more about that.
Absolutely, contra investing and a lot more about that, and especially in a market where investors are often chasing what's working. Some fund managers are choosing a different path, looking for opportunities in stocks that have fallen out of favor. The latest entrant is Bandhan's contra fund. The NFO has started currently. Subscription open from 10th of August to 24th of August as well. To discuss more on contra funds as well as Bandhan's contra fund itself as well, we have Manish Gunwani of Bandhan AMC joining us right now. Mr. Gunwani, good afternoon. Thank you so much for joining us on the show. You know, let's start by talking about the contra category. This category actually sits alongside with the value fund category. How does one as an investor draw a line between, you know, choosing something because it's cheap and unloved versus cheap and broken? If you could start by that.
Look, we've seen across times that whatever sector does well in year one doesn't do well in year 3 or year 4, and whatever sector doesn't do well in year 1 comes back and does well in year 3 or year 4. So, contra is basically a good style of investing forever in one sense. Clearly, it needs a bit more patience than, let's say, momentum investing, because momentum investing is where you're buying something where earnings and price to earning multiples are already doing good. So for contra, you need to have a bit of patience, have a 2-3 year time frame. But across time frame, we've seen that these cycles play out. I should also say that we are not exactly a pure value fund, because there is a difference between value and contra, in the sense that contra, we have a growth bias also. So we are not looking to necessarily buy what is cheap on price to earning, replacement cost, or price to book. We are obviously looking at that, as well as fast growing companies which may go through some issue or the other temporarily. So I think it kind of sits between value and growth investing.
Just to follow up on that, since you said those companies are not always broken and it's somewhere between value investing and other aspects as well. So I just want to understand, in the time that we are in, are you finding contra investment bets across the board? Because a lot of companies have not seen the kind of valuation re-rating we could see because of market conditions. At what point in time does it make sense to launch a contra fund and for investors to look at contra funds?
Look, contra is a good style of investing all the time, but particularly we feel it is relevant now because I think over the next 4-5 years, there are two mega themes, if you may call it that, which we feel will make sectors diverge a lot in terms of performance, which we feel will create volatility in the market structurally, so that the style of investing works. Now, these two are basically, one is AI, which is clearly one of the most transformative technologies we have seen, or even mankind has seen across centuries, I would think. The second is geopolitics, that for many years, for the last 3-4 decades, we had a situation where there was one superpower who was unrivaled. And now we're clearly seeing that there is an emerging superpower, China, because of which you're seeing every 2-3 years there is some geopolitical crisis somewhere or the other. When you combine these two mega themes, we do feel that the performance of the market, the performance of sectors within the market will keep changing in short cycles. When I mean short cycle, I mean 2-3 years. And that gives scope for a contra fund to do well.
That does give hope for a contra fund to do well. Mr. Gunwani, you know, what I also want to understand, so you think this is maybe the right time, given the geopolitical uncertainty that is going on. AI bet that has not played out for India yet, right? So then IT right now, like you said, is among the cheaper sectors, right, that we have available.
Yeah. Yes.
Do you think in the last 2 years, obviously, you've not seen anything exciting happen there. So this is something that now you believe is going to start playing out. And are you not worried about being a late entrant here right now?
No, so look, contra doesn't mean that we need to be positive on everything that has not done well. Especially today, if you see that if the market itself has been flat for 2 years broadly, there are many number of stocks which haven't done well. So IT particularly, we are not structurally massively bullish in spite of valuations correcting. We do think AI disruption is for real. We also think that the base of the industry, because it's done well for the last 20, 25 years, is quite big. And on that base to grow anyway is an issue, right? So if you see India's services, India's market share in services exports, it's quite high, 6-7%, whereas in manufacturing, it's about 1.5%. So the point is, even without AI, the base is so high that growth becomes difficult. And now with AI, that poses a structural challenge. So we might like something which is niche, with some companies which might be doing very new age kind of practices, or they might be in manufacturing kind of technology. But we're not necessarily super bullish structurally on IT services.
Okay, not particularly in IT services. Manish, I wanted to understand then what is the portfolio composition like right now in this contra bet? AI bets, you did speak about some of these West Asia crisis impacted sectors or something. If you can name that and drill them down individually. And how are you picking these names? One would be, companies which have been broken, as you said in that presentation as well. But what are some of the, I would say, facts or investor elements that investors should go through while they're looking at some of these contra bets?
So clearly, the sectors which we like from a contra perspective today, a lot of them are domestic sectors because India, because it didn't have AI, has obviously underperformed the global markets. So a lot of the sectors across banks, NBFCs, real estate, insurance, cement, auto, to a certain extent, they've not really done well for last 2-3 years. And from a sector perspective, maybe those are some of the sectors we would look at. But having said that, the whole point is to be bottom up. So even if you take a sector like pharma, for example, right? Now that sector has done reasonably well, but we still think that within that sector, there are a lot of stocks which haven't done well, right? So it's a very heterogeneous kind of sector where every stock is a bottom-up story. And there are clearly a lot of pharma names which, again, for last 2-3 years have been languishing. So while we have certain sectors in mind as preferred contra bets, and that obviously will also change depending on the day we deploy the money. So right now, the NFO is on, and there'll be a day when we deploy the money and prices may be very different then from what they are today. But broadly, I would say at a sector level, most of the domestic facing sectors, they have obviously been not very popular over the last 2 years. And that is a big focus area for us from a contra perspective.
Okay, a couple of names, Mr. Gunwani, that you mentioned there as well in terms of sectors. We'll wait out for a detailed composition, once the fund is, comes in as well. But what sort of investors maybe you would say should look at the Bandhan Contra Fund?
So this is a fairly aggressive fund in terms of stock picking. Our deviation from benchmark is going to be quite high. And by the very nature of the style, it will need a bit of patience. As I said, investors should come in with a 2-3 year time frame because we are not buying hot stocks, right? We are not buying something which has done very well for last 2 years and earnings are doing well. There is a lot of momentum in that stock. So people should come in with a 2-3 year time frame. People should come in knowing that this is an aggressive stock picking fund which takes fair amount of risk against the benchmark. But the aspiration also then is on 3-5 year basis to create reasonable outperformance against the benchmark.
Okay, so this will be for an aggressive investor. So do you think that is one of the risks that one should consider before investing in a contra fund? Because like you said, there could be some broken companies where you are expecting turnaround. So what are some of the risks associated with a fund like this, the contra category as a whole, not just the Bandhan specific fund?
No, so this is a style of investing, and obviously both the style and stock selection may demand patience. So this is not a low risk fund. I totally agree. I think people should know that we will deviate a lot from the benchmark. So our returns on a 3-6 month may be very different from the benchmark, right? So that is true that we are going to be aggressive, not only in terms of deviation from benchmark, we also, from a small and mid-cap exposure, might be reasonably high versus our peers or other diversified funds. So yes, it is going to be ambitious fund in terms of trying to outperform the benchmark.
So a follow-up on that, Manish, if we are saying that it could be high risk, trying to understand from an investor's perspective, how do returns pan out in that case? Are they further away from the standard deviation of returns as well? I know we don't talk about risk versus
obviously.
that. How much higher can an investor expect it to be?
See, obviously we can't
Of course, yes, I understand
put a
that.
numerical number to this. But yes, since we are taking higher deviation from the benchmark, since we are shooting for 3-year kind of performance rather than 6-month or 12-month kind of performance, as I said, our aspiration is to meaningfully outperform other diversified fund in terms of what alpha we can create.
Meaningfully outperform at least. Normally we go with that higher risk, higher return, but we will wait for the returns to come in as well. But on that note, we're going to slip into a very short break. We'll come back after the break and continue this conversation. Stay tuned, viewers.
Welcome back. You're still tuned into MF Corner, and we still have with us Manish Gundwani of Bandhan AMC. Manish, now that you have told us and explained to us how this contra bet would work, we have to talk to you about more bets in the mutual fund industry in general. And the one pertinent question, I'm sure you must be getting it a lot as well, because small and mid-cap funds, they are now drawing the bulk of flows despite valuations. What do you have to make of this? Do you think this could continue? Because now small caps have outperformed mid caps have outperformed large caps. What will drive growth from here on? Will it continue to be the small and mid cap category in terms of at least mutual fund flows?
So structurally, this has been our view over the last 3 years that for patient investors, we feel small particularly is a good asset class to be in. And we have generally said that in the long term, a good small cap fund can meaningfully outperform a large cap fund. The idea here is that two points. Essentially, one is that you have a lot more choice in the small cap space because the number of stocks, which is the addressable universe, is very big. So you could probably look at 700, 800 stocks at an institution level. The second, more important probably, is that rather than looking at so many stocks, I think the bigger point here is that usually small and mid, we feel, do well when there is a big change in the economy and the composition of what's driving the economy. And both at global level and at domestic level, we feel that the next 10 years is going to be very different from last 20, 30 years. This is because of technology like AI, robotics, electronic manufacturing, whatever, as well as the fact that the geopolitics could lead to a lot of currency movements, could lead to a lot of disruptions, could lead to reshoring of manufacturing, for example, right? Because supply chain security has become a big priority. Energy security has become a big priority. So usually what happens is large caps are large caps because they've done well for last 20 years, which was under a certain macro context. If the macro context is changing, which we think it is, then we feel that structurally small and mid will outperform large cap. Now, having said that, obviously there'll be cycles around this. And maybe if you take a 6 months, 12 months view, large caps may come back because they have underperformed a lot recently. Also because there is some correlation to FII flows, right?
Absolutely.
So whenever foreign flows are stronger, large caps tend to do better. And it is our belief that they will improve from here, the foreign flows. But medium to long term, I think it's more about
the broader end of the market.
Are there new sectors emerging? Are there new themes emerging, which we think will happen a lot? And therefore, a good small cap fund which can play these new themes and new sectors, the winners of tomorrow in one sense, I think there is enough room to create meaningful outperformance versus large cap.
There is meaningful outperformance that one could expect from the mid and small cap side versus large cap. But then what happens to large cap, right? Because this time after, more than a couple of years that we've seen large cap funds actually seeing an outflow in the month of July. Is this a bit of a risk that we should worry? Yes, FII flows, all of that come into place. But as a retail investor in India, when you see, the outflows for large cap, is that a bit of a worry?
Look, as I said, things tend to go to an extreme in market, and maybe there is a bit of a turning point for large caps as a contra-indicator. But again, I think that's more a 6 months to 12-month trade, maybe, to bet on large caps. Very simply, if you think about this, that over last 30, 40 years in US, for example, were you better off being in NASDAQ or were you better off being in Dow Jones? Obviously, the NASDAQ has massively outperformed Dow Jones, right? Now, Dow Jones was the traditional large cap index, right? So all I'm saying is that whenever economy goes through change, the large cap index may underperform over long term. And we feel that India is in a similar situation because the sectors that drove a lot of the growth from, let's say, 1990 to 2020, which is basically FMCG, IT services, banks, they have become very big, and incrementally, the industry growth is not going to be very high in those sectors, right? So I think most economies, if you see long-term history, mid and small caps outperform. The US has been an exception over the last 15, 20 years, purely because it created some very big tech companies. But that is not usually the case in most countries. So we do think that given the change, given the fact that a lot of the large sectors in the large cap index have become very, very big by market cap, there's not too much growth left in those sectors, basically.
Got it. There are a lot of emerging sectors, and India has to make big headway into that, be it AI, as you've been pointing out, be it energy security, because renewables, yes, we are picking up big way, but there are other aspects to that as well. But it's always good to see that we are making some entry and some headway into that. Manish, always a pleasure speaking with you. Thank you so much for joining us today and talking to us about the Contra Fund and the outlook on different categories as well. A pleasure having you on the show today.
Thanks. Thanks a lot for having me.
Okay, all right. We need an interesting conversation, an interesting category. We don't talk about contra funds often, but there is a new offering from Bandhan AMC. Starts on 10th of August, and it has, of course, already started, and that is the fund we are talking about.
Absolutely. And, you know, Sonal, interestingly, I just pulled up some data that's on AMFI for contra funds as well, right? We have a few contra funds that are there. Overall, in terms of returns for the last 5 years, so most of them have been obviously in the range of around 11-12% as well. Will be interesting to see how this one plays out, given that he's spoken about higher risk, speaking about higher returns as well, and you want, you know, that's what investors want as well. But will be interesting to see the bet that comes in, especially at a time that we're seeing so much uncertainty, the anti-AI play that Mr. Gunwani highlighted as well. So that is something that we'll keep an eye out on. But with that, we're absolutely out of time on this edition of your MF Corner. Thank you so much for tuning in. Up next, your closing bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Nikkei modestly lower, almost 1%. It can hit, but not yet.
Look, we're in there for one reason. Iran cannot have a nuclear weapon.
Iran is now shifting its policy from a defensive one to a fully offensive one. Markets are opening 24,230. It's about 0.25% lower.
As long as the SIP flow continues, there's going to be liquidity to be able to absorb it.
We're going to keep hunting for partners and create a win-win situation.
In terms of categories, 29% of the revenue comes in from paneer.
The index is now at a very, very important level.
Continues to be a quiet day. Another day of lows on the Nifty. We are down 82 points in the Nifty.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and a short while from now, Prashant as well will be joining in. Well, a bit of a down day for the Nifty. We're down. We've breached the 24,200 odd mark here. On a closing basis, actually, you'll want to end above these levels. So that's going to be the important mark we're looking at. Remember, today we have the weekly expiry as well. Important in terms of, how do we see the volatility pick up on the screen as well. Lots to talk about. First up, let's run you through what we have lined up on the show for you. The markets trade weak as crude oil prices spike and worries grow over tensions between the United States and Iran. The Nifty is hovering around the 24,200 mark. Autos and pharma, they outperform. Milky Mist makes a very strong debut on the street, listing with a premium of around 19% and building on gains. Rima will be telling us what brokerages are making of the stock and giving us a complete valuation snapshot as well. Defense stocks, though, they surge as the government releases the 6th positive indigenization list, including 400 items for domestic production. Ria will break that down for us. And Indomim posts a very, very strong operational first quarter with margin expansion and double-digit revenue growth. The stock is locked in an upper circuit, up 10%. So it'll tell us what led to this sort of an outperformance. Okay, all right. Let's get in Mitesh then to help us out with what's the trade on the Nifty. Mitesh, we've been weak for majority of the trading session. The breadth of the market actually is not that bad. It's almost 1:1. Around 1,500 stocks are still advancing. Your view on the headline index first on the Nifty as well as the Nifty Bank?
See, I think on the Nifty, Nigel, I've been suggesting the level of 24,200. We're just hovering around there. And with cash, you never know where the closing will be below it or above it. So kind of holding my horses on the Nifty. The Bank Nifty also, is at a mild pivot at 57, 100, 150. If it breaks that, then I think we'll look for more downsides. And between the two indices, it is the Bank Nifty which looks more fragile and is showing higher chances of possibly getting below 57, 150. So as of now, I think both the indices are near the supports. No signs of a strong bounce back, so we'll keep a watch. And on the stock side, L&T Finance is a buy. Keep a stop at about levels of keep a stop at about levels of 317. Look for targets of 335, and CAMS is a sell with a stop at about 774 for targets of 730.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, let's talk about one of the stocks of the day on the upside. Milky Mist Dairy, that one listed today. It had a very, very strong debut today. It's sitting with a solid gain of close to around 30%. Rima breaks down all those details and gives us a valuation snapshot as well. Rima?
Thanks so much for that. So Milky Mist was expensive to begin with, but now with the kind of bumper listing that we've had, the stock is trading at 41 times FY28 PE, far more expensive than peers like a Dodla Dairy, Heritage, Parag Milk, which are trading at valuations in their mid-teens. Hudson Agro is the only one with a comparable valuation multiple. That too is cheaper at 35 times. And Hudson is a company whose top line is almost 2.5 times that of Milky Mist. In fact, Milky Mist valuations at 41 times is closer to two consumer valuations. So look at a Tata Consumer or Britannia, both of them are trading at valuations closer to 43, 47 times. So the question is, why does Milky Mist command such premium valuations? For starters, look at the expected EPS growth. FY26 EPS for the company was 2 rupees, expected to more than double to 4.3 by FY28 and further increase to 5.6. So the bottom line growth is going to be very strong. And secondly, this is a company which is growing faster than peers. Now, over FY26 to FY28, Milky Mist's top line is expected to grow by 25%, while peers are expected to compound and grow between 11 to 17%. And secondly, because this is a company which gets 100% of its revenues from value add, it doesn't sell milk which is low margin commoditized. Its margins too are higher than peers, trading at 14.4%.
Thanks a lot for that, Rima. Well, let's get in Dharmesh Kant, Head of Research, Chola Securities, who joins us on the show. Dharmesh, hi. Good afternoon. Welcome back. I believe you were in Australia, so hope things were good down under. And, this is the first time we're speaking, I think, in a couple of weeks. Welcome back. Dharmesh, tell us, what do you make of this sort of listing? Phenomenal, right? DAM Capital comes out with the note, they want 175 on the stock. On listing day, it's done. $180. Your take?
Yeah, good afternoon, Nigel. Definitely a very strong listing from the Milky Mist. It's good that both milk and, alcoholic beverages like Radico Khaitan and Tilak Nagar have been doing fairly well on the volume side as well. So I went through the projected numbers of Milky Mist. So they are, saying more than 100% kind of an EPS growth in next 1 or 2 years kind of a time frame. Volume-wise, the traction has been there, but we skipped this IPO listing because the experience with, say, Dudla Dairy and the others in the basket has not been that great. So maybe on a listing day, it's been doing fairly well. But the proof of the pudding lies in the next 3 quarter of earnings when it comes through. So we'll wait for that before having a recommendation beyond Milky Mist.
The proof of the pudding lies in the paneer, right? But incredible and quite something. Saman Capital, I think, is selling off, and the news just came in, I think, about 30 minutes back. And this is, of course, the Supreme Court essentially asking the CBI to investigate into some of the matters. I mean, these are the old same matters. There's a response coming in from Gagan Banga. And this is what it says. The graphics will come up. No allegations against Saman Capital. The Supreme Court has asked CBI to probe into allegations against ex-promoter. ED has stated very clearly that Saman is the victim in the FIR, which CBI will be probing. Saman Capital is not accused. So I think that's an important clarification coming through. Remember, the earlier erstwhile promoters are out. There is IHC, which came in, put in capital. There is, Himanshu Modi, who's, of course, with Suzlon earlier, who's now joint managing director. Gagan Banga, of course, is there. And they've had a couple of quarters, basically, under the new sort of team at Saman Capital in that sense. So just wanted to sort of put that up right now.
And Ashmit as well is saying this is an old case. Investigation pertains to the old promoters, and that's why there was no funding or order on Saman Capital. I guess that's why, in fact, the stock, after collapsing, I think 5-6% odd, it's finding its feet. And, Ashmit as well is getting us the latest. And we have a response coming in from the management as well, which explains why, from being down more than 5-6%, now the stock is down just around 2% or thereabouts. Good recovery from the lows. Let me ask Dharmesh. Dharmesh, what do you think of Saman Capital? You periodically get these news flows, but invariably it's proved to be, actually entry opportunities. However, the stock is not running away. Even prior to the big deal announced, it was in this vicinity as well. And some believe, going by what the management is saying, there is big value unlocking. But that is yet to be seen. At $150, you're interested?
Yeah, definitely, the stock has been oscillating between 135.40 to 180 kind of a range. And all the news flows have come and gone by. But constructively, if you see, the road ahead looks far positive than what it was. The only worry was when Mr. Banga was presenting his business case for the next 3 to 5 years. He has been advocating same, unsecured lending business and the low end of the business where the main growth will come through. So, 60% of the portfolio would be going into similar legacy kind of a businesses where they lost, and maybe the learnings from there can help them out. But that the microfinance business is still, is still susceptible to Indian economic conditions. So we have seen that time and again the cyclical problem do come in those segments, and that's the reason why I think serious investment is not coming into Sammaan Capital. Though if you look at MTF book and all, the position build-up is very strong out there. But because of the nature of the business which we talked about, which will be the growth going forward, which is not so great in the credit quality and more of unsecured business. So we are still, staying away from that.
Got it. All right. Let's then focus on more news-specific stuff like defense. The Department of Defense Production has notified its sixth positive list in terms of domestic manufacturing. They opens up close to 405 strategically important defense items for domestic manufacturing. Ria joins us to run us through that list and which companies are better placed. Ria, take it away.
Well, yes, defense stocks have been in focus today, and the Department of Defense Production has come out with its sixth PIL, which is the positive indigenization list, with a list of 405 defense items for indigenous development. Now, the business potential for this is estimated at nearly 3,070 crores, and this includes 389 items for defense PSUs and 16 items for the Indian Coast Guard as well. And in terms of what is included in this list, we have aircraft like the ALH and LUH, armored vehicles like the T-72 and T-90 tanks, naval warships, missiles, electronics, as well as ammunition as well. That is a part of this list. And once all of these items are indigenized, these items will be procured from the Indian industry, which will provide a potential revenue opportunity for all of these domestic defense companies. And we will also be seeing significant participation from MSMEs and other domestic vendors as well. Now, in terms of the timelines for this, the indigenization timeline for all of these items ranges from anywhere between December of 2026 to the end of 2032. And in fact, in the earlier PILs, the first 5 PILs, that had covered nearly 5,000 defense items. Now, also, let's take a look at some of the key listed beneficiaries that will come out from this list. Now, BEL and HAL account for nearly 77% of this entire list. And we also have other companies like Bharat Dynamics, Garden Reach Shipbuilders, BEML, as well as Mithani that will see benefit from this.
Got it. Okay. All right. Thanks a lot for that, Ria. Dharmesh, what do you make of this news piece? Clearly, some of these stocks, they've taken off, post this release that did come in. Your take?
It's a positive take, Nigel. I mean, these news flows will keep on coming, and Government of India is very clear that more and more products have to be made in India. Almost 60% of the content should be manufactured in India going forward 2 to 3 years time frame. And by 2032 to 35, they want 100% manufacturing in India with technology transfer in place. So as you have already highlighted, I mean, the key beneficiaries are BEL and HL. In fact, today we included BEL in our high conviction large cap basket. HL was already there. The stock has been moving up. And the best part about most of the defense companies is they already are sitting in an order book of 6 to 7 times their revenue. So 3 years, 15 to 20% kind of a CAGR revenue is already there on the cards. The only thing is the execution part. BL Q1 numbers were not that great. There was a bit softest kind of a number. Stock price has taken a correction. But I think going forward, things are likely to pick up. So that's the reason why we have initiated a buy today on BEL. HL was already there in the basket. It continues to be there. The numbers were quite better this time around for Q1 for HL. Going forward, the pace is likely to pick up. We are expecting 20% CAGR on PAT over the next 3 years for both BEL and HL. It's, I mean, valuation-wise, it's in the mid zone, around per year. If you look at the target price, 15 to 20% upside is seen out there.
Got it. Okay. All right. Got that. Well, keep an eye out on Polycab as well. That stock suddenly has seen a sharp downtick actually in the last few minutes. We were talking about the stock earlier as well, earlier this morning. And suddenly that one is nosedived. It's now at the low point of the day. 3.1% lower. Yesterday it was trying to show some momentum. Last few days, getting back to around the 9,300 mark. And today, in fact, it's slipping. Any view on this name? Dharmesh, the street fears that there could be some supply overhang. Quality name, but that's the fear, right? If it dips, would you be looking to buy?
Yes, Nigel. I mean, it's more of a technical sell-off which is taking place. If you look at all the wire and cable manufacturers, be it Polycab, KEI, RR Kawal, all reported very strong set of numbers. Even Havells, the wire and cable segment has done pretty well, so all in excess of 25% kind of growth, which is volume plus the realization part. And all the measures sounded very positive on the input cost price hike being passed on to the end consumers through the price hikes. And economy was, doing well. And they were very positive on that. But the stock prices have not reacted to the extent of the upside on the numbers, which was visible. So in our sense, as a basket buy, you can consider all, be it Polycab, KEI, and RL Cable as a basket buy for a play on the wire and cable industry. And a lot of transmission and distribution and value or margin accreditation businesses they are taking up, which will overwhelm in the future as well.
Got that. There is Indomim, which is the fairly recent listing, which of course has basically been almost a doubler from the issue price. And, of course, adding today's very sharp gain after the first quarter results. Sud is here with details. So take it away.
So as you said, the stock has almost doubled if you compare against the issue price. Issue price was 485. It was listed at a premium of 44%, and from that level, the stock has seen a huge run over since the time it got listed. And today's move is on the back of the strong operational earnings that company has reported for Q1 FY27. Margin, if you take a look, it's improved, it's expanded both sequentially and YOY. Revenue, if you take a look on sequential basis, it has seen a growth in double digits, up almost 16%, but on a YOY basis too, it's up almost 10%. EBITDA has seen a surge of almost 25%, and margin has expanded. It has come in at more than 33% versus 29.4% in the same quarter last year. Company is yet to upload the presentation. We'll get to see more details once the presentation and the analyst call happen. But as of now, by the first look from the P&L, it was a strong set of earnings.
Any thoughts, Dharmesh? Indomim?
Yeah, Prashant, I have not, tried this company closely, so won't be able to comment on that.
Any of the other, there was Dhoot Transmission, which saw fairly good response. Did you take a look at any of these recent listings?
I mean, the Prashant, only one which we have report was Manipal Hospitals, but again, the run-up has been quite sharp post the listing gain. So we were expecting 20% kind of upside from the IPO price. So that has happened. And the valuation gap which was there between them and the Apollo Hospitals or the Max Healthcare is now fully bridged. So we are taking a look, but it's definitely there on our radar for going for a better coverage on that.
The other one, which is also fairly recent, right? I mean, I think the second month in the listed sphere, SBI Funds Management, Dharmesh, almost 100 rupees off the highs. I mean, and of course, below the IPO price as well. Any thoughts on this one?
Yeah, I mean, we were very clear in our IPO note when SBI Funds came out that it's more of a listing day pop can be there. But going by their entire AUM structure, they were around 30% below than that of, say, ICICI or Nippon or even SDFC, AMC. So the valuation which they priced, apparently it looked better off, but there was hardly anything on the table for them. So as long as the equity AUM inflow is not great, you will find to have, it will be difficult to have the better margins off the table. So they are almost at 30% discount as far as the earning margins are concerned to their peers. So that has played out. But still, if somebody wants to, get into the AMC space, so then Nippon Life or SDFC Life, along with ICICI, is the recommendation out there on the table.
Lots of stuff in terms of, that asset management space as well. 80 points, by the way, 80 points lower on the index. We're at about 24,200, which is, like a clean round next support zone. Market breadth is pretty poor, pretty negative as well. For IT, for technology stocks, which are down 2%, 2.5%, have you seen any news flow around this, Dharmesh? Entire pack is down.
Yeah. I mean, initially also we were of the clear view that it's more of a cyclical or trading play which is happening on IT. And this is, last 3 days, they have been seeing some selling pressure out there. This is happening despite, rupee being where it is. The depreciation tailwind is yet playing out in the rupee. So IT, there is nothing structural happening out which can, warrant you a fresh buy. We have two recommendations out there. One was on Tata Technology and the other was on Orient Pro Solutions. We are sticking out. We are still not given an exit on both of them. And Orient Pro, I think the worst is being through. Q2 onwards, things should start looking up for them. But let's wait for the numbers to play out, and then we can take a call on that. Apart from that, we are not, venturing into any of the IT stocks.
Okay, all right. Dharmesh, wanted your view on HEG. Now, the stock is buzzing in today's trading session. HEG is, moved up actually on very high volumes. And the street is possibly awaiting the green signal coming in from the NCLT. And that's where you're seeing that sort of a bounce. Just to give you a few details, the existing entity, will be renamed as HEG Green Tech. Remember, we have been waiting by for this demerger for a while. And now, in fact, it appears it's in its final leg, and that's why the street is getting very, very excited. So the listed entity will be renamed as HEG Green Tech. What does the Green Tech business consist of? Well, it consists of various businesses. Just to run you through a few of them, advanced battery materials, that will include anodes and the likes, battery energy solutions, as well as the power generation business, which will be the hydro business, some part of solar as well is included out there. So that's what the Green Tech business is. As of now, the revenues are not very high. The EBITDA as well is not very, very high because this entire expansion with regard to anodes, graphene and the other, products that the management has been talking about, they kick in the coming years. But we had spoken to the management. We asked them, say in the next few years, what could this business EBITDA look like? They said it could look closer to around 1,000 crores or thereabouts. But we know that the Bhilwara energy business, which is the BEL business, the listed entity will have only 40% out there. So the attributable EBITDA could be in the vicinity of close to around 700 crores approximately. Very, very rough numbers, difficult to get a number, but in the next few years, that approximately should be around 700 crores, which is the attributable EBITDA. The HEG graphite business, well, that will be listed separately. Currently, remember, that's the core business. And the graphite electrode business, the capacity is already moved to around 1 lakh tons. That's expected to move up by nearly around 15,000 tons because they've already announced that particular capex. And the EBITDA number is gradually expected to scale up. Remember, the company has gone through a few years of pain or a few quarters as well, where price increases have now come about. The offtake has not been that good. But in the next few years, very, very roughly, if you look at it, the EBITDA number is likely to move from around 400 crores all the way to around 850 crores. And if you're looking at it on a 2029 basis, then you could say that the graphite electrode business could be around 1,000 crores, very, very roughly. And the other entity, which is the Green Tech business, could have an EBITDA of around 1,000 crores, but the attributable will be around 700 crores approximately. So let's stack up the numbers. The capex I've laid out is close to around 5,500 crores. The management told us that the peak debt will be in the vicinity of around 4,500 crores. The attributable EBITDA in the next few years will be 1,000 crores coming in from the graphite electrodes business and around 700 crores coming in from the the Green Tech business. So put it together, the combined EBITDA could be close to around 1,700 crores. And the combined EV, going by 4,000 crores of debt and around 14,000 crores of market capitalization currently, will be close to around 18,000 crores. So it's not very, very cheap. You're getting it at around 10, 11 times approximately EV upon EBITDA, and that to EBITDA that you're looking at for the next few years. The key to track will be the execution of this Green Tech business, because otherwise the street is wondering how to value this particular business. As of now, it's not much, but they're talking about 1,000 crores in the next few years. So HEG for the time being is buzzing because the street is awaiting the NCLT nod. How much of value unlocking will be there? Well, time will tell. Some part of the street appears bullish, while the others believe that maybe at around 18,000 crores of enterprise value, most of it is in the price. Dharmesh, what do you make of this one? HEG buzzing because of that hope, and the last quarter actually was not too bad. Second half of the year will actually be good. Your take?
Yeah, Nigel, you have detailed out everything about HEG, and the only, the way you summed it up was the valuation part, and that is where the things get, stuck. So it's on the last leg, I think, of the stock price rally, though the market opportunity is definitely there. The entire potential of reaching 1,700 crores of EBITDA through the graphite electrodes and the other businesses, that potential is there in the Indian market, and that's definitely coming. So most of the players, in this renewable space or the battery energy storage space, if you look at them, they are already discounting 5 years ahead of the numbers into the stock price. And that is where the problem arises. And we have seen that. Slightly digressing from here, look at Waaree Energy, all the renewable plays. they will continue to report 25 to 30% or even 50% kind of a profitability growth for next 2 years. But the stock prices have actually sold off around 50-20% of their highs. So but that's the situation where, to my mind, the business is there, potential is there, but the valuation comfort, I think, is not there. It seems to be fairly discounted. Maybe 5-7% more from here, but beyond that looks difficult.
Right. Dharmesh, good conversation, good speaking with you. Appreciate your time here on CNBC TV 18. It's always a pleasure. Well, I think we'll take a quick commercial break here. When we return, Hormuz is going to be with us with some notable buzzing stocks of the day. What's happening behind the price action. So that's the focus as always. Take a break. See you on the other side. Welcome back. Market still, of course, sulking a little bit, but Hormuz is here with the spotlight and the top movers across stocks. Hormuz, take it away.
Well, the index may not be doing much, but the broader markets are the ones where the action is, and Tube Investments is one such name. We spoke about this yesterday. Sudarshan highlighted the conference call from the company yesterday after its results. 8% higher now on the stock, the biggest single day gain since November of 23. The top gainer on the Nifty 500 today as well. Volumes are the highest since November of 22. Close to 40 lakh shares have been traded today. The 20-day average is only 3 lakh shares, so significantly higher compared to the 20-day averages. Today's volumes, 20% of those are marked for delivery as well. The stock, as a result of today's move, has now moved above all of its key moving averages as well. And as a result of today's move, the significant trading activity has made this the third most traded stock on the Nifty 500 in today's session. And of course, the stock is up 13% so far. And in fact, last year was the first and the only negative annual year that the stock has had since its listing. Nelco, on the other hand, has had a forgettable day. The biggest single day fall since December of 2010. This I'm talking about the intraday fall. The intraday fall was around 12.5%. At this point, it is the biggest fall since March of 2020. Now, it hit a 52-week high in just yesterday's trading session. The volumes could potentially turn out to be the highest in the last 2 months. The 18 lakh shares have been traded on Nelco. The 20-day average is around 4.5 lakh shares. So 4x its 20-day average. Close to 40% of those shares are marked for delivery as well in today's trading session. And the next level on the downside for Nelco is the 50-day moving average, which is at around 905. So still some distance away from that level. But despite today's fall, the stock is still up 30% so far on a year-to-date basis. And lastly, MCX, that stock has been outperforming over the last few days. Another 3.5% added in today's session, gained in 6 out of the last 7 sessions, during which it has gained 16%. The volumes today, though, are a little subdued because they only managed to cross their 20-day average after 12 noon. And since then, they have been higher than the 20-day average. So 30 lakh shares traded so far. The 20-day average is only 20 lakh shares. 42% of those shares are marked for delivery as well. And the stock continuing to move higher and remaining above its key moving averages as well. Has had a good year so far, close to around 40% gains on a year-to-date basis.
Okay, all right. Hormuz, thank you very much for that. Well, you know, one of the big talking points, of course, has been the entire healthcare space, hospitals specifically speaking. Stocks have corrected a little bit on the back of the recent parliamentary committee recommendations prescribing lower cost via capping of room tariffs and a lot more. You know, we conducted a sort of market forum yesterday with hospitals very much front and center. Had a range of voices across the healthcare ecosystem. Hospitals, of course, private equity players, investors in the space, and of course, other interested stakeholders as well. These are some of the top CEOs weighing in essentially and pushing back against the idea of price caps and why that perhaps could hurt more than help. Listen in.
I think the profitability of, if you look at every listed player, you know, my argument would be that the largest players and those profitable ones are the listed ones, and you know, the financials are a lot more transparent. So the median sort of profit after tax is about 8%, and I think it varies anything from 4 to 13%. And whilst I agree with Ekta about the EBITDA numbers and the revenue numbers increasing, keep in mind that this is not a services sector alone. This is a bricks and mortar business. So profit after tax, because we have real depreciation, you know, the buildings depreciate, the equipment is there for about 10 years, that depreciates. So profit after tax is the right sort of indicator. And 8% median profit after tax, or an outlier being at 13%, is not really egregious, and it is not really out of the park from that standpoint. And if you do less than that, I think it is going to stifle investment into the sector. And, you know, you're going to have issues as far as capital investment is concerned. Now, if you look at the costs, I think costs are a function of inflation, both on the variable side as well as the fixed side. And we have to solve for the person who's going to put up that hospital next, okay, because that is so required. As the baby boomer population in India, which is average age is 29, it shifts to 43, which is the European age over the next 15 years. I think, you know, we need to have about 10 times the number of beds. And if we are not going to be providing a basic risk-free return, okay, to any investor today.
Abhay, on that point, and I think what you said, some of the other metrics is net profit, you say, is the correct one. But look at return on capital employed, for example. I mean, 22, 23, 24% on mature assets. I mean, that's a pretty healthy return, right?
So, You're absolutely right, but please look at it in context.
I'm not leaning this way or that way. I'm just pushing back against that.
I completely agree with you and understand, but keep in mind, if you're going to look at the return on capital employed of a hospital which was put up 30 years ago or 20 years ago, is going to be very different from what is being set up today. A hospital which is being set up today takes into account the current prices of land, the current cost of construction, and so on. It takes you about 4 years to construct. And yes, 20 years later, that particular hospital may give you a 20% ROCE. But the fact is, at present, and if you actually see, everybody's return on capital have come down by 40 to 50% because people are expanding, because people are sort of moving up, on the capex cycle. So you have to solve for whatever is being set up today, not what has been set up. And look, price is always formed by the marginal player, is by the people who are setting up hospitals today.
Is the private hospital industry underbuilding for the long term, but over the next 4 or 5 years, there's a huge amount of new beds which are coming up. So is there overbuilding happening in the short run? What will it do to return ratios from a shareholder standpoint? Listen in.
The larger micro markets of metros, as Ankit pointed out, are very complex and different in nature, and there are opportunities within these markets. So it is natural for most of the groups who have adjacencies, who have a presence and brand value established in these markets, they will focus on those markets first. But a lot of groups are extending themselves into other markets as well. And there are many cities which earlier were considered tier 2, tier 3, where you would see that a lot of infrastructure started coming up. I mean, if I can say, Abhay himself is going in Lucknow, Bhubaneswar, and many other markets, and so are we. So I think a lot of that capacity will come in tier 2, tier 3 cities, but 30,000 beds is not going to be enough.
Okay. What about
If I can just add, today's oversupply is tomorrow's very well thought out decision because they plan for the future.
No, I want to be absolutely clear. Lest I be accused of, wanting lesser hospital. I mean, of course, I'm more than welcome. But that question was simply from a perspective of, shareholders are not.
So I just want to add to what the debate. If you look at the Delhi NCR market, and interestingly, that's supposed to be a market where you had the maximum amount of supply of quality beds in India, right? But if you actually see the number of tertiary care beds in the private sector in Delhi NCR is about 11 to 12,000 total beds, right? Again, I'm going to compare it to the UK. The population of National Capital Region, NCR, is 85% of UK's population. And like I said, it's 200,000 beds, the 12,000 beds. Okay, I don't see the 12,000, even if you add your entire 30,000, which you're adding across India, to Delhi NCR in the next 5 years. Okay, and by that virtue, you get to 100,000 in the next 15 years. You're still half of UK's supply at that point in time, even if you take a lower amount of affordability.
As I said, it was not just the hospital CEOs, but we also had investors on the sort of forum, the market forum. And this was a pretty interesting debate. We had Macquarie Capital's Kunal Dhamesha, who is the analyst who covers healthcare and hospitals. He's cautious on the space. And on the other side, we have TVF Capital Advisors, Shiv Puri, who joined us from Singapore, who is very, very structurally positive. So just want to sort of, play that out for you as well.
I already had a cautious view on the hospitals, primarily because, as I said, the expansion was kind of very great. Currently, this large listed hospital has a bed capacity of around 40,000 beds. And if you look at their next 3 to 5 year guidance, they are suggesting to add almost 20,000 beds. And then beyond FY30, there is another 10,000-15,000 beds get added. So, and whenever such a large capacity expansion comes, this is capex heavy, upfront indirect cost kind of sector, and hence there is always a pressure on profitability, which in my view was not largely factored into the street's estimates, and hence I have been on the sidelines for the sector for the last couple of years.
Hospital capex comes in cycles, but the business is not cyclical. It is highly structural. It's always been the case. And also, I think the important thing to understand is that the capex cycle is not in anticipation that hopefully demand will come. Try going to any of the hospitals in Bombay or Delhi or even Lucknow or Pune, etc., the high-quality private hospitals. you kind of need to have a contact to get a bed in many of these places, right? And so when you look at the numbers that are coming, they're absolutely incredibly small. So one of the key aspects of investing is that if you can have capital that comes out of a business and you don't know where to invest, and you return that back to shareholders, the returns are not that great. If you can take that capital and reinvest it for a long period of time at 25 or 30%, it's actually a great business. So anyway, the point I wanted to make it's not cyclical, but the capex comes in cycles.
Well, interesting chat yesterday with regard to hospitals on Market Forum. But we keep getting you bites all through the day as well as, through the week as well. Interesting comments coming in there. But it's weekly expiry, so let's do a quick check then on the F&O market. We have the Nifty options data that comes up for you on the screen. The 24,250 call, the premium has come down from around 140 rupees at the end of yesterday. It's come down to around 15, 16 rupees or thereabouts. Similar is the case with regard to the 24,200 call, which is the strike where we are at. Now, the premium out there, it started the day at around 180 rupees. It's come down to close to around 50 rupees approximately. While on the flip side, the 24,200 put, the premium is holding at around 6 rupees approximately. So they are betting on the Nifty seeing a bit of a slide in the final. Those put buyers are betting on a bit of a slide in the final 30 minutes or so. Moving to the levels, then today's low becomes the important level, 24,175. You don't want that to get breached on the downside. And unless something really takes off from here on, then the resistance level appears at around 24,275 going by the options data we're looking at. Individual stocks, well, stock futures should come up for you. Polycab, that's a stock we chatted with Sudarshan in the morning as well. There's suddenly some open interest built up and some kind of weakness that is creeping in there. The intraday chart will tell you the picture that appears. There are some shorts creeping into the system. Let's see whether or not there is some news in the offing. But that's a stock that we're looking at. The other one is Vodafone Idea. On a day-to-day basis, you're seeing a bit of a squeeze on that name. And that's why, in fact, that stock as well is perked up a little bit. So it appears the shots are covering out on Vodafone Idea. We'll keep an eye out on that particular name. For the time being, we'll slip into a short break. As always, we'll get you a quick check into dealing rooms. Nimish will be joining in to tell us what's going on D-Street Chatter. Technical experts will be back with us as well. Stay tuned. Welcome back. Well, let's hop across to Nimesh. He's joined to tell us what is he picking up on D Street chatter. Nimesh, take it away.
Hi, Nigel. From a market perspective, it looks like it's again a lackluster day of trade, but that seems to be the mood, at least in the conference. I've been here for the last 2 days. At least from a investor perspective, there seems to be a lot of optimism, largely because the earnings have been quite strong. So a lot of fund managers do believe that maybe we're at the cusp of a earnings rebound, and which is why there is a bit of optimism. However, it doesn't reflect in the market of late. I guess that the reason for that is maybe there is so much of supply of paper and IPOs which is in the market these days that there is hardly any interest in the secondary market. Look at what's happening to all the recent IPO listings. All are buzzing, large volumes and are hitting upper circuit. So that's where the focus seems to be. And even in the broader market, it's getting narrower and narrower with every passing day. So very selective stocks participate on the upside. Otherwise, it's been quite lackluster. Even from a volumes point of view, my sense is for the last couple of days, the activity has been on the lower side, both from the DIs as well as from an FII perspective. I guess, as I said, number of IPOs which are lined up, the QIPs in the blocks which are lined up, maybe it'll cap the upside in the very near term. But from a mood perspective and from positioning point of view, investors are looking for newer ideas and are hopeful that, this earnings cycle is likely to continue. So maybe, you might see once the supply of paper dies down, you might see a bit of rally in the secondary market as well. But as things stand, currently the mood seems to be largely in the IPOs and in very selective broader market stocks.
Well, absolutely. Nimesh, in terms of specific stocks, what's on the radar?
Well, as I said, the big theme seems to be the IPOs and block deals and QIPs. The first stock on my list is travel food services. It's been buzzing off late because Q1 was quite strong, but I believe there could be a large block deal in travel foods very soon. More than 10% equity is likely to come for an offer in the very near future. So watch out for large block there. The second stock is Jana Small Finance Bank. It's been buzzing post Q1 earnings and has been quite, even on the volume side, it's been quite active from larger HNI desks. And even in Jana Small Finance Bank, the street is anticipating a large corporate development very soon. So watch out for that. The third name is Piramal Finance. It was part of my chatter list a couple of days back as well. Looks like the QIP is around the corner and the company is likely to raise funds by QIP very soon. So watch out for that in Piramal Finance. And the last is AB Capital. Within the NBFCs, this is one stock which stands out in today's trade and off late as well, largely because I believe there is very strong buying flows from larger FIs, and one large institutional investor seems to be buying as well AB Capital at current levels.
Yeah. Nimesh, I think in Jana, the last transaction was, I think TVS buying some 5%, right?
Yes. So they already bought 5% stake.
Yeah.
There is...
Go on, Nimesh.
No. So the fact is that yes, the TVS has bought 5%. They have a room to go to 10% as per the RBI guidelines. So, and TPG is a one large private equity investor who is looking to sell some stakes. So maybe that transaction can happen. But also beyond that, there is an anticipation that maybe further more developments on the corporate side is lined up. It's going to take some time, but there is, at least from a direction point of view, the indication that I'm getting from the bankers is that some deal is brewing in Jana Small Finance Bank. So watch out for some corporate development in the very near future. It's in the works, might take some time, but there is something on the corporate side which the bankers are working on, is the sense that I'm picking up as far as Jana Small Finance is concerned.
Okay, all right, Nimesh, we'll keep an eye. Thank you very much for that. So Jana is FB in focus. So it's 3:15, which basically means that regular trading is stopped on the indices and, of course, stocks with the F&O contracts on them. And we transition to the cash segment. 3:20 is when that starts. You can start punching in orders 3:20, which then goes on till 3:28. And of course, there's a random close between 3:28 and 3:30. So today, of course, is also the NSE weekly options expiry. And let's just hope, fingers crossed, that it's a calm, quiet day. And compared to where we've closed things on the Nifty, which is 24,166, you're not wildly off. You're not wildly different as far as the the discovered price is concerned. So 24,166 is the reference price you need to work with. And we'll see what happens on the other side of the cash session, which is starting at about 328, 329 or so. Is typically when we get those rates which start to come in. So that is the picture. I think Mitesh is with us with what he'd like you to do as far as trades are concerned. Mitesh, what do you have? The audio is a little off. Mitesh, you sounded like Bane from The Dark Knight. I don't know if you've seen. Sorry, that's the throat of the mic.
I think throat.
No, it's the mic. Now your voice is fine. Go on, Mitesh. Your trades.
BTST with a stop at about 3019 for targets of 3075. And MFSL is the other one. BTST with a stop at about 1570 for targets of 1600.
Sorry, that was too fast. Which was the stock, Mitesh? Max Financial.
Yeah, Max Financial.
Okay, all right. I think there is a bit of a throat also there. Mitesh, thanks very much for that. Take care, and we'll speak again soon. So that is those are the trades which are coming through. But I think we have Jai Bala now with us. Jai, good to have you with us here. Good afternoon. Appreciate your time here as always. Your quick word in. 10, 11 days. I mean, it's like every day lower highs, lower lows, and the market slowly kind of sort of deteriorating. How would you read it?
Thanks, Prashant. Yeah, the markets have been dipping lower, and I pointed out to markets coming closer to 24,100 and then turning around. It's come very close to that. This zone of 24,100 to 24,050 is extremely crucial. See, as I pointed out on the 4th of August, the main risks for the equity markets are coming from cross assets. By that, what I exactly mean is the markets have been bearish on crude since April, and the crude declined to 67. From then on, crude has rallied to 93.5, and that has been consistent with a corrective bounce. But any move above 93.5 will have a second-order effect. So far, it's been the bond yields that have been taking the brunt. But any push above 93.5 on WTI crude will have second-order effect on equity markets. So the bond route that will extend, and that will have knock-on effect on the equity market. So watch out, 93.5 on WTI as a very crucial reason. Then if it goes above that, like I said on August 4th, I will revise my objective probably to 145 crude. So I'm not expecting this to happen, and I don't want it to happen. But if it does, I will flip my view on crude.
Got it. Okay. All right. And on the Nifty and the Nifty Bank levels?
Yeah, see, Nifty is, like I pointed out, 24,050 is the maximum it can pull back lower. Ever since the CAS session began on August 3rd, it's been a slow bleed down. So we want to watch between 24,050. If it doesn't hold, the bullishness that I'm anticipating into the Diwali season, that will probably get delayed, and we're probably getting the record highs probably only in 2027. So watch out, 24,050. But if that breaks, I might be open to considering lower levels of something like even 23,000. When it comes to the banking index, it's slightly better off than the Nifty. It's got higher high sequence there, but it needs to hold about 55,800 for the bullishness to stay intact. So anything below 55,800, I may have to revise my objective on the lower side.
Okay. All right. What about gold? $4,400. You could argue that it was $5,500 earlier this year, which went to sub $4,000, but now it's making a strong comeback. And even silver from the recent lows, it's half from the top, but it's popped 15%. Your take?
Yeah, I have a divergent view on gold and silver. I believe the low is in for gold. The June 30th low on the London spot gold was 39.45. That low, I think, is there, and it's not going to break. But silver is giving a slightly different message that the low at 55 and change may not be the final low. It probably needs one more low to come through. So either the dollar index strengthens from here and silver breaks the low, but gold holds the low of June 30th, or one of this assessment is going to be wrong, and I'm leaning towards the bullish side on the precious metals. From the low that we saw in June has the potential to be a very important major low for gold, and it's probably taking to fresh all-time highs, somewhere around the next 12 months.
So this is the time to buy. That's what you're saying, Jay?
That's right. See, either the June low is already in, or the next further low for precious metals is actually is a bottoming process. So yeah, you're absolutely right. if you can, stagger your purchases from here on to the next oncoming pullback, I think that will be an important accumulation point from a medium to long-term perspective.
What's the is there a typically what's the correlation between gold and oil?
Yeah, there is, of late, it's been silver that's been leading the markets. And recently, since the West Asia crisis, gold and silver have been on the opposite sides. So basically, if gold were to, crude were to rally, the precious metals get thrashed a bit lower. Silver is more sensitive to it. So, so that is also pointing to the probability that maybe we're not going to see further higher highs on crude. But 93.5 is absolutely crucial for me. So that doesn't tally well with silver trying to make a new low. So one of this is going to be getting revised.
Okay, all right. Stay with us, Jay. We'll just come back and, you got a bunch of positional trades also, which you usually put out. So we'll ask you for those. There's 8 minutes to go for market closing. It's 3:22, which means that the cash session is on. And you can see that the indicative price is changing. So 24,166, we're at about 24,167. It's absolutely flat. 73, 74. I mean, there's not very much, and I hope, fingers crossed, it stays like this without too much by way of change. Nifty Bank, 57,308 was the Nifty Bank reference rate, and we're at about 374 or so. There's about 3 minutes, 4 minutes to go. Actually, 5 minutes to go for the till the time that you can actually punch in orders, etc. So we'll have these rates up on the side of the screen. Take that break. We are back in just a bit on the other side.
Welcome back. I think we have the Nifty rate, I think, should have come up. I think we should get it up. Yeah, the indicative closing, I think it's still settling down, 24,140 approximately. But we've got a couple of calls coming from Jay, so let's get that out of the way. Jay, individual stock calls?
Yeah, actually, I just have one today, Nigel. It's Cube Investments India. And I'm bullish on the auto ancillary space and capital goods space and realty. And this stock has exposure to two of this, auto ancillary and the capital goods space. And so this stock, the 2026 low was about 20.64. From there, it rallied to about 3335, and then it's pulled back to the 50% Fibonacci retracement, and it's rising very sharply. That tells us that the next leg of the up move has possibly begun. So a stop loss of about 2665, and if the stock were to close about 3400, there's even potential for this to scale fresh record highs. So this is looking very interesting at current juncture. More than price objectives, the stop loss is more important, 2665 on a closing basis.
What about last week's call? I think you had another pick, right, in there that did pretty well. I can't recollect, but I recall it was up and you were still bullish on it. Which one was that?
Yeah, last week's call was LG Balakrishna, and another one was Kulti Patil, and I was expecting that to get accumulated on pullback. So yeah.
So are you still bullish on Kolte Patil after the 22% run, or it's done?
Absolutely, I'm bullish on the real estate space. Like I said, on the 7th of April, I'm expecting the real estate sector to scale fresh all-time highs. I'm still maintaining that view. And we have seen a rally from 600 odds to about 940 for the Nifty Realty Index. I think it's heading for something like 1100, 1200 potential in the next 3 to 4 months. So Kolte Patil is, after a 20%, near 20% circuit, it's pulled back. I think it's still got potential to scale about something like 700 odds for me.
And the IT sector is selling off today. I mean, just to revise the view there, Jay, have you changed it? What's the view?
No, as I said, the July 1st low, which for the Nifty IT index is still suspect low for me. But the rally since the July 1st low is looking bullish. So there is a contradictory signal that's coming from the Nifty IT sector. So like I said, I don't want to touch the large cap space. If I want to participate in the IT sector, I will be participating through the mid cap and small cap space like Tata Technologies, Saxsoft, and Newgen Software. So I would be a bit cautious on the large cap IT, but I don't know actually what the low meant, or the July 1st low, because the move from the April highs to the July 1st low is suspect one. It says more lows coming, but whereas the rally from July 1st high to the August high is saying it's quite bullish. So I'll wait for the markets to give its verdict.
I think the cash session has, it's 329. So between 328 is the last you can punch in orders, and between 328 and 330 you get the price.
Yeah, more or less.
It's the same. Yeah?
24.15, right?
Okay, 24.15. We should actually put up that other graphic. Actually, just refresh it. Maybe it should come up. And I think we have a comparison graphic as well if you're able to put it up. 25, yeah, that's the one. Not this one, please. The other one. The live graphic, the one we put up before this, I think that'll tell you the the final rate and the difference compared to the 315 rate, if you can have that up. So it's a 10-point difference. So it's pretty marginal. It's very small. No wild fireworks one way or the other, which hopefully then essentially would mean that maybe on the option side as well, things have not gone haywire and crazy, right? So 24,155. That's you see that last tick which is coming through. Slightly lower. I don't think that entire thing is 10 points. I mean, I think that started at about 3 o'clock when the market started selling off. But there's just a 10-point change, which is between 315 and 330 or so. If you can put the graphic up, which is the the live, I think we have the difference. The 315 and the 330 price as well. I think that's pretty instructive on the Nifty Bank, and the others as well. I think we'll be able to pull that up a little bit from now. I think markets have also shut. Nigel.
The big change would be on the 24,200 put, on that one, because at around 315, the premium out there was around $17. And since the Nifty has ended at around 24,155, that we end up with the premium of close to around 42 rupees approximately. So basically, if you had bought the 24,200 put at around 315, you would have doubled your money at around 330. That's the kind of move. 17 rupees has become around 42 rupees. Today, in fact, I just made a quick note about that. And 42 rupees is more or less in line because the Nifty has ended out there. 42 rupees is approximately the difference between 24,200 and around 24,155. So I think that's the only strike where you're seeing a big shift as of now. Otherwise, since this change in the cash session was only around 11 points, I think it's par for the course.
Absolutely. The only thing, Nigel, is on calls. What would have happened?
Calls is zilch, no? It's come down to zilch because
because typically the 330 price has been higher than the 315 price, so calls went a little more expensive, expecting that there would be a move on the same direction, but it's gone the other way.
Yes, so 21 rupees on the 24,200 call. That was what it was at around 315. At around 327, 328, the 24,200 call came down to $8, and now it's down to zilch because we have ended so much away from that particular strike, not the 22,000 call. I'm talking about the 24,200 call. That should come up for you on the screen, and that's the number that you're talking about. So that's the one. I think let's get that up for you on the screen. I think we'll just have to refresh that plate actually because it's actually come down to zilch. Since we have ended at around 24,155, I guess we'll have to select the right expiry on that particular one. So no big change is actually good news.
No, but Nigel, the point is that the options are still trading. They're still trading all the way to 340.
Right.
So I think, going into the final close, I mean, but in any case, the calls would go to zero. And since the market's essentially gone the other way. Anyway, it's a pretty well-behaved close all told. 10-point change, 11-point change, we can live with it. Not like the 200-point change we had on the first NSE weekly options expiry, which was, Tuesday, the last Tuesday. That was, of course, week 1. This is week 2 now for the CAS session, the 10-minute, 15-minute change in terms of how closing values are calculated. It's a wrap on this edition, a closing bell. Thank you very much for staying with us. Markets Forward will pick up on the action in just a bit. Stay tuned.
Markets end at the day's low on weekly expiry with all four major indices losing around 0.3%. The Nifty slips below the 24,200 mark.
Defence indigenization gets a fresh push with the government notifying its sixth list covering 405 strategically important items. Defence stocks block up the trade.
Paytm promoters sell shares via block deal for the benefit of Antfin, while Netweb Technologies and SPR Auto launch QIPs to raise 1,200 crore and 1,000 crore rupees respectively. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra, and with me is my colleague Vivek Iyer. Vivek, good afternoon. Well, weekly expiry and that last few minutes of sharp fall that we saw on the Nifty as well ended below that 24,200 mark. Throughout the day, we were just consolidating at those levels, but ended the day sharply lower and a sharp fall on the Nifty as well. Defense pack did well, but we did see some pressure coming on Nifty Bank. IT also did not do so well, and that continued to put pressure on the Nifty as well. But we do have a power pack show for you, and that is something we'll talk to you about. But yes, continues to be a down day.
Continues to be a down day, and the good part is, today's expiry, you didn't see too much of a change of volatility, especially when it came to the last 10 minutes from the CAS time and to the time in which the actual Nifty end came about. But a lot lined up on the show, so let's see what we have in store for you today. We'll start with the top movers and shakers of the day with Hormuz Fatakia. From Milky Mist market debut to the big opportunities in emerging for defense players, from the latest indigenization push, we will decode all the key developments. And last but not the least, we'll delve into the key markets events to watch out for in tomorrow's trading session. Now, first on to our first segment of the day, Hormuz Fatakia joins us now from the big wall with all the top movers and shakers of the day. Hormuz, over to you.
A forgettable day for the bulls nonetheless, and the Nifty ending below a crucial support level of 24,200 and opening further downside now towards that 24,000 mark, being the weekly expiry in today's session. IT was a principal contributor to that fall in today's session, be it large cap IT or be it mid cap IT. Both of them are equal contributors. Infosys, HCLTech down 2% each. Emphasis and LTM also declining up to 3% in today's trading session. You take a look at the newsmakers beyond IT, and there were plenty of them. Tube Investments, after some positive management commentary in its earnings call, the stock ended 8% higher. Aegis Logistics on the back of a report which said that it is in setting its sights for an acquisition, then that stock ended 6.5% higher. Nelco, of course, the worst single day fall in over 6 years. Colgate ending 3% lower, some cautious commentary as well during its analyst day. And Paytm, after the block deal, ending 2% lower in today's trading session. You take a look at some of the other stocks that made headlines in today's session were the defense names, and Paras Defense. Of course, the smaller defense names were the ones that were in the thick of things. Paras Defense is up 10%. Zentech was up through the day, 6.5% higher. Dynamatic Tech and Data Patterns too, ending with gains of anywhere between 4 to 6% in today's session. Unfortunately, capital market stocks did not have a very good day. Contrary to defense names, Grow, CAMS, JM Financial, all of them saw losses of anywhere between 1.5% to 3% in today's trading session. And lastly, despite a wobbly weak market, there have been stocks that ended at record highs today. Bosch being one of them, now nearing the mark of 50,000. Another 4% added to today's trade. Craftsman Automation too, ending another 3-4% higher today. Lenskart continues to grow higher. 600 plus now is where Lenskart is, another 3.5%. And Netweb, after the launch of its QIP, at another record high, well over 5,000 rupees now, 2% higher on that one as well.
Okay, some interesting names which are buzzing around in trade today. Thank you so much, Hormuz, for joining us. Let's talk about the first story that we are tracking. Bharat Electronics and Hindustan Aeronautics, among other defense stocks, were in the spotlight after the Defense Ministry identified 405 defense items for indigenization with an estimated potential of 3,000 crore rupees. Ria joins us with more details on this one. Ria?
Well, the Department of Defense Production has come out with its sixth positive indigenization list, or the PIL, which includes 405 strategically important defense items for indigenous development, and the business potential from this is estimated at nearly 3,070 crores, and this includes 389 items for defense PSUs and 16 items for the Indian Coast Guard. Now, in terms of what is included in this list, we have aircraft like the LAH and LUH, armored vehicles like the T-72 and T-90 tanks, naval warships, missiles, electronics, as well as ammunition that is a part of this list. And once all of these items are indigenized, they will be procured from the Indian industry, which will create a potential revenue opportunity for domestic defense companies. And we will also be seeing significant participation from MSMEs as well as other domestic vendors in this. Now, in terms of the timelines for this, this ranges anywhere between December 2026 and the end of December 2032 in terms of the indigenization timelines. And let's also take a look at some of the key listed beneficiaries from this list. We have BEL and HCL, which account for nearly 77% of all of these items from the entire list. And there's also stocks like Bharat Dynamics, Garden Reach Shipbuilders, BEML, as well as Medhani that will see some benefit from this.
Well, thank you so much, Ria, for joining us, giving us all of the updates as far as the defense space is concerned. Well, to take the discussion forward, we are now joined by Jayawala from Cash the Chaos and Sudeep Bandopadhyay from IndiTrade Capital. Good afternoon, gentlemen, and thank you so much for joining us. Well, Jay, let me come across to you first. For the last 11 trading sessions, Nifty has not managed to break above its intraday high. Where do you see markets headed from here on? Will it continue to remain to trade in a range?
Anyway, the Nifty has come to a very crucial support. That zone of 24,100, 24,050 must absolutely hold. And from a cross perspective, even crude is coming to a very important resistance. So if crude shouldn't cross about 93.5 for the second order effects of the bond yields trickling into equity markets. So far, the equity markets have been resilient with higher bond yields. But anything about 93.5 on WTI crude will start having second sort of effect on equity markets. So watch the 24,050, 24,100 zone as a very important support. We don't want the Nifty closing below that. That will delay the onset of bullishness, which I've been maintaining for the last several months. And we might see a revisit of 23,000 or probably lower if we have to close below this critical zone. So we are at an important juncture from a 1 to 2 day perspective.
Okay, all right. So that's the technical view. Sudeep, coming on this, do you think crude could be the biggest fundamental risk to markets from here on?
Well, the fundamental biggest risk, of course, is oil prices. I mean, we know the geopolitical scenario, and the oil prices going up doesn't augur well for Indian market and Indian economy. And of course, the market is pricing that in. And the pressure we see in Indian markets is on the back of oil prices going up. Things are kind of a stalemate. But if there is further escalation or people stop using from their existing fuel stock and come to the market, particularly for China, I think that will put further pressure on oil prices, and that doesn't bode well for India. So we have to be cognizant of that and be very careful in the current circumstances.
Okay, take that point. Gentlemen, hold on. We do have some more stocks to talk about. Milky Mist, that's the stock. It made a stellar debut on the street. The company listed at an 18% premium to its IPO price and ended the day nearly 30% higher. So how does Milky Mist stack up against its listed peers? Rima is here with all the details. Rima.
Thanks so much for that. So Milky Mist was expensive to begin with, but now with the kind of bumper listing that we've had, the stock is trading at 41 times FY28 PE, far more expensive than peers like a Dodla Dairy, Heritage, Parag Milk, which are trading at valuations in their mid-teens. Hudson Agro is the only one with a comparable valuation multiple. That too is cheaper at 35 times, and Hudson is a company whose top line is almost 2.5 times that of Milky Mist. In fact, Milky Mist valuations at 41 times is closer to consumer valuations. So look at a Tata Consumer or Britannia, both of them are trading at valuations closer to 43, 47 times. So the question is, why does Milky Mist command such premium valuations? For starters, look at the expected EPS growth. FY26 EPS for the company was 2 rupees, expected to more than double to 4.3 by FY28 and further increase to 5.6. So the bottom line growth is going to be very strong. And secondly, this is a company which is growing faster than peers. Now, over FY26 to FY28, Milky Mist's top line is expected to grow by 25%, while peers are expected to compound and grow between 11 to 17%. And secondly, because this is a company which gets 100% of its revenues from value add, it doesn't sell milk which is low margin commoditized. Its margins too are higher than peers, trading at 14.4%.
Well, thank you so much, Rima, for joining us and giving us all of the details as far as the latest kid on the block is concerned. Sudeep, let me come across to you. Have you had a chance to look at Milky Mist? And within this particular space, within the dairy space, what's your top pick?
Well, Milky Mist definitely does look good. I think we should not compare them with the plain vanilla dairy companies because the Milky Mist sells only derivative products, value-added products. So their comparison should be closer to the other consumer companies like Britannia and others are much bigger and well established, but Milky Mist is on a similar mode. The valuation today after listing has reached 41 times and things like that, which is a little high. So I would be a little cautious and not advise a buy at this stage, but it is a counter to watch. On correction, this can be bought. Overall, in this entire space, we do like Hudson Agro. I think this is a good buy from investor point of view from a 1 year plus hold.
Okay, take that point, Sudeep. Jay, I wanted to ask you about the Nifty IT index. If we talk about the top losers today, we did have Infosys, Wipro, HCLTech, TCS amongst the top 10 losers that we saw today. Will this weakness in the IT index continue? What are the support levels here?
Yeah, see, I don't have a very good handle on the Nifty IT index now, and as far as supports go, 29,600 to 28,900 is the very, very important support for Nifty IT index. And the reason for this is the July 1st low on the Nifty IT index. From a price structure perspective, it's not a clear and durable low for me. But whereas the rally from July 1st low to the August highs is looking bullish. So there is contradictory signal that's coming from the Nifty IT index. So I would rather wait for the markets to resolve itself one way or the other and then take a stand. And I've been saying that, it's better to avoid the large cap IT names rather than look at, the mid cap IT, small cap IT, if you want to get exposure within the IT space. So, within the mid cap and small cap ITs, I like Tata Technologies, Newgen Software, and Saxsoft. So, if you have to get an exposure, I would rather look at these names rather than looking at Infosys, TCS, HCLTech of the world.
Okay, thank you so much, Jay, as well as Sudeep for joining us, giving us a view on the market, stock-specific views, as well as your top pick in specific sectors. Well, moving on, a lot of stock-specific action today, from earnings and block deals to fresh fundraisers. Let's get you across the key stocks to watch and what's driving the action. Ananya joins in with all the details.
Well, yes, let me first start with the one of the top gainers today, Indomim. The stock was surging on back of its strong Q1 results. If you look at the numbers, the revenue was up around 9% and profit up around 32% here. Now, let us also talk about Paytm. It was down as founder promoter entity Resilient Asset Management plans to sell up its stake up to 4.98%. Now, Colgate Palmolive India was also under pressure on the back of its con call, where management said it will prioritize growth over near-term profits, increase ad spends, and also acknowledge weakness in Palmolive. Now, Nelco was also under pressure after announcing a $20 million or around 200 crore investment in a US satellite company that has not started earning revenue yet. So returns could take time and will depend on satellite deployment and regulatory approvals here. Now, Seagull India was also down after Delhi PWD cancelled a 330 crore tender where it was the lowest bidder. Now, Netweb Technology was rallying after opening its QIP at a floor price of 4,885 rupees per share. Now, Sigma Advanced System was also in focus after winning 155 crore of anti-drone orders, and also broader defense stocks were also buzzing after the Defense Ministry listed 405 items that will now be bought from Indian companies instead of imports.
Thank you so much, Ananya, for joining us with all those stock-specific updates. But let's go across to Nigel now for a quick check on premiums on expiry day. Nigel, what did it look like?
Well, it was a weekly expiry that played out today. And the good news was that the cash session wasn't too volatile because the difference between 315 as well as 330 was only around 11 points, and that too on the downside. So actually the put buyers in the final 30 minutes, they had a good session. I'll tell you why. Because at around 310 to around 315, if you pulled up the intraday chart on the Nifty, you'll see that in fact, we saw a bit of a dip. And then in the cash session, we ended close to around 11 points lower as well. So for example, if you look at the 24,200 put, at around 315, it was ballpark around 15 to around 17 rupees. By 328, that number had gone up to around 28 rupees approximately, and it ended at around 45 rupees, which perfectly tallies with the close on the Nifty. So the put buyers did make money out there. And the good news is that the 45 rupees, exactly tallies in with that number of around 24,155, which is the close. On the flip side, the call writers, well, they would have gained close to around 20 rupees approximately because the Nifty ended lower. So obviously, the call buyers will not make any money. In fact, the writers will take home close to around 20 rupees. So that was how weekly expiry played out. The difference between 315 and 330 was only around 11 points approximately. So that's why we didn't see any big swing, but it played out perfectly to the plan of the put buyers, whose money close to have more than doubled just in the last 15 minutes from around 17 rupees. It ended at around 45 rupees. Back to you guys.
Well, thank you so much, Nigel, for putting in the spotlight as far as premium movement on expiry day was concerned. Well, with that, it's time for a short break. We will get you the top corporate voices along with the key market events to watch out for on the other side. Welcome back to Markets Forward. Well, let's listen to some corporate voices of the day. The management of PB Fintech has said that the company expects growth to remain around the 30% mark. Speaking to CNBC TV 18, the management added that their strongest growth drivers come from its term and health insurance verticals, which will continue to grow at 45%. They added that the Supreme Court directive on extending third-party insurance covers of new vehicles by a year will bring a major fillip to the industry.
Electronics market India expects to deliver around 20% revenue growth in FY27 after a strong start of the year. The company's management told CNBC TV 18 that top-line growth driven by demand and price escalation. The company also expects margin to rise 7% for the year.
And before we wrap, we bring you some of the key market events to watch out for in tomorrow's trading session. Ananya Singh is standing by with all the key events.
Well, starting with the global cues first, the biggest focus will be on the US Fed meeting minutes that was held on July 28-29, which will also give more clarity on the interest rate outlook here. Now, also in focus is the additional 50% US tariff on Canadian imports, along with earnings from major retailers, Target and Lowe's. Now, President Trump is also expected to meet crypto industry CEOs, while Lintris is set to make its debut on the NYSE. Now, coming to domestic events, the SEBI chairman and DEA secretary will address FICCI CAPM 2026, while the cabinet meeting will also be closely tracked for any key policy announcements here. Now, SpiceJet will remain in focus ahead of the NCLT judgment in the Aviator ML case. We also have our CNBC TV 18 Banking Transformation Summit, where commentary from the banking sector will be of the utmost importance. And finally, in the IPO space, the 2,600 crore Horizon Industrial Parks IPO and the 1,700 crore Lalita Jewelry Mart IPO will close, while the 550 crore Gaja Capital IPO opens for subscription. So watch out for these events.
All right, we will do that. Ananya, thank you so much for joining us with all those details. And with that, it's a wrap on this edition of Markets Forward. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
and welcome to Business 360. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you this evening. Oil prices rise as the deadlock between Iran and United States worsens supply risks. Trump says Iran should put up the white flag or surrender, adds they are not interested in seeking an extension after the ceasefire pact expired yesterday. Tehran indicates they might adopt a more aggressive strategy. A vessel transiting the Hormuz Strait suffers damages after being hit by an unknown projectile. Sensex and Nifty declined for the sixth straight session and at the day's low point on weekly expiry day after minor adjustments in the closing auction session. Rupee weakens marginally against the dollar to stay above the 95 mark. The annual shareholders meet at Tata Sons gets adjourned today for the first time in its 108-year history due to the lack of quorum. The top brass of Sir Ratan Tata Trust is unable to nominate representatives to the selection committee to pick the successor to outgoing chairman N. Chandrasekaran following a restraint order by the Maharashtra Charity Commissioner. India considers relaxing rules to boost foreign direct investment. Individual ministries could be empowered to approve proposals worth up to 15,000 crore rupees. Also weighs easier rules for downstream investments. Defense Ministry unveils a new listing comprising 405 defense equipments, which will be the only sourced from Indian suppliers. The items include gears for light helicopters, tanks and light combat aircraft with an estimated business potential of 3,700 crore rupees. The government issued nearly 2 lakh blocking orders to social media firms between March to July. Indian Express reports 1 takedown order was issued every 68 seconds on average over 5 months. This period includes the student protests in Delhi, which led to the resignation of Dharmendra Pradhan as Education Minister. 1 in every 5 voters could be excluded from Maharashtra's draft electoral roll. Forms for approximately 2 crore 8 lakh voters could not be collected during the SIR exercise. Mumbai region could see the maximum deletions. Names of more than 47 lakh voters of 33% could be excluded from the Delhi draft electoral roll. The PM Cares Fund discloses a corpus of more than 8,400 crore rupees as of March 2025. The disclosure for FY24 and FY25 comes after a 2-year delay. Nearly 80% of the funds, worth over 6,600 crore rupees, is parked in fixed deposits. Also on the show, India's top hospital operators say private equity is not in the driver's seat and not involved in any clinical decisions. Also oppose parliamentary panel's recommendation to impose curbs on foreign ownership. The top story this evening, the deadlock between Iran and the United States continues as tensions rise in the Strait of Hormuz. President Trump's son-in-law, Jared Kushner, told Fox News that Iran is not showing any interest in striking a deal that makes sense for the United States. He added that Trump is focused on exerting economic pressure on Iran and ensuring it cannot build a nuclear weapon. This, as Trump said, Washington is not interested in seeking an extension after the ceasefire pact expired yesterday. The IRGC has denied Trump's claim that his administration has established a direct back channel with them. Iran reiterated that the strait will open only after the U.S. naval blockade is lifted and all military threats and operations were stopped. Brent crude prices were back above the $90 mark as tensions rose in the strait. This after a cargo vessel was struck by an unknown projectile. The UK Marine Trade Organization said that 1 crew member was killed and the ship's engine room was damaged. The traffic through the waterway remained muted. Tensions were equally high in the Red Sea. Yemen's Houthis said it targeted Saudi Aramco's Jazan refinery. The militant group said the attack was in response to the violation of Yemeni airspace. This comes after the group said it attacked a Saudi military ship and 4 escort vessels with ballistic missiles yesterday. Dalal Street closed the day lower after weak global cues dented sentiment. Nifty ended below the 24,200 mark, while the Sensex fell nearly 500 points. This is the sixth straight session of losses. IT stocks were the major drag. Broader markets fell in line with the blue chips. Only 10 Nifty stocks closed the session in the green. Tata Sons' annual general meeting was adjourned for the first time in its 108-year history due to a lack of quorum. Now, the deadlock stems from a restraint order by the Maharashtra Charity Commissioner, which prevented Sir Ratan Tata Trust from nominating a representative. Now, the impasse could also delay the formation of the search committee to choose a successor to N. Chandra, who will exit the company when his term as chairman comes to an end in February. Rachna Dhanrajani joins us now with all the latest updates from Bombay House. Rachna?
Well, yes, I am outside Bombay House, and a short while ago, in line with what we had reported, that the Tata Sons AGM has now been adjourned. Well, the meeting started at around 2:30, and after 30 minutes, it was adjourned as the Articles of Association had mandated it to be. For a meeting to be adjourned, it had to convene as scheduled, which was at 2:30 p.m. this afternoon. And after waiting for about 30 minutes for the quorum, and since there is a lack of quorum today, the meeting has now been adjourned. Now, the steps from here on, like we've reported before, is that the group gets about a 1 week of adjournment, but in this 1 week they have the option, and from our sources we've learned that they are exploring this option, which is to reach out to the ROC, the Registrar of Companies, and seek an extension which can run up to 3 months. Now, if that happens is what we'll have to see. But speaking of today's meeting, it was attended by N. Chandra and Anita George right here at Bombay House, that's behind me. But apart from that, Harish Manwani joined online. Other members, including Noel Tata, also joined online. I remember this is the 108th AGM, and the participants also included Sunil D'Souza of Tata Consumer, R. Mukundan, Venu Srinivasan, Puneet Chatwal of IHCL, Kaushik Chatterjee, Dr. Praveer Sinha of Tata Steel, and Mehli Mistry, who came in as the executor of late Ratan Tata's will. But for now, the AGM stands adjourned. For the next steps, we'll keep an eye out for, because now the matter gets even more serious. Now, the lack of quorum at the meeting was due to lack of a joint representative appointed by SRTT and SDTT, and SRTT cannot hold board decisions, cannot hold board meetings to take that decision, and that is why no nomination. But from here on, as we know that Mr. N. Chandra has decided to step down, but for that selection committee to kick off the process for his successor will also require not one this time, but 3 representatives jointly nominated by the two trusts, that is SRTT and SDTT. And one of those 3 members is also supposed to chair the selection committee. So from here on, we'll have to see what the Tata Sons is likely to do, because now it's not only about the AGM, on which the agenda of the AGM was FY26 dividend and FY26 accounts, apart from that extension of directorship of Mr. N. Chandra, but now also the successor of Mr. N. Chandra is in question. And remember, it is only till February that the group has the time to find the next chairman of Tata Sons.
So, Rachna, there with the latest from the Tata Sons AGM, which has been deferred. Many thanks for those details. Milky Mist Dairy Food made a strong debut on the bourses, listing 18% above the IPO price. The 1,500 crore rupee IPO was subscribed over 56 times in the primary market on the final day of bidding. After the robust debut, the stock extended gains and ended 10% in the green.
Let the bells ring.
Shares of Paytm fell in trade after nearly 2 crore shares amounting to 3% equity changed hands on the bourses. The total transaction value is set to be 2,950 crore rupees. Sources say promoter entity Resilient Asset Management was set to sell up to nearly 5% stake. The base offer size was at 3% and upsize option was of nearly 2%. Grow fell 4% after 7.78 crore shares changed hands in 2 block trades worth nearly 1,500 crore rupees. That accounts for nearly 1.2% of the company's equity. The shares changed hands at a little over 193 rupees apiece. India is considering relaxing FDI norms to boost foreign investment. The government may allow individual ministries to approve investment proposals of up to 15,000 crore rupees without a formal cabinet-level clearance. Earlier, the cap stood at 5,000 crore rupees. Abhimanyu Sharma is here with all of those details. Abhimanyu?
FDI equity inflows into India had increased over 18% in FY 25-26, and several other measures are being taken by the union government to make the prospect more attractive for foreign direct investment flowing into India. Now, a proposal is in the works currently in which the government is trying to make the prospect more attractive, more lucrative for foreign investors, in which the proposal has indicated a higher threshold for FDI proposals, which will remove the rupees 5,000 crore cap on FDI proposals, which currently required to be approved by the union cabinet. Also, the proposal is indicating that the rupees 15,000 crore cap is also going to be removed, which till now required the approval of the cabinet committee on economic affairs. The proposal involves removal of multiple clearances for FDI into subsidiary companies, which till now required different clearances, separate clearances, and the proposal has indicated that only the parent company will once require an approval, post which no further approvals will be required by any of the subsidiary companies to bring in FDI into India. It remains to be seen how early the proposal is going to see the light of the day, how early it's going to be implemented, and also more details are awaited about which sectors are possibly going to benefit from this proposal.
All right, Abhimanyu, many thanks for those details. Now, the Defence Ministry has launched the 6th indigenization list comprising 405 items with business potential of over 3,000 crore rupees. Aishwarya Airy joins us now with the details. Aishwarya, what are you picking up?
The Department of Defence Production has released its 6th positive indigenization list, where it has identified 405 items to be developed and manufactured domestically. This is expected to create a business opportunity of 3,070 crores. Now, these are not platforms or weapon systems, but these are components, subsystems, raw material that will be used on these platforms. The items identified include components and subsystems for parts that are used in Su-30 MKI, Tejas, Advanced Light Helicopter, T-72, T-90 tanks, BMP-2 vehicles, missile systems like Akash, Invar and MR-SAM. Of the 405, 389 are linked to Defence PSU and 16 are linked to the Coast Guard. BEL accounts for 227 of these items and HAL for 86. Other requirements are linked to BDL, BEML, GRSC, Goa Shipyard, Hindustan Shipyard, Midhani and Munitions India. The indigenization deadlines on these vary from December 2026 till December 2032. Once an item is successfully indigenized, it will be procured domestically. The government says that since it has launched the Srijan portal, it has facilitated the offer of over 33,000 defence items for indigenization. Of this, in the past 5 years, 15,700 defence items have been indigenized, and it has replaced an estimated import cost of 9,000 crore.
All right, Aishwarya, many thanks for those details. Now, the Federation of Indian Pilots has urged aviation watchdog DGCA to overhaul drug testing rules. The Federation is seeking that the quota for random testing of pilots must be increased from the current 10% to at least 25% annually. Madiha Mujawar joins us now with all of those details. Madiha, take us through what the Federation has said on this front.
Well, there's a lot of speculation around the Air India AI 2379 flight incident, including questions around the pilot in command's drug test. But it is important to separate what is known from what is being speculated. The PIC did test positive in the confirmatory test, but crucially, he was not flying the aircraft when the incident happened. The first officer was at the controls. Against this backdrop, the Federation of Indian Pilots has now written to DGCA with a 30-page proposal to strengthen pilot drug testing. So what exactly is FIP asking for? First, it wants random testing increased from the current 10% to at least 25% of pilots every year, and pilots should remain eligible for repeat random tests. Second, FIP wants oral fluid or saliva testing introduced alongside urine testing because it says this could make testing faster and easier at airports and allow more frequent checks. And third, FIP wants risk-based post-occurrence and follow-up testing. It wants mandatory awareness programs for pilots covering drugs, alcohol, and even commonly used medicines. It is proposing a check before you take system. So pilots can check whether a prescription, over-the-counter medicine, herbal product or supplement could affect alertness, contain a prohibited substance or create a problem in their drug test. And importantly, FIP wants pilots to have confidential access to aviation medical experts before taking such medication. FIP says pilots should be able to seek that advice confidentially so they don't hesitate to disclose medication use out of fear or automatic punitive actions. This is what the FIP is recommending.
Right, Madhya, many thanks for those details. On that note, it is time for us to head into a short break. But coming up, 1 in every 5 voters could be excluded from Maharashtra's draft electoral roll after the SIR exercise. 33% voters may be excluded from the Delhi list. That and more on the other side. Stay tuned. Welcome back. You're still with us on Business 360. The government has sent close to 1.95 lakh content blocking orders to Instagram, Facebook and YouTube between March and July. As per Indian Express, this is roughly 1,275 a day or 1 every 68 seconds. Instagram received nearly 1 lakh of these orders, followed by Facebook at around 80,000 and YouTube at nearly 15,000. Together, Meta's platforms accounted for roughly 9 in 10 orders. Meta has taken steps to address issues related to child sexual abuse material following meetings with the government as per government sources. The government conveyed that no safe harbor protection would be available in cases involving such content if the law is violated. The government said WhatsApp's username policy is still under examination. The issue is not unique to WhatsApp, and similar concerns involving other apps are also being looked at. The Bombay High Court has directed Maharashtra's food safety body to pay a fine for keeping Guru Nanak Dairy and Sweets license suspended despite 98% compliance. The bench imposed a 5 lakh rupee penalty, calling the FDA's stance strange and perverse. The court has ordered that the suspension be revoked immediately. FDA Commissioner Tukaram Munde said he would examine the order before responding. 1 in every 5 voters could be excluded from Maharashtra's draft electoral roll. Forms for approximately 2 crore 8 lakh voters could not be collected during the SIR exercise. Meanwhile, in Delhi, names of more than 47 lakh voters of 33% could be excluded from the draft electoral roll. Santya Gora has more details on that front. Santya?
So yesterday was the last date to fill enumeration forms in multiple states and UTs under the third phase of the Special Intensive Revision SIR. And the data has started coming in, with urban areas recording the highest number of uncollected enumeration forms, falling under the absent, shifted, dead, deleted or duplicate category, the ASDD. If not clarified by submitting the required documents, these numbers could lead to deletion from the voters list, and voters will have to register themselves as new voters. Let's start with India's Silicon Valley, Bengaluru. The city has recorded the highest number of voters falling under the ASDD category. Out of 40.2 lakh voters in the city, 17.2 lakh voters or 42.9% were reported to fall under the ASDD category. The second on the list is Thane, a Mumbai metropolitan region city. In Thane, 28.61 lakh people or 38.41% of the overall 74.5 lakh voters are under the ASDD category. For Mumbai, with both Mumbai city and Mumbai suburbans combined, this figure stands at 35.6%, with 36.16 lakh voters out of the city's 1.03 crore voters falling under the ASDD category. The capital city, Delhi, has 1 out of every 3 voters falling under the category. In Delhi, 47.62 lakh voters, 33% of the city's overall 1.45 crore voters fall under the ASDD category. For Gurugram, this figure is 29%. Talking about states, Maharashtra has 2.07 crore people or 21.16% under the ASDD category, while Karnataka has 1.08 crore voters or 19.54% under the ASDD category. Rural areas have recorded much lower ASDD numbers as compared to urban areas, and the Election Commission has cited migration and mobility as the key reasons responsible for the high ASDD figures in urban areas. The Election Commission has also maintained that this won't lead to permanent deletion from the voters list. Once the draft roll is published, people can appeal and get their names added after providing the required documents. The EC has also maintained that voter list revision is an ongoing process and people can always fill Form 6 and apply as a new voter.
All right, Santya, many thanks for those details. Now, US President Trump has cited India's Chief Election Commissioner Gyanesh Kumar to make a case for stricter US voter ID laws. In a Truth Social post, Trump said Kumar had recently asked his administration how the US holds elections without a valid photo ID. Trump pointed to India's last general election, where every voter was required to hold valid photo identification. He used the comparison to renew his push for Congress to pass the Save America Act, which would mandate proof of citizenship and photo ID for US voters and sharply restrict mail-in voting. The PM CARES Fund has disclosed a corpus of more than 8,400 crore rupees as of March 2025. The disclosure for FY24 and FY25 has come after a 2-year delay. Archana Solanki joins us now with all of those details. Archana, take us through the key numbers.
Yes, so the PM CARES Fund has disclosed a corpus of more than 8,400 crore rupees as of March 2025. The disclosure for FY24 and 25 has come after a 2-year delay. This is, of course, the highest balance that has been achieved so far as of March 31st, 2025. Now, for the first time since FY 2022-23, the fund's audited financial statements have been made public. The statements for 2023-24 and 24-25 were uploaded on PM CARE's website on August 17th. Now, here are the key takeaways. Now, the total corpus of 6,641 crore is now invested in fixed deposits. These fixed deposits earned around 475 crore in interest during 2024-25. The fund received 479 crore rupees in domestic donations, while foreign donations stood at 92.82 lakh rupees. 87 lakh rupees is recorded as expenditure for the year ending March 31, 2025. Remember, the PM CARES Fund was established on March 27, 2020 during the COVID-19 pandemic as a dedicated national resource to respond to emergency and distress situations. The opposition and many activists have been raising questions over the transparency regarding the funds, especially because it doesn't come under the ambit of RTI Act and is not audited by the Comptroller and Auditor General or CAG. Now, the government has maintained that the fund is an independent public charitable trust and not a public authority under the RTI. Now, the audit has been conducted by KKC and Associates. They are Bombay-based chartered accountant firm, and they have been appointed as the fund's independent auditors for these 3 years. These accounts were audited on August 6th and signed by the auditors on August 7th, as the documents have been uploaded on the PM CARES website. Back to you.
All right, Archana, many thanks for those details. Now, US President Donald Trump's approval has fallen to 33%, the lowest of his presidency. 64% are now disapproving of his overall job performance. Majority of Americans surveyed said that they are worried that US war with Iran will drag on and cause oil prices to rise even further. The slide ties the low point of his first term back in December 2017. Paramount Skydance asked a U.S. judge to require a dozen states challenging its acquisition of Warner Brothers Discovery to post a $1.88 billion bond. Paramount argued that the bond would address the costs of delay in completing a tie-up. The company must pay a fee of $7 million a day if the $110 billion merger does not close by September 30th. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on the other side.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, India's floating solar market is a sunshine sector undergoing rapid expansion. But the bigger opportunity lies in country's vast potential for floating solar capacity. Let's look at India's present capacity. Well, it stands at around 0.8 gigawatts, while the country has potential to reach 102 gigawatts. According to the National Institute of Solar Energy, this estimate is based on using just about 20% of surface area of eligible water bodies. So which states have the highest potential? Well, Maharashtra tops the list with a potential of 16.28 gigawatts, followed by Madhya Pradesh, Karnataka, Odisha, and then, of course, Telangana. What are the opportunities? Well, massive untapped reservoirs, higher energy yields, hydro-solar hybridization, and then reduced evaporation and zero land use conflict. The floating solar systems can generate 5 to 15% more electricity than traditional ground-mounted systems. But no opportunity comes without challenges, and these include higher capital expenditures, structural degradation risks, fluctuating water levels, and then, of course, ecosystem impacts and other challenges. Joining us to take this discussion forward is Sanjay Banga. He is CEO and MD with Tata Power Renewable Energy, and Neha Agarwal is Senior Vice President Corporate Strategy with Vikram Solar. Thank you so much for joining in. And it really is a sunshine sector. Mr. Banga, let me start with you first. Large-scale floating projects typically demand significant upfront capital for specialized anchoring and mooring systems. Would you say that the markets are just about becoming competitive now, or is this a segment that still requires government subsidies?
So, Manisha, if you see the typical cost of setting up a solar plant, it's around 3.5 to 4 crore per megawatt in a ground mounted, and it's 1 crore more for the floating solar as such. Now, with the new scheme which is announced by government is a very, very positive step in this direction. So this will make virtually the ground mounted solar and the floating solar cost virtually same. And this is how it will promote more and more floating solar projects in India. And it is good because this piece of water, which is whether it's a reservoir or it's a backwater, can be effectively used. And the floating solar, as you mentioned, has a higher efficiency because of the cooling water impact. And the surface which was unused, when it is used for the solar plant, the water evaporation is also less. So it's good for economy also and good for energy transition in that way.
Mr. Banga, with projects like Kayam Kulam and Omkareshwar, how much of Tata Renewables energy future of 20 megawatts do you see coming in from this?
So this policy will really help all developers, not only Tata Power. Right now, we have around 200 megawatt out of our 7 gigawatt of portfolio. We already have taken around 2,500 acres of Ringoli Reservoir, where Odisha government wants to set up projects for floating solar. That will be adding to around 500 megawatt. And then how this scheme goes further, because as a developer, we will be bidding for more and more solar projects. And the good part with the floating solar is you don't have a land issue, you don't have ROW issues. The execution is virtually certain in case of floating solar rather than setting up a ground mounted solar. So we would be eagerly waiting for new announcement in this market for floating solar, and we would be very, very active.
Mr. Banga, I want to come back to the cost of this really, because one of your projects is brackish backwaters, the other is freshwater reservoir. So would you say that the engineering cost really varies when you look at various different environments, or would you say there's a standardized platform and there's not so much of a change that you have to do between two projects?
So if you see our two projects, one is in Omkareshwar, which has around 15 to 20 meters of depth of the water. So there the survey says that we have to incur more capex cost. In the Kayakulam, which we developed, a 100 megawatt project, there's hardly 2 and 3 meters of depth. So any floating solar projects, when we do a bathymetric study where we find what is the depth, how is the wave intensities, and the capex cost vary on that basis, whether it could be 25% more, it could be 35% more. So it depends on that. But the good part of this is still, I would say, the execution time is better as compared to the execution time if you don't have land and the transmission challenges you have in ground for the solar projects. But in terms of engineering as such, it's not very complicated. It of course the cost varies because of the depth, and sometimes when you have more waves. For example, in our Kayakulam projects, we don't have much wave, but we have a strong waves in Omkeswar because of the 20-meter depth. So you have to design your project on the basis of that. Sometimes you will have to have even wave barrier to avoid your infrastructure from that. But that escalation cost is not more than 5 to 10%.
That point is well taken. And what automated cleaning technologies or robotic solutions are you using to ensure that your operational costs are well within limits?
In fact, very surprising, Manisha, our operation cost in a ground-mounted solar project and the water floating solar project is not much different. Because in the ground-mounted solar projects, you have to have a security arrangements. Then there are other issues. Whereas in case of the floating solar, you don't have those security arrangements. So for that point of view, in fact, the cost is less. Further, the cleaning frequency in floating solar is less. The only issue is that the kind of skill set which are required for floating solar is slightly different. The persons who are working on floating solar needs a kind of a swimming and diving licenses also. But if you have a good mechanism of a condition-based monitoring, and then you are doing optimizing the frequency of maintenance on the basis of that, then I would say the operational cost for ground-mounted solar and the floating-mounted solar, the difference is not more than 10% as such.
And what would you say is your reliance on third-party or imported components for this?
So there are not many important components in this. You have the solar panels, which are same as you use for the ground-mounted solar projects also. And then beneath that, you have a kind of a floating surface which you develop. Those surfaces are normally developed or floats are developed at the site itself by Indian manufacturer. Yes, if you have to have a wave barrier, then for a special kind of mooring arrangement, you have ropes which are imported. But otherwise, most of the component, even in the designing and design consulting, is also easily available in India.
All right, Mr. Banga, that point is well taken. Let me take this conversation across now to Neha Agarwal, who joins us from Vikram Solar. Neha, hi, thank you so much for joining in. And as we were having a conversation that India has almost identified 102 gigawatts of that, but actual deployment is quite limited. What would you say are the major barriers that we're looking at in sense of scaling this in India?
Hi, Manisha, and thank you for that question. So just to initiate this, I'm sure we are all aware that Vikram Solar did the first ever floating plant in the country, which was back in 2015, while it was really small, a 10 kilowatt pilot project. And then we continued this journey. We have recently also done 80 megawatt for NTPC in Gujarat, and followed by a 20 megawatt currently for West Bengal Power Development Corporation. So I think, yes, the market was there and we were evaluating, we were doing a lot of technology upgradations. As far as module technology is concerned, it requires the certification around salt and mist and, specialized frames and junction boxes, which we are ready with. However, like even Sanjay mentioned, the cost is a little high. But now with this initiative by our Honorable Prime Minister with 1 crore per megawatt, subsidy announcement, I think it is here to stay, and it will help manage the costs equivalent to ground mount. Also push a lot of tenders because this will come through SECI. So we are expecting these tenders to come with standard terms, and now this is going to pick up. India is surrounded beautifully with a lot of water, while at the same time, it's also quite challenging with the land availability for ground mount. So this is definitely going to pick up from here on.
Neha, also, when we look at the overall technology, how do you see floating solar evolving alongside, let's say, battery storage or hybrid renewable systems? And would you say that it does become an important solution when you talk about India's reliable, round-the-clock renewable power therein?
Absolutely. So module along with battery is the best combination for floating solar because it will help round the clock energy availability. And with us, setting up our module capacity along with battery storage also, we'll be offering a bundled product to all our developers. We are there in terms of module certification and battery also. We are setting up our new facility, and combined combination will help round the clock energy availability and assurance. So that will help scale this up. For other products, to take care of safety, there are a lot of technology upgradations in terms of cable trays so that they don't come in contact with the water, and other safety measures are important for this to scale up, in which, we are working towards technology upgradation there as well.
So Neha, what would you say on how do we see this segment growing commercially, commercial readiness that is, and bigger utility scale floating? How would you look at the wins therein, the orders therein, and what is the sense that Vikram Solar is now looking at in this space going ahead?
So, of course, in order to scale this up till now, while each reservoir, each water body was engineered differently, given the climatic conditions and the water conditions, the wave, etc., basis these studies that were done. With, however, the potential which has been now come forward by NICE of almost 102 gigawatts, I think it will need some sort of standardization in the product, product bundling, which we are working on. And with this, and with SECI taking up tenders to, get to the market announced by our Prime Minister, the standardization will help scale this up quite fast. And we are working with developers who are planning to bid for these projects so that we have arrangements with them so that our modules can be well placed towards this market.
A final question to you, Mr. Banga, and well, there are some narratives as well being set out on how floating solar perhaps is blocking sunlight, affecting aquatic ecosystems, local fishing communities perhaps. How are you reacting to all of that?
Manisha, whatever I know, it's more a kind of a narrative which is generated by few not to have floating solar plants, but most of the reports which I have read is it helps in terms of less evaporation of water. So it's good for that point of view. And of course, when this report has come to set up 102 gigawatt by NICE, it has considered all those factors, and that is why the government is promoting here. So there is not much substance in such kind of reports as such.
All right, that point is well taken. Mr. Banga, Neha, thank you as always for joining in and making very clear to our viewers on what floating solar panels is all about. The technologies clearly seems to be growing. The upside or the possibilities clearly are limitless, and the company is working on that as well. Thank you for your time. Appreciate it today on CNBC TV 18. But with that, we'll go for a short break. When we come back, we will be joined by Australian mining giant BHP, which has reported strong FY 2026 driven by copper and rising commodity prices. We discuss this with the company's Chief Commercial Officer, Ragnar Udd, on the other side. Welcome back, and joining us now is Ragnar Rudd, who is CCO at BHP. Rag, hi, thank you so much for joining us here at CNBC TV 18 India. The results, first of all, and that has been consensus across board, whether it has been about revenue, EBITDA, net operating cash flow, debt, also delivering a stronger than expected dividend as well. How would you explain these numbers?
Well, I would characterize it as a strong result across every one of our businesses, built on, obviously, a rise in commodity prices across the vast swath of our commodities, but also strong operational performance consistently across our business.
Rag, copper clearly seems to be the largest contributor to BHP Group's underlying EBITDA. How are you looking at copper performing going forward as well?
Very exciting. Very, very exciting. So copper is now making up 54% of our profit results that we're delivering this year. And understand that the time it takes to actually bring on copper deposits or any mineral deposit is measured in decades. And so this has been a long, progressive plan to actually grow our copper exposure over time. And what we're seeing is that bet has proved out right. For the 5% growth over the next decade, that's going to be really sought after globally.
Also, when I look at the data, Rag, BHP produced nearly 2 million tons of copper for 2 straight years right now. Are you looking at that number to continue to grow on?
Well, absolutely. And so that 2 million tons, in context for your viewers, 2 million tons for the second consecutive year is the world's largest copper producer. And that is something that we continue to focus in on. How do we actually grow that portfolio? So the plans we've outlined in our annual report indicate the 4 major projects that we have globally between Vicuña in Argentina, expanding at Escondida in Chile, Copper South Australia in Australia, looking to double production there from 320,000 tons to over 650,000 tons over the next decade. And our focus in resolution will result in a CAGR of 5% on top of already being the world's largest copper producer.
What are the plans for iron ore going forward?
Well, iron ore continues to be a fantastic business for us. So we've seen prices up 3% year on year. We've seen our volumes up once again for record production. And what's important and really differentiates our iron ore business is if you take a look at the price realization we're achieving and the cost differential relative to our peers, we are making a $10 free cash flow margin greater than any of our peers. Now, when you put that across 300 million tons, that is a meaningful contribution to our profit result and will be for the foreseeable future. But we also recognize that steel production globally is starting to get more into balance. And so we expect that our iron ore business will continue to navigate supply and demand. But against being a low-cost producer that's making high margins is a fantastic spot to be in.
It is. And it's not just about copper and iron ore. It also is about gold, silver, uranium. Those numbers seem positive as well.
Well, across the suite, we're seeing most of those commodities. We've seen gold up to record highs in the last year, silver doing very well. Uranium, as you've called out, is a big story. And for ourselves, as we look at the world's need for more energy, in particular in India, where we know there is a strong demand for uranium, we see this as a very attractive market moving forward. Obviously not one of our core commodities, but nonetheless a meaningful byproduct that contributes 5% of the world's uranium production out of BHP.
Crude oil prices at $91 a barrel in the market they're in. How is that impacting physical traffic, especially for BHP? What has that meant for your freight insurance premiums, bulk adding, shipping rates, etc.?
So there's no doubt the volatility, and particularly in the Middle East over the last year, has impacted the prices that we're seeing for raw inputs such as diesel, sulfuric acid, ammonium nitrate. But it hasn't been about sourcing, it's actually been about the price. And so we're able to source everything we need.
How would you look at the overall Asian markets? Because with crude prices on the higher side, there are certain reports of input cost demand destruction for many of the key commodities. Are you facing that at all right now? Or would you say that for many of these raw materials, the demand, especially from China or India, is pretty inelastic?
For myself, the commodities that we're producing, we see tremendous potential and growth. So if I look at copper globally, we've seen 3% demand growth over the last year. We continue to see raw demand for any concentrates that we can produce, whether that is in China or if that is in India, there is strong demand for whatever we produce, and we continue to believe that that is actually going to be the case. In terms of iron ore, we do expect that we will see that supply-demand shift as China progresses forward. That said, it's important to recognize that China's been producing 1 billion tons of iron ore for the last 7 years, and we believe that will continue for the next couple of years. Overlaid with, we see what's happening in India in terms of growth in their steel industry, rising and potentially even doubling by the end of this decade as a tremendous growth story, not only for iron ore, but for met coal.
Like as always, thank you so much for joining in, and many congratulations for that very, very strong numbers that the company has yet again put in, and clearly a time of cheer for many of those investors therein. But thank you so much for your time. I appreciate it.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the government sent nearly 1.95 lakh blocking orders to Instagram, Facebook and YouTube between March and July of this year. And that's according to a report by the Indian Express. That works out to about one order every 68 seconds or around 1,275 orders a day. Now, notably, this period also covers the student protests over the NEET paper leak at Delhi's Jantar Mantar in June, which led to Dharmendra Pradhan's resignation as Education Minister. Now, data accessed by this report, by the Indian Express report, shows Instagram took the biggest hit with nearly 1 lakh blocking orders. Facebook received around 80,000 and YouTube got close to 15,000. That means roughly 9 out of every 10 orders went to Meta's platforms alone. Remember, each order could cover hundreds of individual posts or accounts at once. This is a sharp jump from the past year. Between October 2024 and October of 2025, the daily average was just about 6 blocking orders a day. RTR records obtained show that during that period, 2,312 blocking orders were sent to 19 online platforms through the Home Ministry's Sahyog portal. The Home Ministry's own 2024-25 annual report says that 1.1 lakh pieces of suspicious online content were blocked by March of 2025. Earlier this year, the government amended the IT rules, cutting the takedown window down from 24 to 36 hours to just 2 to 3 hours, a move that's drawn criticism. And the Indian Express has learnt that Meta has now integrated its API or application program interface with the Sahyog portal. Content flagged through government orders is automatically taken down from Meta's platforms with no separate human intervention or review. In other words, this automation leaves Meta with no room to review or contest a takedown order before complying with it. Now, just days ago, Elon Musk had said that X will make government orders, content restriction orders, clearly visible to users. The platform intends to identify the government department or agency that submitted the request, along with the legal justification or explanation provided for seeking this restriction. Well, joining us now to help us discuss this further is with us Pranesh Prakash. He's a tech law as well as policy expert. With us is also Siddharth Deb, Associate Director of Public Policy at the Quantum Hub. And Mr. Pavan Duggal, a cyber law expert, will be joining us shortly as well. Pranesh, let me come to you. Let me get your quick thoughts. The orders that we've seen, at least what this report refers to, it's a referral to orders that have been passed under Section 79, not under Section 69. Now, that's slightly technical, slightly complicated. Break that down for our viewers. Why is the government opting for Section 79 route and not the Section 69? What experts tell us is that under Section 69, there are many safeguards that are there, procedural safeguards for the government to comply with if they want to issue orders under Section 69, not so much under Section 79.
That's absolutely the case. Now, Section 69A of the IT Act is a provision which compels intermediaries to remove material. It requires them to, and if they don't, they can be punished with imprisonment. It only provides a limited number of grounds, which are the grounds listed in Article 19.2, a subset of those grounds as grounds for which a request can be made. And it actually has provisions, though they are not followed, it has provisions which require the government to hear the opposite party, hear those who it wishes to censor. Now, 69A rules themselves don't require any transparency. In fact, they prohibit transparency, which the Supreme Court slightly read down in the Shreya Singhal case in 2015. Now, 79(3)(b), which is the provision under these notices, and these are not orders for removing content, but notices rather, saying on your platform there is some unlawful act that is being committed, and we are providing you actual knowledge of this unlawful act. That is what these notices are saying. Now, if intermediaries like Instagram, don't remove that content which the government is complaining about, and by the government, this is a platform operated by the MHA. Police departments from across India are able to send these. So it's not just one person sitting making these decisions, but police from across India who are sending these takedown notices. In many cases, including in notices that have been leaked online, which I have had a look at, there is no crime that is mentioned. So they are saying that there is a crime being committed, there's an unlawful act being committed, but they don't even mention any section under which there's this crime. And indeed, for instance, the Kerala Cyber Police, in one notice that they sent to a journalist, they didn't mention a crime. They didn't actually proceed to register a crime. The crime doesn't eventually go to they don't prosecute it. It doesn't go into the judiciary. So these are just frivolous notices that they're sending when no crime is being committed, saying that there are crimes being committed. Now, this has been used against opposition. So the Aam Aadmi Party found its handles blocked just shortly before elections. This has been used against newspapers like the Hindu, the Hindustan Times, and many other news portals. It has been used against student protesters, even when there's nothing whatsoever objectionable. And it was used even for a new account that had existed just a few hours and was immediately removed, which was the Dimaki Naxal Party.
Right.
And that was instantly removed. But so it's clearly being abused. And I can't find a single case in the public domain where a clear crime has been stated and it's been used properly for what it's meant to be used for. So it's a censorship portal. There are no safeguards whatsoever.
Right. Let me take that across to Mr. Duggal. Mr. Duggal, thank you for joining us. Again, I want to begin by asking, we've seen a spike, at least if these numbers are reliable, if they're anything to go by, it seems to suggest there's a big spike in the number of takedown orders that have been issued by the government. Tell us, at this point, given the platform that we have in the form of Sahyog portal, this is where all the government orders are funneled in, and then subsequently the platforms, the social media companies are required to comply. The question I want to ask is this the best way to regulate social media? Because like what we've seen in Sahyog portal, there is little or no review of these orders, that the companies, fearing loss of safe harbor, willy-nilly do end up complying with these takedown orders. And like what Pranesh was pointing out, sometimes you have local police officers issuing these comments without really rationale.
When I look at the structure of Section 79 of the IT Act, obviously it was meant to stipulate 4 conditions, the fulfillment of which will lead to the statutory exemption from legal liability. And one of them is Section 79(3)(b), which basically talks about exercise of due diligence. And then also the factor that once you're called upon to remove or disable access to any electronic information, you do that expeditiously without vitiating the original electronic evidence in any manner whatsoever. So if the notices are being sent in this particular section, this is within the remit of the powers given by the IT Act. Well, the Supreme Court under Section 7, under the sheer single case, had actually upheld the constitutional validity of Section 79 of the IT Act. But I think in 2015, this kind of combinations was not brought to the attention of the court. So should now these permutations and combinations are emerging, and should they be brought to the attention of the court is likely to bring in far more checks and balances to say, hold on, the kind of checks and balances that are there under Section 69A of the IT Act pertaining to blocking should parameter be also be made available under Section 79(3). The reason for this is that you can't bypass blocking and use this power as a more convenient way of trying to go ahead and block content. But again, this particular article that's come across, there is also not much information available as to how much of these blockings were Section 69A, how much were these pursuant to the orders that were given under Section 79(3) of the IT Act. But yes, there's a Damocles sword on the head of the service provider. The moment he gets a 79(3) notice, he has no choice. He wants to ensure that he continues to have his statutory exemption from legal liability. So more likelihood than not, he will go ahead and comply with such requests without finding the necessity of going and legally challenging the same.
So more likely than not, the platforms are likely to fall in line with respect to these takedown orders. Siddharth, let me get your thoughts in on that. Section 79, what it essentially says that either follow the takedown order or you'll face the loss of safe harbor protection. Is that cost disproportionately high that leaves realistically no choice in the hands of the social media company than to comply with whatever takedown order is being issued?
I mean, yes, and I'll come to answering your question in a moment. But essentially, even if you think about when the IT rules amendments were passed recently in February of 2026, this was a couple of days prior to the AI Impact Summit. So when global representatives from tech companies were coming about, they were talking about the fact that we anticipate that not only will there be a surge in the volume of requests, but the expectations of us to take down all posts or all takedown requests within a period of 3 hours, we will need to figure out a mechanism to be able to lawfully comply. It's been happening in parallel with the government's decision to expand the remit of Section 79(3)(b). It's not just the Sahyog portal, but we've also been seeing a surge in the number of designated institutions that can issue takedown requests through the Section 79(3)(b) framework. We've seen institutions like SEBI being granted those powers, which is the securities regulator. We've even been seeing the Ministry of Railways. And the time period that is covered in these Indian Express disclosures is immediately after the amendments were passed. So we're clearly seeing a surge in the number of requests that are being pushed to platforms for content takedown requests. The problem has really been that because now they don't have as much time, earlier it was 36 hours, now it's 3 hours, they have to kind of build mechanisms to immediately comply. And the additional problem is there aren't sufficient checks and balances from the point of view of both institutional safeguards as well as transparency. So one thing is that platforms under the current systems, whether it's under Section 69A, as Pranesh was talking about, or even under this mechanism through Sahyog portal, there is a confidentiality obligation for platforms. So what that means is that they're unable more often, they are unable to forward these takedown requests to the affected parties. So for example, if I'm a user, then I don't know what are the exact legal grounds for the curtailment.
Fair point. Let's build on that point. In fact, that's a very important point that you make, that there is no notice that is issued to the creators and there is no notice that the platforms can make available to these creators. Pranesh, let me get your thoughts in on that. Very recently, we've heard from Elon Musk where he says that all these takedown orders, he'll be making public on his platform X. He'll be explaining why that takedown order was issued, what the legal rationale was. He'll be disclosing that. Number one, to begin with, is there any provision under Indian law that bars such disclosures by a platform like X owned by Elon Musk?
Under Section 79, I would say no, there is no bar at all. In fact, for copyright notices, which is again another way that government censor. There was a report just today by the Reporters Collective on how the Aam Aadmi Party government in Punjab has been using fraudulent copyright notices to get content that they don't like removed and so on. So those are at least made available by these intermediaries through a public database called the Lumen database. The same can be done by the intermediaries when it comes to 79 notices as well. And we must demand that both for all notices sent under 79 as well as the orders sent under Section 69A, that the government must make them public. Now, the government can't refuse to tell us what books it's banning. When it's banning books, there must be a public notice. But we've ended up in a situation where the government claims the right to ban all kinds of online content, accounts, and so on, without a shred of transparency, without an iota of transparency. And that's terrible. Now, in the Shreya Singhal judgment, the Supreme Court held that sufficient information must be made public to enable people to approach the courts to challenge these orders. Currently, the government is not complying with that. whether under Section 69A or under Section 79. What we must require of the government
from disclosing these.
Elon Musk is free to disclose at least all the 79, which is the bulk of the orders that they're receiving right now, are under the intermediary liability provision. So they are free to disclose all of those, and they must disclose all of those publicly. And I would urge all platforms to disclose them. And indeed, the government, the Ministry of Home Affairs, should disclose them so that there's transparency.
In fact, that was my very next question. Siddharth, if I can actually take that up with you, you raised this point. Elon Musk saying, I will disclose. Does it fall on the government to disclose these takedown orders, blocking orders as well?
Fortunately, the law does not really compel that transparency. And beyond that, what we also have is a situation of not enough institutional checks and balances, which was another point that I wanted to talk about, which is right now, even the review mechanisms that take place for content takedown orders, that review mechanism is headed and fronted by our Interior Security Ministry, which is the Ministry of Home Affairs. Ideally, if you think about constitutional democracies, you need checks and balances, either at the level of judicial authorities being able to review content takedown orders after the fact, or you need, like, let's say, parliamentary oversight, so that different arms of the government can keep on auditing that, let's say, content takedown requests are pursuing public order and national security objectives whilst being consistent with the right of free speech and expression. So that is clearly a structural deficiency right now in the system that we have. So essentially what the Information Technology Act is providing, and perhaps we need to have a longer conversation on reform, is we either have a system of flawed procedure under Section 69A or an absence of
procedural deficiencies there with respect to the IT Act. We're running out of time. I'll just come for a quick closing comment to Mr. Duggal. Mr. Duggal, again, to cut a long story short, we've seen a lot of people comment about how their positions, how their posts or how their accounts were taken down. As, say, perhaps a young creator, if without notice my Instagram account is taken down, what legal remedy do I have under the IT Act that I can take that you would recommend?
Well, under the IT Act, you have the IT Rules 2021, which allow for a grievance redressal mechanism. Should you find your content down, you can raise it as a grievance to the grievance officer, but that's a failed mechanism from the word go. There is no effective remedy under the grievance redressal mechanism because most of the time the grievance officer doesn't respond, does not give you any remedy. So the only choice for you is to go ahead to the grievance appellate committee, otherwise go to the red jurisdiction. But I think the grievance redressal mechanism is a failed experiment from the word go. You'll have to come up with more effective mechanisms to provide effective remedy to affected people. The current dispensation does not provide any effective remedy in this regard.
Pranesh, I saw you raising your hand. A quick 30 seconds to you, if you can just summarize your point. Pranesh?
I agree with Mr. Duggal when he says there is no effective mechanism, but the grievance appellate committee, that's only about when they remove content pursuant to someone else's complaint. It does not apply when the government is the one that uses Sahyog portal to complain. So the GAC route isn't even available. So it's not just a flawed procedure, it's just not available at all under the procedures laid out under the IT rules. So the only remedy that you really have is to approach the court, which is what the Aam Aadmi Party did. And they got a court order from a high court to get their accounts reinstated by Instagram and Facebook. So that's
clearly a relief that many stakeholders that we know of have availed of knocking on the court's doors. We'll, of course, have to wait a final decision on what the Supreme Court has to say on the matter. I'd like to thank all of our panelists for joining us and sharing their insights with our viewers. But with that, it's time now for slipping into a very short break. But don't go anywhere. More news and updates will continue on the other side. Welcome back to News Center. Now, Tata Sons' annual general meeting was adjourned for the first time in its 108th year history due to a lack of quorum. The deadlock stems from a restraint order by the Maharashtra Charity Commissioner, which prevented Sir Ratan Tata Trust from nominating a representative. The impasse could also delay the formation of the search committee to choose a successor to N. Chandra, who will exit the company when his term as chairman comes to an end in February. Rachna Dhanrajani now joins us with the latest updates from Bombay House. Rachna.
Well, yes, I am outside Bombay House, and a short while ago, in line with what we had reported, that the Tata Sons AGM has now been adjourned. Well, the meeting started at around 2:30, and after 30 minutes, it was adjourned as the Articles of Association had mandated it to be. For a meeting to be adjourned, it had to convene as scheduled, which was at 2:30 p.m. this afternoon. And after waiting for about 30 minutes for the quorum, and since there is a lack of quorum today, the meeting has now been adjourned. Now, the steps from here on, like we've reported before, is that the group gets about a 1 week of adjournment, but in this 1 week they have the option, and from our sources we've learned that they are exploring this option, which is to reach out to the ROC, the Registrar of Companies, and seek an extension which can run up to 3 months. Now, if that happens is what we'll have to see. But speaking of today's meeting, it was attended by N. Chandra and Anita George right here at Bombay House, that's behind me. But apart from that, Harish Manwani joined online. Other members, including Noel Tata, also joined online. I remember this is the 108th AGM, and the participants also included Sunil D'Souza of Tata Consumer, R. Mukundan, Venu Srinivasan, Puneet Chatwal of IHCL, Kaushik Chatterjee, Dr. Praveer Sinha of Tata Steel, and Mehli Mistry, who came in as the executor of late Ratan Tata's will. But for now, the AGM stands adjourned. For the next steps, we'll keep an eye out for, because now the matter gets even more serious. Now, the lack of quorum at the meeting was due to lack of a joint representative appointed by SRTT and SDTT, and SRTT cannot hold board decisions, cannot hold board meetings to take that decision, and that is why no nomination. But from here on, as we know that Mr. N. Chandra has decided to step down, but for that selection committee to kick off the process for his successor will also require not one this time, but 3 representatives jointly nominated by the two trusts, that is SRTT and SDTT, and one of those 3 members is also supposed to chair the selection committee. So from here on, we'll have to see what the Tata Sons is likely to do, because now it's not only about the AGM, on which the agenda of the AGM was FY26 dividend and FY26 accounts, apart from that extension of directorship of Mr. N. Chandra, but now also the successor of Mr. N. Chandra is in question. And remember, it is only till February that the group has the time to find the next chairman of Tata Sons.
Now, the Federation of Indian Pilots has urged aviation watchdog, the DGCA, to overhaul drug testing rules. The Federation is seeking that the quota for random testing of pilots must be increased from the current 10% to at least 25% annually. Madhya Mujawar now joins us with more details. Madhya, take us through what the Federation is asking of the DGCA.
Well, there's a lot of speculation around the Air India AI 2379 flight incident, including questions around the pilot in command's drug test. But it is important to separate what is known from what is being speculated. The PIC did test positive in the confirmatory test, but crucially, he was not flying the aircraft when the incident happened. The first officer was at the controls. Against this backdrop, the Federation of Indian Pilots has now written to DGCA with a 30-page proposal to strengthen pilot drug testing. So what exactly is FIP asking for? First, it wants random testing increased from the current 10% to at least 25% of pilots every year, and pilots should remain eligible for repeat random tests. Second, FIP wants oral fluid or saliva testing introduced alongside urine testing, because it says this could make testing faster and easier at airports and allow more frequent checks. And third, FIP wants risk-based post-occurrence and follow-up testing. It wants mandatory awareness programs for pilots covering drugs, alcohol, and even commonly used medicines. It is proposing a check before you take system. So pilots can check whether a prescription, over-the-counter medicine, herbal product or supplement could affect alertness, contain a prohibited substance or create a problem in their drug test. And importantly, FIP wants pilots to have confidential access to aviation medical experts before taking such medication. FIP says pilots should be able to seek that advice confidentially so they don't hesitate to disclose medication use out of fear or automatic punitive actions. So this is what the FIP is recommending.
And with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
very few of the NTLFs that have always been virtually a permanent fixture there. So it's great to be back here in partnership with NASSCOM to address an issue that is causing significant anxiety at this point in time. But as Noshir was pointing out, it is also an era of opportunity. The question, though, is will Indian IT services make the pivot? 24 peak, we're down 15 lakh crore rupees for the IT services industry in terms of market cap. And the question that's being asked is the market mispricing the anxiety at this point in time? Is there something that Indian IT knows that the market doesn't seem to know? Because when you talk to these guys, they're all basically telling you there is that $300-400 billion opportunity, and that's the kind of value creation that we hope to accrue. So where is the dissonance is the question that we want to talk about. The other aspect that we do want to address is that if there is this $300-400 billion opportunity that opens up by 2030, which is estimated, where does the value creation lie for the Indian IT services sector, and what changes will they need to make structurally in order for them to be able to leverage and gain momentum of that market opportunity that presents itself? There is, of course, the issue that Naushir mentioned, and that is the decoupling that we are seeing between revenue as well as headcount growth, and that has been something that we've seen accentuate and accelerate over the last few years, and it is flat, as Naushir pointed out, at this point in time. The other big question, though, is growth, and are we in this single-digit growth trap for the foreseeable future? Are the double-digit days, is that era a thing of the past, and do we need to recalibrate the growth aspiration that we have? There is, of course, the global story that's playing out, the OpenAIs and the Anthropics of the world, and what that potentially means in terms of this industry specifically. AI monetization, how quickly will that be able to outpace seat cannibalization? I think that's one of the big issues up for debate and discussion. Well, I've got a fabulous panel here to address those issues. So without further ado, Rajesh, I want to start by talking to you. 15 lakh crore rupees gone in market cap erosion since the 2024 peak. What is the market not appreciating about the story? Indian IT, as Salil Parekh told me in our interview recently, Indian IT abhi zinda hai. Why is the market not appreciating that?
Absolutely zinda hai, but I think it's important for us to note a couple of things. One, if you ask anybody in the room, and if you look at the last quarter results of all the companies, the top one included, the medium ones, of course, grew. When you look at the top ones had about 3% year-on-year growth, the medium tier, and many of the companies which actually did fairly well at 9 to 12% of growth, and the smaller ones actually even had higher growth. But more importantly, when you go back and look at the order books, almost all of them had the largest order book ever in the history of this industry. So they've all been doing really well. On the contrary, as you rightly mentioned, all of them had a headwind from the stock market point of view. I do not know how the stock market valuation happens, so I can't really comment on what they do. But I can always tell you one thing. They always price for the worst case, and then when they look at the terminal value, they want to make sure that whatever they are seeing on the order books, whatever the story that we've been sort of saying for the last 1 or 2 years, holds good for the long term. I know that they're sort of looking at these numbers, and occasionally you'll find that because of the green shoot that we produce as an industry, there's suddenly sort of a shoot up of our numbers and so on.
Yeah,
but that is what it is.
18% off your lows.
There you go.
Yeah.
There you go. So that is, in some sense, so I think quarter on quarter, if they are able to put the proof points on the board, I personally believe that. Will you see an aberration? Absolutely, yes. I think there is going to be a bit of an aberration when you see that this industry will go through bad times before it gets better, as I always say. So I think we're going through that turf at this point in time. But I think in my mind, if you're what we are seeing around the order books and the opportunities that we are seeing, and of course we'll talk a little bit more in detail as to what exactly is the opportunity. And Naushir put some really good data around. People always ask me, will the industry pivot? The industry has nothing to pivot here. I think the individual companies will pivot. Will all the industry players will pivot? Probably not. 80% of them will pivot. Maybe some of them will not pivot. But the opportunity you saw in those charts, the TAM that we are talking about, the opportunities that for the services company to truly cross the chasm, if you may, that's for real. And I don't believe that the markets have actually priced in yet.
Okay, so that opportunity is real. Amit, let's talk to you now in terms of recalibrating growth. And as I said, is the era of double-digit growth something behind us? Do we need to recalibrate ourselves into appreciating the fact that at least for the foreseeable future, for the industry, for companies like yours, it's likely to be low single digit. And what does that then mean for the next 5 years as far as this sector is concerned?
I think I tend to take a pretty bullish approach on things, and possibly by nature an optimist. But if we look at how things are shaping up, we look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen. The transition on anything to do with operations is expected to be pushed for efficiency and productivity always, with or without AI. That has always been the candidate, and it will always remain a candidate. But the pivot towards new opportunity is what we are seeing more and more. What used to be an industry known for effort, largely our industry has always been known for how much effort we have put in. I think that pivot is moving from effort to intelligence. Our industry is getting redefined for intelligence. Our industry is getting recalibrated for intelligence, and that's a transition that we are all experiencing right now. But a huge opportunity ahead of us.
So let me double down on that. If you're making this transition from, to intelligence, what then happens as far as pricing is concerned? And I think that's the question. And Naushir mentioned that you're moving now to outcome, and everybody's talking about the outcome model and outcome pricing. What does it mean in terms of pricing deflation at this point in time? And, how quickly are you likely to see this model shifting? And two, on the headcount front as well, as we move into this agentic future that everybody is talking about and so on and so forth, what will it mean essentially as far as the current model of headcount is concerned?
I think second question first. If we look at operating model, headcount has been part and parcel of an operating model to deliver services to a customer enterprise. Deliver services in an output, in an effort, or an outcome-based model. It's been a combination of all three. The percentage variation has been very different. Now, when you look at the operating model shift, you'll have a human and AI agent collaborate and coexist in different capacities, in different natured roles, and different skill sets. The ability to price for outcome becomes more profound now because you're committing to what the end experience the customer will gain rather than the effort that you'll put in. But hand on heart, I don't think so the industry has transitioned to an outcome as yet. We are clearly seeing a shift of effort moving to output, but very small percentage still moving to outcome. But that's a big opportunity in front of us.
And the timelines that you believe that you are likely to see the inflection point as far as this shift is concerned?
Tough to predict. I think if we go back in history, we always take inspiration from history. So if you go back in history, when the mobile era was introduced, say the consumers have huge excitement around it. Enterprises took a long time to come around that space. I don't think so it will be any close to that lead time, but there is a lead time that is always expected from consumer excitement to being ready for enterprise grade.
Okay, Arundhati Bhattacharya, let me address the big question with you. And I think every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then. Then they want to go back to the early one. But having said that, this is a real case.
Yeah.
So, but having said that, on the SaaSpocalypse, you have to understand one thing. The frontier models, you just can't put them somewhere and expect the entire enterprise problems to be solved, okay? Whenever you're deploying something new, there has to be governance, there has to be auditability, there has to be observability, there has to be, the various regulatory and other compliances have to be correctly recorded. Not only that, in the architecture that you already have. You don't have a clean slate. You're putting in something where something else is already working. So putting all of that together in order to have the best outcomes, it needs a lot of engineering. It's not something that happens on its own. Neither is it something that, any of the frontier models will resolve on their own. And therefore, the requirement for companies such as either ours or even the service companies, that requirement still remains. And the fact is the industry is beginning to realize that piece of it is still very, very important. And therefore, I don't really think this Haspocalypse stuff was sort of, I don't know, it was stocked up maybe a little because there was so much investment going into the other companies and they had to take it out from somewhere and probably we were sitting ducks on it. But whatever it is, I don't think that narrative really makes sense. And I've not been seeing that in actual on-the-ground requirement or even in the order books like Rajesh said. We are not seeing that anyway.
Well, the narrative was built by the stock market enthusiasts.
The narrative was built by the stock markets, but you're right in saying that you did see these massive amounts of capital going into companies like OpenAI, Anthropic, and of course, but what I do want to understand from you is what are you seeing in terms of demand? Because I understand that you're in a silent period, so you cannot comment or make any future projections, but look at your agentic ARR, up 200%. What is the sense that you're getting in terms of demand at this point in time?
So, let me just talk about our own company. We are, by the way, customer zero. Like Noshir said, we are not holding back. We are willing to cannibalize ourselves. We are customer zero on our own platform. And even there, if you see, I had started with my own vertical with a project for creating 3x productivity. In a matter of 90 days, I had 99 applications, okay, where in certain cases, they were giving as much as 27x productivity. Some cases it was lower, it was as much as 1.5, but it depended from case to case. So the fact remains that there is definitely a huge amount of demand. But I think even if there is demand, people have a lot of queries still. The queries on trust, queries on security, queries on cost. There is something that has evolved called token economics.
Yes.
Okay, so that's an entirely new field of expertise.
We've gone from token maxing now to token impacting.
Exactly.
Token impacting is the buzzword today.
That's right. So that's an entirely new area. And in fact, Noshir didn't mention some of the roles. Some of the roles are in that area. How do you maximize the usage of tokens in order to ensure that you get maximum impact and lowest costs? So there are a lot of things that people are still trying to get their arms around. If you ask me whether there is more interest, yes, hugely so. If you ask me, have we seen that actually come down to numbers? I think we are getting there, but not yet there.
The jury is still out on that front. Puneet, as I was saying, the only person on this panel who doesn't have a stock problem is Puneet. Microsoft is still
so glad.
is still holding up. But, the massive CapEx spends that we're seeing globally at this point in time, almost $700 plus billion between the, hyperscalers put together, almost $200 billion for Microsoft alone. Now, when we look at this CapEx build out, and I'm asking this in the context of what the opportunity is for this sector here in India, how does this sector benefit from this kind of massive CapEx build out that we're seeing happen globally? Where does the value creation for this sector lie when we talk about this CapEx build out?
Listen, I think first up, the reason for the amount of investments that you're talking about is, and we were having this discussion outside, this is unlike anything else we've seen in our lives. It's the most consequential technology of our lifetimes. And a lot of this CapEx is going into manufacturing intelligence. And intelligence has always been linked to biology. We've always carried intelligence in our small heads. For the first time, we're making compute become cognition, right? For the first time, we're manufacturing intelligence. So that is the race we're on, and that's the reason the investments will continue to go on. To your question on where the value is, and I was with a client recently, and he said, some of these frontier models that I'm working with, they're like brilliant strangers. I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does the good work look like, and then get that to answer questions or do work for me, which is where the new value pool is, and Naushir spoke about, right? Which is translating this enterprise ontology, the enterprise context into these frontier models, and getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox. Don't pay for these models twice. So I think that is where the real value pool is, and I don't think there's anybody better positioned than the services companies in India who have the context, who have the domain knowledge, who know how to do this at scale.
But let me push back, because this is the fear, right? That given the intelligence that these guys are sitting on, how quickly can the beautiful stranger become your beautiful friend? I think that's the concern, that's the anxiety.
I think the transition from this brilliant stranger to a familiar friend has to be done by the Indian IT services companies, because this is not trivial. We've all seen this, and Naushir spoke about the three things that are true in life. The fourth thing is the enterprise tech debt. There's a ton of tech debt that's sitting there, and it needs to be modernized. It needs to be translated into these models. And again, I'm sure we'll talk about ROI, right? But eventually it comes down to two things, Shireen. First is intelligence, which is intelligence in your own context. Second is trust, to Arundhati's point. We all have agent sprawls in our organization. How do we make sure that we get the intelligence that we want in on our own terms in a trusted way, which is where the service providers are best positioned to go and play.
And I didn't pay him to say that, so
I'll still charge you later. You can buy me a dinner, Rajesh. No, but I mean it. I genuinely mean it. I think this is where there's a massive opportunity for all of us.
No, and I think Satya has been at the forefront of this business of the limits as far as renting intelligence is concerned, and something that Palantir, Alex Karp has also been carping about, particularly on CNBC. So we'll get into that discussion in a second. But Srikanth, regretting listing?
Not yet.
Not yet. But would it have been better? Were you still private?
See, I think this, like Puneet has just mentioned, this is the most transformational tech that we have seen in our living memory. And to think of this as just one more small wave that'll pass by is, I think, a big mistake. I think whether this on this panel or anywhere else, if you're making that assumption, it's going to change the world in very significant ways. And 2026 is just the beginning. We are at that point where recursive self-improvement is beginning to happen in the models. These models are already building the next wave of the models. The models are getting better at a rate that's unimaginable. They're doing long horizon tasks. So they're not just being part of your tech budgets. Tech budgets are increasing, as Naushir was saying. They're going from 4.5% of revenue to 6% of revenue. So there is a certain increase in tech spends that's happening, and many of the service providers can benefit. But if you look at the other side, the labor budget, 20 to 40% of revenue of a company is the budget on human resources. And that budget can also be now exposed to tech disruption, which means that the overall pie that a tech company, whether anybody on this panel or anywhere in this room, can address is a much larger number than ever before. With that massive addressable market, the sky is a limit in terms of how companies like Fractal can perform, or even any of the people in this room can perform. So eventually the world is moving to more tech dependence. Now, coming to the tech services companies that are currently struggling a little bit for growth, it's also something we have to understand as a S-curve that is saturating. So if you look at all the tech companies, tech always goes through these S-curves. We have completed the previous S-curve, the era of sort of doing social, cloud and stuff like that. That S-curve is saturating. The next S-curve comes with an AI wave, right? And companies like here have to reinvent themselves to be relevant in the new S-curve. Fractal is natively there. And secondly, all the companies that are potentially clients of this have to also reimagine their work and workforce with AI, right? So whether it is transforming every business process with AI, building the ontological foundations in their data to be ready for that transformation, or reimagining the talent and workforce so that they are relevant for the new generation. This is not just a tech services or tech companies problem or a SaaS apocalypse problem. It is all companies in the world will have to address this sooner than later to be relevant in the next 20 years.
So that's what I want to double down with each one of you. Let's pick up on this issue of reinvention. And as you pointed out, everybody needs to reinvent, everybody needs to rewire, everybody needs to reimagine. Now, at this point in time, if I were to ask you to pin down for me the 3 strategic imperatives of where this reinvention ought to start, what would you put down?
I would say pick the place where you have the greatest inefficiencies in your organization, or which is your North Star, or where you feel like an important metric that you chase. You pick that part in your organization and see if you can work backwards and redesign the processes to gain traction. That's number 1. Number 2 is that you must look at the data that you're collecting, the system that you've created, and how to harness that data, create that layer of context in your organization so that you can leverage it. And 3, you must activate your talent to think AI native. Everyone in the organization. It's not just tech people who need to learn AI and get better. It is every employee in the organization has to start using AI in a much more effective way. So I would look at these 3 massive opportunities inside every large company, and you can see that the ones who have cracked this problem are already moving faster than the others.
Rajesh, let's pick up on that. The NASSCOM strategic review said that the need of the hour is to focus on value and innovation. Now, those are large, generic terms. What does that mean specifically as far as the actionables for Indian IT services? Noshir talked about R&D. R&D spends have been woefully, abysmally low, less than 1% or just about 1% as far as the industry is concerned. The big criticism is you guys keep doing dividends and buybacks and so on and so forth. You're not spending enough as far as IP creation is concerned. Does that need to be the big shift? Does that need to be the big priority at this point in time? If so, on what exactly?
So first of all, I'll give it that, there is a serious issue with R&D spend. Overall in India, as you know, that as a country we spend 0.7% of our GDP, whether an advanced nation would spend something like a 2.6 to 2.7% of the GDP on the R&D. So there is no question that as a nation we are spending less, as an industry we are spending less, as companies we are spending less. But having said that, for the tech services company, what gets counted as R&D is often, when we talk about R&D, there's always a product mentality around some of this. And I want to put that rest once and for all if I can. See, when you have products and services, the traditional way of looking at what is innovation is a little different, right? I mean, of course, you need to spend on building IP and all of that, but let's not forget that. Let me see if I can give you an analogy. I mean, I think flying is a great analogy. To have a great flight, you need to have a good aircraft and you have a good airline. The aircraft manufacturers have never been able to run an airline, and the airlines have never been able to build an aircraft. So Boeing makes the aircraft. Let me pick a good airline here. Singapore Airlines probably flies it nicely.
I like the fact that you dumped all of the Indian carriers, right?
I don't want to say anything at this stage, but especially given where we are today, I want to be very careful. But that experience, so you have a product plus service combination, if you may, delivers that kind of experience for the end user. So being that the case, of course you need to have core products. I'm not arguing by any means that you have to do less of R&D. You need to do more of this. Tech services companies have really not spent enough. They're beginning to realize that. They're beginning to create a lot more IP. I think it'll improve over a period of time. So that's one. I think they'll have to be a lot more innovative. But let's not forget that what is the biggest... Arundhati and I were together in a different podcast this morning, and we were talking about the enterprise context which the services companies have today are valuable so much that, starting all the way from Y2K and today, you really see they understand this enterprise context of all the corporations around the world, especially the Fortune 1000 and so on. They need to leverage that fully at this point in time, because to truly deploy AI, and then we all talked about as to how critical it is for them to sort of truly get into the bandwagon and take advantage, not just for productivity gains, but also to enterprise transformation. So the second piece of the, how do you really move the needle? These companies have phenomenal opportunities. So all of them, TCS is on the panel and many of the other companies are not. But if you really see the AI services service line, if you may, is actually focusing on that aspect of it. But you have a lot more coming around that as well.
Let's address this issue, Amit, and I want to talk to you about this. Through the digital era, and Salil gave me this number, he said when they started reporting their digital revenue, it was about 20% of their business. And, it moved very quickly, or it took about 5 years for it to get to about 60%. He believes that the shift shift to AI revenue will happen much faster than it did as far as digital is concerned. When do you foresee that you won't necessarily need to have a separate AI revenue line?
I think it was mentioned by our chairman in the TCS AGM as well that we are seeing a pathway of anywhere around 3 odd years from now on, wherein everything that we do will be AI pervasive. I think that's a line mark that we are looking at. But now, if you reflect back on how the change is happening, I think today the industry has very varied definition of reporting AI.
Yeah.
You either take a very purist view, or you take a view of submerging anything and everything. And today, when we look at our own strategy to execute, we have looked at all the 3 dimensions: customers, employees, and partners. Customers, not only our own enterprise customers, but we as customer zero as well. Our employees, not necessarily for the work that is being done today, but for being fit for future in terms of talent, skills, roles, and jobs required. And partners with a clear hand-on-heart submission that not everything can be done alone, and AI ecosystem will be the norm of the future. I think that essentially is how we are defining and transposing the journey towards making an impact on AI. What we report on the back of our quarterly numbers, we have taken a purist view. And in that purist view, we say that anything which is AI transformation is essentially what we report to the market. Anything that we use as AI for IT service delivery is what will become more pervasive, and now that is not part of the number that we report in. And now that definition can keep varying till the industry stabilizes outside of a transition duration to say that, yes, this is how I'll measure, this is how I'll monitor, this is how I'll report. So that's the difference that you will continue to see till it normalizes.
You know, from the purist point of view, the aspiration and the ambition that you also have is to be the world's largest AI services company, right? But to the point that was being made by Rajesh, and I think the point that the market is also asking, is that will the services model need to incorporate much more of productization, much more of platformization as well? Can you continue to exist purely as largely driven by the services model?
I think what the shift that we'll see, the mode of customer engagement will shift, and the mode of customer consumption will also change at the same time. Customer will consuming services. Customer may consume services, but under the banner of a platform, under the banner of a product, under the banner of an end-to-end outcome. The same enterprise customer can also engage with you to say that I want to build my own platform for my own sovereign needs for the future, but I want to borrow the blueprint from you. That blueprint is an equal IP that you possibly have not platformized it, not productized it, but you can still monetize it. So you will see a services component coming on the back of a blueprint to a full-blown platform and anything in between. And that's the shift that you'll see in the operating model on how customer will consume.
Puneet, how do you see this? Because, Microsoft is also foraying into this space with the frontier, business model that you're looking at. But more importantly, you raised the ROI question. You said we'll address that later. Let's address the ROI question. With all the spends that are happening at this point in time, when do we actually start to see a meaningful return on investment?
So I think just first up, this ROI debate is the most healthy thing we're doing as an industry. I think this parade of pretenders on AI is ending. And if a CEO or a board or a CFO asks you about ROI, that means this pilot tourism that we've all been on for some time is over now, so which is great.
Is it over?
I think it's over. I think it is over, Shireen. I think 2024 was all about AI demos. 2025 was all about pilots. 2026 is P&L. I can't imagine a single conversation today with a CEO or a board or a CFO where we're not talking ROI. Right, so I think it is real now, and I think all this AI washing and hobby projects and all of that stuff is out of the window, and rightly so. It's super healthy that we're doing it. Back to where is the ROI going to come from? And I think some of this we've spoken, right? First is owning your intelligence and not the brilliant stranger, but your own context. Second, I think a lot of ROI is not showing up because we're bolting on this flying car on really bad old legacy processes. Right? You put a flying car on a legacy stupid process, you'll produce more crap, right? That is what's happening right now, right? Which is, if you don't reimagine these processes, and for the first time as leaders, we've got a new item on the balance sheet, right? I always had human capital, I now have token capital. Right? And there are 2-3 things, implications, right? One is there's a trade-off. So you always have to think about saying, listen, where am I spending more? But more importantly, Shireen, there's a learning loop between the two of them. And what I'm now measuring at Microsoft is if I'm using so many tokens are my humans getting smarter? And to Arundhati's point, is my token optimization getting better? So can I drive that learning loop between? So I think that's the first thing on ROI, which is just human capital and token capital working together in this learning loop. Second is trust. I think that's a big one. And trust is not just a policy, has to be built into how we ship products and how we lead with customers. And Agent 365, like for example, a control plane for agents. We all have more agents that we can count. We can count humans, we can control them, we can stop access. With agents, we got to do the same thing. So I generally think 2026's pilot tourism is over, but if we get intelligence and really in the right way and trust together, we will deliver this year.
Pilot tourism is over and the parade of pretenders is behind us. Those are nice coinages here coming from Puneeth on the panel. But Arundhati, let's address this issue of enterprise adoption, and specifically from an Indian standpoint, because as you look at this big $300-400 billion opportunity, from an enterprise adoption standpoint in India, what are you seeing today?
Well, I think we are not completely there yet. And we are, however, moving away from pilots into actual production-ready solutions done on sandboxes first and then put on production. We are also seeing a much better way of picking use cases so that you list out all your use cases and determine which ones are the ones that will give you the maximum amount of impact, and then going ahead with those so as to prove, as you say, what is the ROI. And there is sufficient understanding today that ROI is not only quantitative, it's qualitative as well. So what could be the quantitative parameters, what could be the qualitative ones? However, having said that, as Puneeth said, if the technology beneath you is very old, is very traditional, if the processes haven't changed, if they aren't automated, if there are several manual handoffs, the amount of output that you will get will be far lower than what you expect. So the best way of doing this is actually to pick out the use case, to ensure that the underlying workflow is completely automated, and then to go ahead and implement AI on top of it. Unless we are doing that in a holistic manner, you will not really get an assessment of how this is working. And only when you do it holistically, the adoption becomes much better. When is there adoption? Adoption happens when people see results. Adoption happens when people's lives are easier. Adoption does not happen if they have to work just as hard in order to bring in something entirely new. That is where adoption stops. So in order to ensure adoption, you have to ensure that what you are delivering is actually working, is actually adding value.
I want to talk about, again, since we're addressing structural changes that we're likely to see, and this industry has seen a fair degree of consolidation, but do you imagine that we're likely to see far more consolidation? You talked about the nimbleness as far as the mid-tier companies are concerned. They're also growing much faster, at a faster clip over the top-tier companies at this point in time. Do you foresee more significant consolidation in the Indian IT services market?
I don't want to talk about consolidation because I don't know how that trajectory is going to play out. And you're absolutely right. I think the mid-tier companies are actually getting their act together in some sense. They've all been, not all of them, I think most of them have been able to do much better numbers compared to many of the larger ones. That's the fact. But what they are off to, I mean, when you look at, most of them are going for shopping in terms of what is out there. What we are finding is that many of them are adding assets, which are not necessarily to add revenue or add bigger size and so on, but they're very selective in terms of what they're picking on. So they're picking on this, really nice gem, mostly from the startup ecosystem, some of the really small companies. I think that's getting added to the larger fold, and that's how I believe that the market is going to play out.
Shrikant, let's address that issue. And I was having a conversation with the former CEO of HCLTech, Vineet Nair, and he said that this is the need of the hour, is to do what people like Shiv Nadar did 40 years ago when they incubated a bunch of companies which are today, the companies that we all know and respect. But give an opportunity to nurture startup talent, incubate them, give them access to your clients. Don't try and do it yourself because you don't have the capabilities of doing it. Try and bring in startups within the ecosystem, within your own companies, maybe set up a separate subsidiary. Do you believe that that is something that Indian IT should consider at this point in time?
Without a doubt, the Indian IT services industry has to work more effectively with startups. Whether incubate them, invest in them, take them to the world, I think there is no doubt that enormous amount of R&D and innovative work is happening in the startups. Just an example, pharma companies, right? If you look at the pharmaceutical sector globally, now almost all innovation is outsourced to startups. Startups do something amazing. They discover a molecule and Merck comes in, Pfizer comes in, Amgen comes in and swoops them out, and then they create multi-billion-dollar revenue line out of that drug. I don't think the Indian tech industry has figured that out yet, but I think it's something that they should figure it out. And to Rajesh's point, instead of just consolidating another player with sort of similar to your size and then just adding to revenues, it will significantly add their right to win. The Indian tech industry has to work on its right to win. And part of that is certainly through this collaboration with the startups or it's even academia, but also to your earlier point, invest in R&D. I think there's no excuse. India at 0.3% commercial, Indian non-government R&D spends is 0.3% of GDP. Government spends 0.4%. That's total 0.7%. And it is an abyssally low number for the country. It needs to go up to something close to 3%. And Indian tech industry is at less than 1%, right? It's 0.5% or so. It has to get to something like 1 or 2%. And one of the ways I would say that, it's free advice to the Indian tech industry here, is that to go and tell the street that, look, I have a transformation in the making. I have a phenomenally large opportunity, huge market cap, and we can use Noshir to sell that story to the whole world. And then I have to do this transformation, and this time I need to invest greater amount in R&D, because that will create the conditions for my future success. And two, to Noshir's point, there is a part of my revenue stream which is growing very rapidly. There's a part of my revenue stream that is shrinking, but this shrinking pie is going to get smaller and smaller. The growing pie is going to get bigger and bigger, and my growth rate is going to fix itself because I have worked on my right to win. That's what I would do, and go and tell the street.
And just to add to the earlier point, I think today we have more platforms for the larger organization and the startups and the smaller organizations to work together. That's what we've been doing. Many programs such as InnoTrek, for example, exactly aimed at that.
You know, Amit, I also want to understand from you, and ladies and gentlemen, we are going to get some questions in. So if you do have questions for the panel, we'll try and get a microphone across to you, but do keep your questions brief. I want to understand how differentiated is the AI strategy today of Indian IT services. I mean, for instance, TCS is doing data centers, Infosys is not. And that's a decision that you've decided to take, and they've decided it's too much capital, they don't want to go down that path. How differentiated is the AI strategy today as far as the top tier companies are concerned?
I think taking a view from TCS first, and then I'll broad base it. I think we have taken a pretty straight view on the opportunity which lies ahead of us. And for us to be doing justifiable end impact for this opportunity in question, there are things that we need to invest in, there are things that we need to change, there are things that we need to transform. We felt that there is a need for us to have an end-to-end stack view for our customers, and hence HyperVault, which is the AI data center play for TCS. There's a need for us to look at investments slightly varied and differently, some in R&D, some in innovation, some in M&A. And you've seen action from us in that space as well. There is an investment which is required for customers to scale AI. And in that context, should that be done only from a distance to them, or should it be done close to them? Industry calls something like an FDE. There are many different variants of it, and you see that pivoting very well. On all three dimensions of customers, employees, and partners, I think the industry is taking a very accelerated view on how the change is getting deployed. We believe that our strategy is differentiated purely on the back of not only speed and scale, but also on the back of the nuance of context. I think if you put these recipes together, then the dish that you serve out is absolutely very different for customer as an enterprise.
But everybody seems to be serving the same ingredients. So same ingredients, context is everybody's USP.
I think it's fair from a distance. We all have been part of an IT industry, IT services industry, and if you were to talk to an enterprise leader as a customer from an outside-in view, they will find very little to differentiate from a distance. The moment you engage, the moment you have the right conversation, the depth is visible. The depth is the context. And once that depth is visible, the dish turns out different.
The dish comes out different, and everybody has their own version of dhania on top. Okay, we'll get questions, but let me address the anxiety that not just industry is dealing with, but people are dealing with. What does this mean as far as my future is concerned? What does this mean as far as my child's future is concerned? What does this mean as far as the country's future is concerned? This has been the big job creating sector. This has been the sector that's given, aspiration to middle-class India. What happens, Rajesh, there? We talked about the revenue and the headcount decoupling. That is very visible in the numbers. Headcount growth has been flat. With all the opportunities that we've already spoken of, do you believe that we are now unlikely to see net addition as far as headcount is concerned of any significant kind going forward?
No, I think this industry will always be the net addition in terms of the net employee growth year on year. I don't think that's going to go away anytime soon. However, we all know that the kind of growth that you saw in the past is not going to be there moving forward. So, what does it mean to the broader population, especially people who are coming out of education institutions, so on? I think NASSCOM has taken a view that the curriculum will have to fundamentally change what they are teaching within the university. So We've had a program called AI Curriculum, and we're working with METI and the government closely, also with the education department, to say, how do you really go back to the universities and start to change that fundamentally? TCS is involved in that exercise. So is all the top-tier companies that we've been able to enroll in, and then go out and make this transformation. But it will still not change the employment. It will at least make sure that people who are coming out of the colleges will be ready to take on the new set of jobs as opposed to the old set. In fact, I think, again, we all keep referring to no-shares yet, this old and new jobs. I think it is important for us to prepare the entry-level jobs to make sure that they are actually on the right side of the chart in many ways.
Arundhati Bhattacharya, we have a job problem and we also have a talent problem, and we need to address both. But on the job front specifically, do we need to recalibrate the way that we've looked at this industry in terms of job creation? As far as talent is concerned, this has again been an industry that spent significant amounts of money, set up universities and so on and so forth to train people. I mean, employability has always been a challenge. How do you see industry rising to the occasion of an AI era?
Well, one thing I do see, and in a way I think it pleases me as well. Earlier, for instance, no matter what discipline a student would complete their engineering in, they'd land up in IT. So whether he was an aeronautical engineer, or whether he was a chemical engineer, or he was a civil engineer, they'd all land up in IT at the end of the day. Those were the jobs that were actually available. Today, on the other hand, an aeronautical engineer is very much in demand, because missile technology is something that's really and truly making its space. Civil engineers, high demand. Okay, hospitals are getting built, schools are getting built, smart cities are getting built. Chemical engineers, again, very high demand on account of the kind of pharmaceutical products that we are coming up with. So my belief is that AI will be the backbone that will release the job requirements in other areas. And again, very simple example from our own company here in India. I have a 5-member research team, market research team. They were addressing only my enterprise accounts. That's all they could do. And I could not afford more than 5 people in that team. Today, that 5-member team covers my entire set of accounts right up to SMB, plus all of the accounts in the ASEAN region. Now, what has happened is, you might say that means you have not increased jobs. True, but with all of this research that I've been able to do in all of the accounts, I have actually recruited salespeople, because sales opportunities are now coming to me, which were not there earlier. So basically what I'm trying to say is there is a lot of missed demand in the economy that was never sort of, highlighted, that never bubbled up. Now with AI, we should be able to do that and create jobs of different natures, and not necessarily only IT jobs. However, IT will continue to be the backbone for all of this. So that is still very important.
Orchestration engineers, harness engineers, forward forward deployed engine, hill climbing. Yes, we're adding to the list of skills that are required. But the jobs issue. But more importantly, I want to pick up the point that Arundhati made in terms of demand expansion, revenue generation. I think how close are we to move beyond this cost optimization business to actually seeing the benefits of AI show up in terms of revenue and demand?
I think like some of these roles we're talking about, Shireen, didn't exist 12 months ago. The ontology of an enterprise and agent orchestration and hill climbing, like this is new stuff. Like we were talking about new value pools, there are new jobs and new opportunities that are the next generation.
Is it really new stuff or just showing up in a different suit?
No, I think it is definitely new. And I've been in tech for 25 years. All of us have been many years. This is new and this is real. I think the tech is real and these opportunities are real. I think we as parents and as technologists, right, I think we should have a very honest conversation about how careers will shape up in this new world. Careers will still be long, they won't be static. Like my father had a career. It was like a deed that he had, right? Like my kid will have to do a career. So they'll have a portfolio of things to do. And I think that to me is a feature, not a bug, which is what I was telling you outside, which is expecting my 17-year-old teenager to make a choice for his life right now is more pressure than telling him, saying, listen, you get to do 10 things in life. Yeah. Good, bad, ugly, right? It's a combination. Second, AI will amplify all of us, right? I started my career at IBM and McKinsey. The first couple of years were grunt work. All of us did grunt work, right? Which was good and bad. Now, if AI takes away that grunt work, the next generation gets to do more interesting work at the start of it, right? Which means they have a lot more ability to amplify themselves. Again, another gift, right? And they're entering a much kinder world. But you have to be clear-eyed. It's a massive transition. We need a skilling revolution in our country. We've all spoken about this. We're training 20 million people in India. Not enough. But it requires a completely different skill stack compared to the ones that we grew up with. And we have to make that transition for the next generation.
Amit?
I think the shift is moving jobs from jobs to careers. I think we have had a very linear thinking as a country, as an industry, that one line of work defines your job and is equal to your career. I think that will get reshaped to a career conversation which can combine a deep job or a combination of jobs across. And I think that's the thinking and that's the effort that we should be putting towards. Make the young generation, make the colleagues conversation pivot towards careers, say that we'll build your careers, we'll help build your path, rather than say that we protect jobs.
Okay. Shrikant?
I think the first thing I want to say is that to the platform conversation earlier, we must recognize that fundamentally there's a shift between labor and capital and machine and human, right? A lot of the work will be done by the machine and much less by the human. So by definition, if you take a static view of the world, the work for human beings will have to shrink. But then comes a next S-curve which expands the work because there are many more things to be done. The world has infinite number of problems to be solved, and therefore work will expand, and therefore more work will be there. So that is the first lens to understand, is that work will shrink and work will expand. Both will happen, right? Number one. Number two is that there is no such thing as one career for 40-year career. To Puneet's point, it will be multiple careers. So you have to learn, pick up a new topic and become an expert in 1,000 hours, not 10,000 hours like Malcolm Gladwell said, but in 1,000 hours can you become an expert and enough to get a job. And
become a journalist.
Sure.
I can tell you that because and I'm hoping we won't be replaced completely by AI. But yes, I get the point that
you'll be AI assisted in some sense.
Yes, all hoping that. It's quite strange, right?
And I think most importantly, I would say that anybody who's starting out right now has to think of becoming an entrepreneur. My push to is that everybody who's graduating right now, think of creating that company that everybody should be working for, right? And why just work for a company? Yeah. Because what is possible with AI with much less capital is enormous. So why do you have to, anybody who's smart right now, think of becoming an entrepreneur? That's what I would push the country. If we have enough entrepreneurs, I think we will create the growth curve for our country easily.
Well, yeah, absolutely, I agree with you. We need a lot more of entrepreneurial. We have the entrepreneurial spirit. We need to create a much more enabling environment for entrepreneurs to blossom and prosper. Any questions here? Yes, we can see you. If you can just stand up, it'll be easier for them to get a microphone. Go ahead. I'll come to you in just a second. Go ahead, sir.
Wonderful initiative by NASSCOM and CNBC, first of all, so thank you for this. My question is for Shrikant. Shrikant, Nowadays, clients are demonstrating the similar capabilities can be built by using OpenAI or the cloud, and why they need our solution. Even if we are explaining that it is scalable, enterprise level, still I see the resistance. So how to tackle this kind of situation?
So there's no question that it's become a lot easier to build than ever before. And therefore, the low-hanging fruit of what can be built by somebody internally is absolutely something that they should build internally. But just remember that if you build it badly today, it's going to use 10x more tokens and probably be less effective. So what you are saving in build cost may be much more outspent on the token cost. Just it's like building when I buy an air conditioner, I'm always thinking which is the best air conditioner and spend 20,000 extra rupees to buy that air conditioner because it's going to consume more efficient in electricity consumption, which is a far more long-term spend. In a similar way, I think there's a reason to believe that ones that are have deep expertise will build a much better product that will consume much fewer tokens eventually, right? In order to get the same outcome and maybe even get better outcomes. And getting this right and doing it responsibly, building the trustable AI, solving for the alignment problem, what you want versus what the AI does, these are still hard problems to be solved. So if it's an easy problem that anybody can solve, by all means go and solve it.
Yes, sir. Go ahead.
Yeah, this question is for Rajesh. Rajesh, this is a very India-specific question. India-specific question. So India has built global leadership in IT services in the last 3 decades. Now, as AI increasingly takes over the knowledge work, what do you think should be the competitive advantage in this AI era, as you think?
What will be India's right to win in the AI era?
Look, I mean, as most people have said about this layered cake, and again, we had a conversation about that this morning as well. There are multiple layers, one could potentially play, starting all the way from power to a semiconductor and all of that. I think India will have a play in pretty much every layer. The question is, which are the layers that India can really take leadership? Right? Clearly, I mean, there's a data layer, there is an application layer, there is a harnessing layer. Of course, we're figuring out that is potentially a lot more important for enterprises to truly adopt and then truly get into some meaningful solution. So as a leader, I mean, if your question was leadership in terms of how do we sort of position India in many of this, I believe that's what it is, in terms of ensuring that we are able to take our advantage, which is around talent and around what we could do, enterprise context, domain knowledge, and so on, and then turn it into something who can build the best harness layer in the whole world, or the best application layer in the whole world. Continuing to play in the frontier models and continuing to play in the other layers of what AI is, but then specializing on where the strength is quite vivid and then quite competitive around the world.
Yes, the 5-tier cake has been, it's sort of now you wake up thinking about the 5-tier cake and where we find ourselves on that. Yes, sir, you had a question.
Yeah, hi. This question is for Puneet. See, most of the frontier model companies are starting IT services wings. So, Rajesh, what's happening here? And what's your strategy on that front? I mean, where are we? Where do you want to take that?
Listen, I think these frontier models companies are fascinating. I think, but as you go and talk to clients, a few things are becoming very clear, right? First, no client is going to bet the farm on one model. Right? It is just very clear. We have 11,000 models today sitting on Foundry, and eventually, I do think these models will not be your differentiator. That's not the moat anymore. It's your ability to get these models to work for you, right? So that's the first piece to kind of just keep in mind. Second, I think this is something Shrikant spoke about, which is like brilliant strangers, right? These fascinating models don't mean much unless they understand your knowledge turns, unless they understand your organization, unless you have this ability to get this learning loop between human capital and token capital. All of that work needs to be done. This is the 90s moment for IT services, right? All that plumbing, all that orchestration, and all this FD stuff. And the FD is 3 things. It's domain, its ability to go reimagine processes, and hands-on keyboard and products. Who's better positioned than Indian IT services to do it, right? So that is the opportunity to go after. So fascinating innovation happening out of these frontier model companies, and they will continue to do it. But I don't think companies will bet the farm on one and it's the end for others. I think we all have a massive role to play.
Can India be the FD capital of the world is the question being asked as well. Yes, sir, go ahead.
Thank you very much. And we heard a lot about R&D, and everybody is aware that R&D investment is very less. So my questions to each and everyone sitting in the panel right now. So how we can increase the R&D investment of GDP to 3%? What can be the one strong message or step we can take for government, industry, or private sector?
Just start spending the money.
I think maybe that can help, because this is very less if it compares
yes.
to...
Yeah, I think there's consensus on that. It is low. We need to do better. And I think it is going to have to come down to actually spending. And I think we've all talked about, the priorities and the imperatives. I'm going to take the last question because we do have another panel. So if we can get the microphone across to the gentleman who's raising his hand. And okay. I'll come to you. Yes, go ahead, sir.
One last question, or I don't know, you can add it, Sherin. So, unlike the most technology disruptions that come through, it starts with research and then standardize, industrialize, and eventually democratize, which makes the price affordable for the technology. But AI is completely taking a different race, right? It came in a different freemium model and now hitting price peaks, like most of us are talking about token economization and things like that. How do you see that as a very suited panel here? So,
Puneet, you want to take? Puneet and Amit, you want to?
So I think two things, right? And this is, everybody's saying this: the models that you see today are the dumbest and the most expensive they'll ever be. So they're only getting cheaper and smarter, right? So that's the first thing. Second, I think the ability for enterprises to tokenomics or whatever you call it, but the ability to get these, like the first thing I tell clients is don't use frontier models for non-frontier problems. Right, which is just because you have the access to the flying car and you don't take it grocery shopping, right? So I think your ability to orchestrate and get these intelligence at that scale has economics, right? And we now all understanding the economics between cost and capability and our ability to trade off and work with this. So the fundamental models will continue to get cheaper and smarter every day. Our ability to get them to work the right horses for the right courses as enterprises and platform and providers will only get better, right? So that's how we scale this. It's not sustainable to do this at the level it is right now, and that's how we'll scale it.
Amit?
A quick one to add to what Puneet said. I think, experimenting with any new technology is a phenomenal step towards change management. And that's what we all have been experiencing. Now is the next pivot towards scaling. Now, for scaling, compilation of work becomes the most profound way of looking at things. If you go to the frontier model for anything and everything, it will hit the same problem statement that has been coming our way. But if the compilation of work, you break it down on what is really required real time, what is really required for a frontier model capability, that will redefine the ability to scale and get the ROI in the right place.
Well, so let me give one small example. We were doing some work for a company that gives loans. They were using 7 parameters in order to do their underwriting. We are using a frontier model and showing them that you can get 10,000 parameters. The question automatically comes, why do I need 10,000? I don't need 10,000. Okay, 7, you can make it 70. No more, not required. Okay, so every single thing that you do with a client must answer that question. Are you showing them courses for horses, actually? You can't just give the same stuff to everybody to use. Then the whole thing will be obviously too expensive and just too complicated for them to democratize it, really.
I think just when building becomes cheap, what to build becomes expensive. And I think that's your point, which is that's the judgment that we all need to build.
I know we have more questions, but we do have another panel coming up, which will take the conversation and the questions forward. Let me end by asking each one of you, and Shrikant, I'll start by asking you 10 seconds, the most overrated risk AI-related and the most underrated AI-related risk.
The most overrated is Terminator. I don't think it's happening anytime soon. It might happen in 20 years, but not happening now. Okay, that's one. And the underrated is the alignment problem. The fact that it can do a lot of damage very quickly. An AI agent that you set out to do a task is doing more damage than good. I think it's underrated. It's already happening, and we will see a bunch of these things happen in this year.
Absolutely, and we have seen live examples of agents going rogue, and people trying to put the guardrails in place at this point in time. So that's a very legitimate and valid concern. But we don't need to worry about Terminators anytime soon. Amit, the most overrated risk and the most underrated risk.
I have a common view to that: speed.
Speed. Fair point. Fair point. Puneet?
I think the most overrated is AI will replace humans. I don't think that's going to happen. It's going to amplify us. The most underrated is skilling. I think some people still think that it's like a hobby. This is guerrilla warfare against irrelevance every day for all of us. So if you don't take this seriously, the skilling part, I think that is truly underrated today.
Well, the overrated, I think, is the thought that it's a magic wand.
Yeah.
Going to solve everything simultaneously. And the underrated one, I think, is the fact that I still feel people hanging back, not really believing that things have changed materially, and they're not going to change back.
You can't wind the clock back. Rajesh, the final word.
Because I'm representing the industry, so I got to be very careful. The most overrated risk or the comment which I always hear is that it's going to replace all the tech services companies. It's not going to happen. So that's overrated, clearly for me. And the most underrated would be the cyber risk, security and the trust and risk factor, which happens all along. I think we don't speak enough about how much we are not talking about in terms of the real risk of cyber attacks and so on and so forth because of AI.
So the message you want to send out to the market: don't write off Indian IT services.
Absolutely, yeah.
Indian IT, Abhi?
Abhi is in there.
Abhi is in there. All right. Ladies and gentlemen, thank you so much for joining us here on this panel. Appreciate your time. Thank you very, very much for joining us here this evening.